SQC1 standards on quality control. First, we'll see this notes was prepared in corner notes taking method, so that these were the points were like cues. You have to trigger. This is the question type, and this is what you have to write the content. This is the content that you have to write if there was any question that was asked in the exam relating to this topic. Okay. First, you could also take a printout of it, and the notes would be available in our Telegram channel. And what you could do is that after reading, you could close this notes portion and then recall the information here. So it's very easy, and we also provided summary here so that you could see it. And it's not very important, but you have to see it in a day before the examination. Okay, with no delay, please like this video and subscribe for more. And we're going to make our community bigger. And okay, now we are going to discuss SQC1. And what are the you see, this is just of audit pronouncements, and you'll get all the relevant information for your examination, and not a single important point was missed here. And this was newly made. This is not an year back video or 6 months back video. This is made only for May 2023 examination. And if you're also preparing for November 23, you could also watch this. And our first Q is elements of a system of quality control. What is, you see, this was all the essays were with respect to audit, but SQC standard is only such a standard which actually talks with a viewpoint of practicing unit, that is auditor. So now our first Q is elements of a system of quality control. And you could remember this as the figure point, 6 point. It could be asked as Lehem, and it's very easy to remember. We often read that with mnemonic or without mnemonic, you could really grab this points. Leadership, ethical requirements, accept and continuance of client relationships, human resources, engagement performance, and monitoring. Leadership responsibilities of what? The engagement partner or the auditor. He need to also have ethical requirements. These both go hand in hand. And the acceptance and continuance of client relationships, SA 200 series, right? SA 200 series. And then human resources, about the employees or staff or article assistants with the which were in the firm, and relating to the engagement performance, how the engagement that was taken was performed. These two were related. These were the people who do work, and this is how do they work. And this is the monitoring of the engagement partner of what? Work of these staff and article assistants or engagement team. Okay. Leadership, ethical requirements, acceptance, human resources, engagement performance, and monitoring their work. And communicated. Anything with regards to communication of the engagement partner to its engagement firm or engagement or the firm within or people within the firm, what he need to communicate. You see, this communicated is also in the keyword. If you forget this portion, you could write simply what was discussed in our keyword kit 2. I think it's mostly in keyword kit 2. You could refer that. There were 5 simple points you could write for any kind of communication. So what the engagement partner should communicate, or the auditor should audit partner should communicate with whom what? The message that each individual has a personal responsibility, which individual staff for what? Quality, and it's expected to comply these policies and procedures. This is what they have implemented a system here. Who have to follow that? Any kind of systems were what established by the top level management. Here for the audit firm, the top level management is the partner. So partner decides the policies and procedure systems. Who have to follow? The staff individual has to follow. And what he's communicating is that they have personal responsibility for the quality. Therefore, the firm encourages its personnel to communicate their views or concerns on quality control matters. Okay. There are, see, communication is a two-way communication. Communication should be two-way. So what they're communicating, audit partner is communicating to its personnel about the policies and procedures, and telling their personal responsibility. And what they're expecting to be the second way is that the second way from them is that they wanted to communicate their views and concerns on quality control matters. Communication is always a two-way. Leadership responsibilities for quality within the firm. You have seen this here from the elements of system of quality control. Leadership responsibilities, whenever they ask for any kind of in detail with leadership responsibilities, you could write this portion. Designed to promote an internal culture that quality is essential in performing engagements. Performing engagements, what's performing? Why do we set up an audit firm? To do engagements, right? to do engagement. So this is why they were promoting their internal culture, because they wanted quality first thing. That is what the standard is talking about, quality in what matters. Why quality should be there? Quality should be there in the work they perform. What the work they perform engagements. So the firm designed to promote internal culture, the quality is essential in performing engagements. You see, audit is mostly a behavioral science. You'll get all answers and you need not by heart anything. What you need to have is you need to get answers for every question, like how, when, why, who should do, and why they are doing that. And you have to observe for every action there should be an end goal, right? Yeah. So by answering all that, what, who, and how, you could get most of the answers, even if you don't remember. You see, audit is a vast kind of, it's a theoretical subject with a vast information, right? You cannot remember everything, even if you read whole day. Okay. And we all have experienced that, and that's why the most trickier part is that you need to know answers for everything, why they are doing, what all the elements, or what all the parties in the audit, whole audit syllabus, and what purpose they consist of, what work they have, what the responsibilities they have, so we could easily write our audit answers in an examination. So the firm's managing partners assume ultimate responsibility for the firm's system of quality control. Why they're assuming their ultimate responsibility is that it's their responsibility is to place or establish a system of quality control. Promotion of quality oriented internal culture depends on clear, consistent, and frequent actions and messages from all levels of the firm's management, emphasizing the firm's quality control policies and procedures and requirement to. Okay, when quality, okay, they have to communicate in order to promote. So what they are doing, they are more emphasizing on that, and communicating through communicating, and frequently consistent and frequent actions were taken place. For what's their purpose? Why, first of all, why quality was there? Quality is to work. What work are they doing? They're doing engagements have to be done on on compliance of what? Audit has to be done in compliance with auditing standards. That's the same thing here. We are also writing perform work that complies with professional standards and regulatory and legal requirements. What the auditor should comply with, he have to comply with professional standards, regulatory and legal requirements. Professional standards is our professional ethics and standards on accounting. Sorry, auditing standards. Audit has to be done as per auditing standards. Regulatory and legal requirements is Companies Act, and for banks it's Banking Act, insurance, NBFC, PSU, as their requirements. And issue reports. Why the auditor is auditing the financial statements? In order to form an opinion and give audit report. To issue reports that are appropriate in circumstances. I want to mention here, this is actually an inherent risk. What is I want to mention inherent risk here. Inherent risk is that auditor is forming an opinion which is not suitable for the circumstances. That is not appropriate. So what he wanted to do is minimize that inherent risk of the audit. That issue audit reports that are appropriate in the circumstances. So in order to mitigate inherent risk, he wanted to give appropriate reports to the circumstances. And our second thing here is ethical requirements. If they have asked in detail about ethical requirements, what all the ethical requirements he have to possess is integrity, objectivity, professional competence, and due care, confidentiality, professional behavior. You read it once again and you could get that. Integrity, objectivity, rhythm, professional competence and due care, professional behavior, professional competence and due care, professional behavior, confidentiality always. Integrity, objectivity, professional competence and due care, professional behavior, and confidentiality. These were the ethical requirements that the auditor and its staff should possess. And with regards to independence of the auditor, you see, whenever there were independence, they consist of two: independence of the auditor and independent director. So you need to have, whenever you find, you have you have to know whether they were asking about the independence of whom, two parties. Mostly in case based, or whenever in examination we'll get some situations, right, with regards to the management independence and independence with regards to auditor, you have to mention both. And even in our RTP for the May 2023, they have asked about the independence of the auditor. with regards to mind and appearance, and we are going to discuss that soon in tomorrow or evening, tomorrow or today. And with regards to independence of the auditor, what they have to do, they have to establish policies and procedures to maintain independence by the firm, its personnel, during including experts, communicate its independence requirements to its personnel, and identify and evaluate circumstances and relationships that create threats to independence to withdraw from engagement. Such policies and procedures should require engagement partner firm with relevant information about the client engagements, evaluate the overall impact on independence, personnel to promptly notify circumstances and relationships that create a threat to independence. There wasn't anything new here. This was all we have discussed above. We'll see what we have discussed. You see what we are thinking of. We are thinking that the system of quality control should be established by the audit partners. This is what they have also said. If you see here in a summary, we have here, right? This is the objective of SQC1. We'll see first what's the objective of SQC1. The firm should establish a system of quality control designed to provide it with a reasonable assurance that firm and its personnel comply with professional standards, regulatory and legal requirements, that reports issued by firm or engagement partner are appropriate in the circumstances. This is what the objective of the firm. You see, if you forget anything, if you forget everything that was in this PDF or with regards to SQC1, try to remember this just objective of the SQC1 so that you could retrieve everything that was discussed here. You see, you are listening it to here right now, right? And whenever you think of establish a system of quality control, what do you think of? You think of that it was the responsibility of the management and they have to communicate, and it had to comply with professional standards, regulatory requirements, and report have to be issued, and they will have to be appropriate in circumstances. You see, one after the another, the link comes on, and you could remember almost most of the information. So this is something that was relevant to the objective. They have to establish policies and procedures in maintaining independence. This is replaced by the quality there, because they are talking about in an overall perspective. This is, we are talking only with regards to independence, so we have replaced that with independence here. What we have to do, establishing policies is merely isn't enough. You have to communicate. That's what they are saying. You have to communicate. And what they have to find, identify and evaluate the circumstances and relationships that create threats to independence. In order, we said communication is a two-way thing. So what the personnel has to communicate to the management about the threats of such independence, or threats to any kind of circumstances that create a threat to independence. That's the second way for communication. 2 points over. What the policies and procedures should require. What they require is that engagement partner will be available with the information to evaluate the independence. Okay, and personnel should notify which the threats that will create a threats for the independence. This is again a communication portion. So that what's the objective here? Establishing independence in the firm. For what? To determine whether they satisfy independence requirements. Why they have to satisfy the independence requirements? Because as per SQC1, they have to follow professional standards. Professional standards include professional ethics and standards on accounting. Standards on accounting consists of SQC1. So SQC1 consists of independence requirements. So they have to satisfy independence requirements. Maintain and update its record relating to independence. Can take appropriate action with regards to identified threats to independence. These were the purpose of the independence. At least when they have to review the policies and procedures on independences, they have to review annually. At least annually, the firm should obtain written confirmation of compliance with its policies and procedures on independence from all firm personnel. Why they wanted written communication? Because they have said that they were personally responsible. There was a personal responsibility for what? So, call to action, written confirmation. And that's it with regards to independence. It's talking mostly about the communication, and they have to maintain records, and they have to properly identify, and they have to review the report, review the policies and procedures. And with regards to familiarity threat, we have been lately talking more about threat for independence. What's one threat is that familiarity threat. The same senior personnel on assurance engagement over a prolonged period may create a familiarity threat. The engagement partner should rotate after a predefined period, normally not more than 7 years. That is, at least for 7 years, they have to rotate the senior personnel. This is, don't confuse it with rotation of auditors. Rotation of auditors is applicable to a higher class of companies. This rotation is for, you see, rotation of auditors in Companies Act doesn't apply to private company with a lower or small company, right? But for this under familiarity threat, the rotation is also applicable even to a small company or even a partnership or LLP also. That period is not more than 7 years. So don't confuse with that rotation of auditors in Companies Act. And the next point is acceptance and continuance of client relationships and specific engagement. That is, let's say 200 series, you could simply write that. And the integrity of the client and competence to perform the engagement. This is also two-way. We are checking. We are checking the integrity of the management in our client, and we are checking our competence and capabilities and our time also, and about the ethical requirements. So this is again a two-way. In order to write completely any answer, you have to check both sides of the coin. And with regards to, in order to check integrity of the client, how do you check the integrity of the client? First, you have to, how do you know the management is integrity, is having integrity or not? First, you have to identify the identify the identity and business reputation of the client. What's the reputation of its business? Whether they have any uh, loans that were unpaid and they have taken an IP or etc. or bankruptcy, and nature of client's operations. What the nature of the client's operations, and the attitude of the client, attitude of the management. The client is whether aggressively concerned in maintaining the firm's fee as low as possible, and inappropriate limitation in scope of work, that is restricting the auditor's work, involved in money laundering or other criminal activities on reasons for proposed appointment of the firm and non-reappointment of previous firm. What are the reasons for shifting the auditor? So you could write it in from here. Whenever there's an integrity of the management or client, you could write it from here, or you could write it from SA 200 series. That what are the prerequisites in order to accept any kind of engagement? You could also write it from there. Mostly the same points, just one or two excess. You have to see the business reputation and client's operations and attitude, why they were aggressively wanted to make the fee low possible and putting the scope restriction on scope and money laundering activities and any kind of reasons for not appointing the previous firm, and information that the firm obtains from. The audit firm gets information from what are the sources? The communication with existing and previous providers of professional accountancy services to the client, and discussions with the third parties. In order to check the integrity or in order to check the client, from where they get the information? They get from the previous or existing professional accountancy service providers or other third parties like banks or any kind of NBFCs or the regulatories. And inquiry of the firm personnel. This is outside. This is inside. Firm personnel or third parties such as bankers, legal counsel, and background searches with relevant database. They are mostly talking about credit worthiness from credit rating agencies, etc. So these were the sources from which the auditor could get information about the client before accepting the engagement. About human resources is about the personnel of the audit firm. The shift was from client to the auditor now. Human resources. What's the procedure? This is mostly a procedural kind of thing. In order to appoint any personnel, what do? First, we recruit them and we evaluate the performance. And then we'll check the capabilities and their competence, and then for the career development and promotion is like from a promotion to higher level, and compensation for any kind of losses that he had or she had occurred due to their employment. This is what you have to remember. You could remember it mostly like an, you need not write all the points here. If you write 4 to 5 points, mostly it's enough. It's a regular kind of words, right? Recruitment, performance evaluation. See, remember CMP here, performance evaluation, and you have to remember the capabilities, competence, and promotion. These were mostly common terms. What the thing that was most often forget is compensation and career development. So you could remember that, and assignment of team engagement teams. engagement has started, and how do we have to assign the team. Assigning responsibility for each, you have to assign responsibility for each engagement to an engagement partner. One engagement partner, or one more than the engagement partner. First, you have the identity and role of the engagement partner are communicated to key members of the client management and those charged with governance. What they have to tell, they have to first tell about our engagement partner, about his identity and role, what is his responsibility, etc. And the engagement partner has appropriate capabilities, competence, and time to perform the role. From where these points have come? These points have come from before the acceptance of client's engagement. What we have to check? We have to check the competent capabilities, time, right? So we are communicating. We are communicating the same, and the responsibilities of the engagement partners are clearly defined and communicated to the partner. All the responsibilities. So the first thing what they are doing is that they are communicating about the identity and the role of the engagement partner to TCWG or client. And they have to check whether the engagement partner is having appropriate capability, competence, and time to perform. And at least the engagement partner have to know his responsibilities, and they have to be defined clearly and communicate to the engagement partners what his responsibilities. And with regard engagement performance, first you have to know what the objective in order to start anything. If even before reading this SQC1, our object we have also read our objective for the SQC1. And what's our objective for watching this video is to answer any kind of question we get from SQC1 in our audit examination May 2023 in order to answer that. So that's the objective. With regards to engagement, whether it's a due diligence or investigation or just giving an opinion on the financial statements, we have to know the objective and comply with engagement standards. Engagement standards were auditing standards, etc. And or other regulatory requirements that the company is under. And the process of engagement supervision and staff training and coaching, and appropriate documentation should be there. With regards to the human resources and audit documentation, if there were difference of opinion, what we have to write with regards to SQC1. The firm should establish policies and procedures for dealing with resolving the difference of opinion within the engagement team and with those consulted, and where applicable, between the engagement partner and engagement quality control reviewer. The conclusions reached should be documented and implemented. The report should not be issued until the matter is resolved. Mostly, this point was mostly tested in MCQ, where you get in a case scenario question, and the engagement team of this opinion and the audit engagement partner is of that opinion. And what you have to do is that you have to select most appropriate answer, that until conclusions were reached, the audit report should not be issued. Even the differences were between the engagement quality control reviewer also. Until conclusions were reached, you should not issue the report. There were few options like since the engagement partner is of higher authority or he has ultimate responsibility, he can issue whatever he wants. No. Until the conclusions were reached, he should not issue the audit report. It's mostly tested in MCQ, case-based MCQs. And engagement documentation, or you could write it also from audit documentation also. We'll see. This is so simple here. And this portion is also mostly tested in case-based or MCQs. First thing, to complete the assembly of final engagement files on timely basis after the engagement reports have been finalized. So what you have to assemble the engagement files on timely basis. Time limit is ordinarily not more than 60 days after the date of auditor's report. The final assembly of that audit documentation should be not more than 60 days. That is, 60 days is allowed. Till 60 days allowed. It touches 60 days allowed. If it's 61, not allowed. Okay. That's also why we are stressing so much, is that you see all wars happen on borders, right? So if we get on 60th day and 61st day, we'll get more confused, and that MCQ costs us 2 marks. So that's why if it touches 60 days, no problem. If it touches 61st day, there's a problem there. Where two or more different reports are issued in respect of the same subject matter information of any entity, the firm's policies and procedures relating to time limits for assembly of final engagement files address each report as if were a separate engagement. So they're saying is that it's different reports. They were the time limits were of as a separate engagement. So when they issue the audit report, the 60 days, if the auditor or partner is giving 2 audit reports, the 60 days has to be calculated for two independently. And the retention period ordinarily is not shorter than 7 years from the date of auditor report. 7 years time limit we have also seen somewhere else where familiarity threat here, not more than 7 years. And the engagement documentation is a property of the firm at its discretion. Make portions or extracts from engagement documentation available to clients. Such disclosure does not undermine the validity of the work performed. This is also tested in various MCQs, which audit documentation is a property of the client. Sorry, audit documentation is a property of the audit firm auditor, and whether they could give extracts or not, they could give extracts. But does that undermine their validity of the work performed? No. Now we are talking about the monitoring. The inspection of a selection of completed engagements is ordinarily performed on a cyclical basis. What the audit partner is inspecting that. Engagements selected for inspection include at least one engagement for each engagement partner over an inspection cycle, which ordinarily spans not more than 3 years. That cycle is for 3 years, and what for the which comes under inspection, at least one engagement for one engagement partner. That's one audit partner, one partner of the firm, at least one engagement should go for inspection for not more than 3 years. Ordinarily, that's not more than 3 years. For at least 3 years, the inspection has to be done at least 3 years. And the firm's evaluation of each type of deficiency should result in the recommendations for one or more following. If there were any deficiencies that were found, what the recommendations should be done. Taking appropriate remedial actions in relation to individual engagement or member of personnel. What do they, if they find any kind of irregularity or deficiency, what do they have to make? They have to make some remedial actions. What they have to do, they communicate the findings to those responsible for training and professional development, and change to the quality control policies and procedures, and disciplinary action against those who fail to comply those policies and procedures. So what they're talking about is, first they need to have remedial actions. What remedial actions have to be done? They have to communicate the findings to the person who is responsible. For what? For the professional development or training with personnel, etc. And changes to the quality control policies and procedures. Because the system was deficient, there exists some irregularity. So what we need to do? We need to modify, make changes to such policies and procedures. The policies and procedures were ample enough or enough, but the audit partner or personnel had violated that, had overlooked that, then had failed to comply that. What they have to take? They have to take disciplinary action. About our final portion is documentation. The firm should establish policies and procedures requiring appropriate documentation to provide evidence of operation of each element of its system of quality control. What they're telling is that we have this elements of system of quality control, right? All these 5 points have to be properly documented, evidencing their existence. What all they have to document? If they ask for documentation, what we have to document? If they ask for fraud, what we have to document, or how do we have to communicate the fraud? Have to describe. First, we have to tell about the size of our firm and the number of offices here. I have forgot the word offices here. The size of the firm and the number of offices and the degree of authority, both for the personnel and officer, and the nature of, and the nature. Hello, mic testing 1, 2, 3. And the nature and complexity of firms, practice, and organization. Here, I forgot that organization. And we have reached our summary portion. This is not so important, but you have to read it at least once on one day before the examination, and with regards to engagement partner or definitions of staff and suitably qualified external person. And these were just the thing. And the main portion was, main objective is the objective of SQC1. The main portion objective of this summary is at least read this objective before going for the examination. Essay 200, overall objectives of the independent auditor and the conduct of an audit in accordance with standards on accounting. Okay, this note was prepared under column note system so that it's easier to find information or retrieve the information when we give examination. And first we'll see the summary here. Summary is something for the quick reference, what all the contents in the PDF. And you could see this, it was mainly designed to see one day before the examination. First, we'll go with the summary here, and then we'll go in detail to the SA 200 series. The purpose of an audit is to enhance the degree of confidence of intended users in financial statements. That is why audit. What's the purpose of audit? Purpose of audit is to increase confidence in financial statements. That is more about reliability. This is achieved by expression of an opinion by the auditor on whether financial statements are prepared in all material aspects in accordance with applicable financial reporting framework. That is auditor what how could auditor build confidence? He could build confidence. He have to check whether the material in all material aspect the financial statements were prepared in accordance with applicable financial reporting framework, and SEs require the auditor to obtain reasonable assurance. This is reasonable assurance about whether the financial statements are as a whole are free from material misstatement, whether due to fraud or error. Reasonable assurance is a high level of assurance. It is obtained when the auditor has obtained sufficient and appropriate audit evidence to reduce audit risk to an acceptably low level. This, however, reasonable assurance is not an absolute assurance because there are inherent limitations of an audit. What are inherent limitations like sampling or management had very well curated the fraud so that it was not very identifiable unless you would go for a due diligence or an investigation. And which results in most of the audit evidence on which the auditor draws conclusion and bases the auditor's opinion being persuasive rather than conclusive. Persuasive rather than conclusive. The auditor, in obtaining reasonable assurance, you see, this is not why they were saying persuasive is that the auditor is giving his opinion, opinion on what all the audit evidence that he had acquired, and what's it's not that the there doesn't exist a fraud. There might exist a fraud in what all the things he had not audited or not taken into consideration because of sampling. So it's not a conclusive decision. It's just a persuasive opinion. Auditor obtaining reasonable assurance, what he have to do? He has to identify and assess the risk of material misstatement. SC 300 series, whether due to fraud or error based on understanding of the entity and its environment, including the entity's internal control. 300 series 315. Obtain sufficient appropriate audit evidence about whether material misstatement exists through designing and implementing appropriate responses to the assessed risk. They were talking about all the 300 series. Form an opinion on financial statement based on conclusions drawn from the audit evidence. Okay. If you write all the names of the 300 series, 300, 315, 330, then you will get this answer. Detection risk. What is the detection risk? Detection risk is that the auditor is not able to find the misstatement or not able to detect the misstatement that was already existed. The risk that the procedures performed, that procedures means audit procedures performed by the auditor to reduce audit risk to an acceptably low level will not detect a misstatement that exists and should be material either individually or aggregated with other misstatements. That is, the auditor had performed some procedures which he think they were reduce the risk to an acceptably low level, but they cannot detect the material misstatement either if you think that's individually or whether aggregated with other misstatement is a detection risk. And what are the responsibilities of management? We know that what the management should do. They have to prepare financials. They have to design, implement, and maintain the internal controls. And they have to find out what's the applicable financial reporting framework they have. And we'll see what all the things that were given here. It is the design, implementation, and maintenance of internal controls relevant to the preparation and presentation of financial statements that are free from material misstatement, whether due to fraud or error. What's they saying? They are saying to implement internal control and prepare financial statements. That's it. To provide the auditor with. This is before the audit. This responsibilities is before the audit. What? Before the audit, they have to do financial statements and implement internal control system. While during the audit, with regards to auditor, what he has to do, what the management has to do, what the responsibilities of management is, provide all information such as records, documentation, other matters that are relevant to the preparation and presentation of financial statement. Any additional information that the auditor may request from management, like written representations, and unrestricted access to those within the entity and from whom the auditor determines it is necessary to obtain audit evidence. Okay, this is information, this is additional information and unrestricted access. And we all know that audit risk is risk of material misstatement plus detection risk, and risk of material misstatement is inherent risk plus control risk. Control risk here is internal control risk. And this is a summary of SA 200, and now we'll go in deeper and we'll discuss deeper the scope of the audit. What's the scope of this audit as per SA 200 is that the auditor's opinion therefore does not assure, for example, the future viability. What the auditor, if auditor is giving opinion of on the financial statements and giving an unmodified opinion, it does not assure the future viability of the entity or efficiency or effectiveness with the management has conducted with the affairs of the entity. This is not the responsibility of the auditor. It's not the responsibility of the auditor. The future viability of the entity and efficiency and effectiveness of management conducting affairs of the entity. These two were not the responsibilities of the auditor, or the responsibilities of the auditor form an opinion on the financial statements, whether etc. What we know, right? Preparation of financial statement. Design, implementation, and maintenance of internal control relevant for preparation of financial and preparation and presentation of financial statements that are free from material misstatement, whether due to fraud or error. And this is what the responsibilities of the management is: to provide the auditor with all information, additional information, and unrestricted access. And how could the management know? Sources that provide direction on application of applicable financial reporting framework. How they know about the applicable, what's the applicable financial reporting framework is? Due to their, from their legal and ethical environment, and published accounting interpretations, published views of various authorities on emerging accounting issues. And this is what for the management, not for the auditor. How management knows their applicable financial reporting framework is from the legal and ethical environment, and published accounting interpretations and accounting issues, and general and industrial practice that is recognized and relevant, and accounting literature. And professional skepticism examples. We know that while performing the audit, auditor shall have professional skepticism throughout the auditing, throughout the audit. What's professional skepticism is like a questioning mind. Audit should not be done like an investigation, like with a preconceived notion that something wrong had already happened or something wrong that's going to happen. But he need to have some professional skepticism, like a questioning mind, like reasons, whether they were reasonable or not, or these rules or implementation controls, whether reasonable or not. The audit evidence that contradicts other audit evidence that was obtained. So how he have to when this questioning might should trigger, when professional skepticism should trigger, why he have to question out what all the points he have to trigger is that when two audit evidence were contradicting, when the information that brings into question the reliability of documents and responses to inquiries to be used as audit evidence. That is, he had got some information and from and some responses to the inquiries. What they were triggering is that they're triggering the reliability. Like he had got some forged documents or responses from some other uh, unauthorized party. Likewise, if he get that, he have to trigger his professional skepticism or questioning mind. Conditions that may indicate a possible fraud should trigger professional skepticism. Circumstances that suggest the need of audit procedures in addition to those required by SEs. That is, management was not accessing to few people or few debtors in order to check the outstanding balance. What he have to do? He have to first, if you have to write in a 4 marks question, what we have to do for that? Well, first we have to ask for the reasons. We have to check whether the reasons were reasonable or not, and we have to if they were reasonable, we have to follow the alternate procedures. They're asking about, they're saying about this here. And if they were not reasonable, they have to check the integrity of the management, integrity or reliability or of the written representations that were given by the management. And if he found a doubt or he thinks there was any kind of flaw, he have to leave the engagement. And if they were, you have to communicate with any kind of regularities or communicate with TCWJ, etc. This is what how you have to write. Mostly the outline of everything was the same for the audit, but what we do is that for the audit, we think every individual question has an individual answer. That doesn't happen. It's like audit is mostly like a behavioral science. If you know how to do some procedures, or you have to know how to live in that situation, you could easily write. And most of the audit answers, except few, like here the sources that were provided, except like these few direct questions, most of the case based scenarios were mostly outlined in the same way, same direction. Okay, why the auditor need to have his professional skepticism, why need to have a questioning mind? So that he should not overlook the unusual circumstances, not overgeneralizing everything, conclusions that were drawn, and using inappropriate assumptions and determining the nature, timing, extent of audit procedures. Mostly they were saying, talking about the same thing here. He should not overlook such circumstances, and he should not overlook the audit evidence, or overgeneralize the conclusions or about the audit procedures he have, inappropriate audit procedures. What is professional judgment? Professional judgment is essential for the proper conduct of audit. When he has to use professional judgment with regards to evaluating the risk of material misstatement, materiality, and audit plan, and what the extent, nature, timing, and extent of the audit plan, audit procedures, or audit program. So materiality, yeah. While checking the materiality in the audit risk, nature, timing, extent of audit procedures in order to meet the requirements of standards on auditing, and evaluating whether sufficient and appropriate audit evidence has been obtained or not, and whether the overall audit objectives have been achieved or not, and evaluation of management judgments whether in applying applicable financial reporting framework, and drawing conclusions based on the evidence obtained. For these, he need to use his professional judgment. And what is talking about sufficient audit, sufficient and appropriate audit evidence? Sufficiency with regards to the quantity. Mostly sufficiency is based on the materiality level and the risk of the material misstatements, and appropriate is mostly relevant, that's a quality of the audit evidence. Sufficiency and appropriateness of audit evidence are interrelated, as obviously sufficiency is a measure of quantity of audit evidence. The quantity of audit evidence is needed. The quantity of audit evidence needed is affected by auditor's assessment of risk of material misstatement. Yes, more the risk, more the quantity. Lesser the risk, lesser the quantity. Obtaining more audit evidence may not compensate for its poor quality. That is, the audit evidence should also be relevant enough. Appropriateness is a measure of quality of the audit evidence. The reliability of audit evidence is influenced by its source. If that source is from a third party or independent party or individual entity, that is more reliable than by the written representations that were issued by the management. Make sure whenever you get any written representation from the management, what you have to think is that that is just a corroborative. That's just an evidence. What you that does not alternate. It's not an alternative for the audit procedures that you have to perform. So you have to perform the alternate audit procedures. If you have any written representation from management, that doesn't suffice for the audit procedure by its nature, and it's dependent on the individual circumstance which it is obtained. Okay, well, they're talking about the audit risk now. The assessment of risk is a matter of professional judgment, yes, rather than a matter capable of precise measurement. It's mostly a professional judgment, not a precise measurement. Audit risk is a technical term related to the process of auditing. It does not refer to auditor's business risk. They are talking about not the business of the auditor's risk, whether he could appoint the next term also as in a statutory auditor, or as a not. And with regards to the risk of material misstatement, the risk of material misstatements are exist in two levels. That's a financial statement level and a assertion level. The risk of material misstatement at an overall financial statement level relate persuasively to the financial statement as a whole and potentially affect many assertions. The risk of material misstatement at an assertion level consists of two components: inherent risk and control risk. Financial statement level is like a whole, like all the items that were in the P&L or all the items that were in balance sheet. But for an assertion level, a particular item in the balance sheet or particular item in the P&L, about like a trade payables or trade receivables or kind of a closing stock or scrap. Likewise, now we are talking about the inherent risk. Inherent risk is suspectability of an assertion about a class of transaction or account balance or a disclosure. As we have said, that assertions at an assertion level consists of two components like inherent and control risk. This relates to inherent risk, also interrelates with this, and the disclosure to a misstatement that could be material either individually or aggregate with other misstatements. This is mostly a misstatement in order to call it a material. They were using these adjectives, that is whether individually or with aggregated with other misstatements, it is material before consideration of any related controls. That is, it could be wrong. A particular transaction or an account balance or particular disclosure could be a misstatement. What is a misstatement? Misstatement is something that is prepared by the management versus that is required to be prepared by the AFRF. What's a control risk? Control risk is a risk that a misstatement that could occur in an assertion about a class of transaction, a account balance, or a disclosure that could be material either individually or with aggregated with other misstatement will not be prevented, detected, or corrected on a timely basis by entities' internal control. Internal controls, what they have to do, they have to prevent, detect, and correct any material misstatements or any kind of errors that they have occurred. Detection risk, the risk that the procedures performed by the auditor to reduce audit risk to an acceptably low level will not detect a misstatement that exists and that could be a material either individually or aggregated with material with other misstatements. You see, control risk is not preventing, detecting, and correcting any material misstatements. Detection risk is control risk is the internal audit, internal control that was implemented by the management is not preventing, detecting, or correcting the material misstatement. Detection risk is the audit procedures that were performed by the auditor were not detecting the misstatement, which is material, individually or aggregate. What are the inherent limitations of an audit? The nature of financial reporting, nature of audit procedures, the need of audit to be conducted within a reasonable time period. This is what nature of what? Financial reporting audit procedures and with regards to time and any kind of fraud or related party transaction or non-compliance or future events that may cause an entity to cease and to continue as a going concern. These were the inherent limitations of an audit. Have you seen about the going concern somewhere in this? As starting, these were not the responsibilities of the auditor. What are not the responsibilities? Future viability and efficiency and effectiveness of how management had conducted the affairs of the entity. So these were the limitations. These is inherent limitations of an audit: non-compliance, related party transactions and relationships, frauds, and the time and nature of financial reporting audit procedures. And this is with for the SA 200 series, and discuss about SA 210, agreeing the terms of the audit. Who has to agree? The management and the auditor. Why they have to agree? Because they are the auditor and auditee who are agreeing to the terms of the engagement or that engagement letter. The engagement letters contains few terms and we'll discuss about that. And first we'll see the objective of the auditor. The objective of SA 210, what the auditor wants to achieve. He has to know whether to accept or continue the audit engagement on basis whether it upon which it is to be performed that has been agreed through establishing whether preconditions of an audit are present. In order to take a decision, in order to the auditor need to take a decision whether to accept or continue the audit engagement, he has to know that there were preconditions of audit and confirming that there's a common understanding between the auditor and management, and where appropriate, TCWG of the terms of engagement. What they have to have a common understanding. You see, our audit engagement is mostly like an agreement to do a particular job. that is engagement. So both the parties who is giving that work, like the auditee and that's the entity, and the auditor who has to perform that engagement, both mutually has to agree to the contents or the terms of that audit engagement. So what should be exist? Preconditions and a common understanding of the auditee and auditor. This is what the objective of the auditor is with regards to. So if there exists preconditions of the audit and a common understanding, he could accept or continue the audit engagement. Accept or continue. Accept is for the initial audit engagement. Continue is previously has been an auditor and without to continue this year, he has to move. That is, he has to check for the preconditions of the audit and common understanding every year. That's the key point there. And now we'll see what are the preconditions of an audit. Financial reporting framework to be applied in preparation of financial statement shall be acceptable. That is, the responsibility of the management is to prepare the financial statements with regards to the financial reporting framework. That financial reporting framework should be acceptable. When that financial reporting framework is not acceptable, then what it has to do, what the management has to do, and what the auditor has to do. First of all, that entity is not having an acceptable financial reporting framework. The management does not have an appropriate basis for preparation of financial statements. That's a consequence. Yeah. If apart from this financial reporting framework, they do not have any other option to do and to prepare the financial reporting framework. And the auditor also does not have a suitable criteria for auditing the financial statement. That is, except that financial reporting framework, which is not acceptable, they do not find a way, or they cannot figure out how to prepare financial statement, then the auditor has to presume that the applicable financial reporting framework, whether that is acceptable or not, is acceptable. And that is like a compromise situation for the precondition of the audit, for the first precondition. And the second thing is the management to provide the auditor with access to all information of which management is aware that is relevant to the preparation of financial statements, such as records, documentation, other matters. Have you thought this before? This is the premise. This is what the responsibilities of the management is. We'll often write this in all the auditing standards and all. Even in SE 200, you could find out. And such additional information that is the auditor may request from management for the purpose of the audit. They have to give all the relevant information. First thing, they have to give all the additional information. Why they have to give all the additional information? What they're talking about? They're talking about the written representation, the third party balance confirmations. They're talking about that. And unrestricted access to persons within the entity from whom the auditor determines it's necessary to obtain audit evidence. And tell that that's like observing the internal controls or investigating or talking to the in-house legal person, etc. This is the premise of responsibility of the management or duty of the management while starting the audit. Management acknowledges and understands its responsibility. Okay, relax. What's the responsibility of management? We have been talking a lot since past few videos. What's the responsibilities of management? There were mainly two responsibilities. First thing is they have to prepare the financial statements. Second thing is they have to design, implement, and monitor the internal control systems for correct preparation or proper preparation of financial statements. Now we'll see what they're talking about. Preparation of financial statements in accordance with applicable financial reporting framework. Okay, they're talking about the preparation of financial statements and internal control to enable preparation of financial statements that are free from material misstatement, whether due to fraud or error. They have to design, implement, and monitor the internal control system to enable the preparation of financial statement. What that internal control system's objective is? Their objective revolves around the preparation of financial statements. The management revolves around responsibility revolves around the preparation of financial statements, and the auditor is to form an opinion on that financial statements. Okay, if you know the objective of the parties individually, you could easily write or you could easily retract the topics what all you have learned past year. Yeah, and these were the prerequisites, preconditions of an audit. What are they? They need to have a financial reporting framework which is acceptable. If it is not acceptable and they do not find any other way to prepare the appropriate basis to prepare the financial statements for the management, and the auditor also did not find any kind of way to audit, what the auditor has to do, he has to compromise and think that the applicable financial reporting framework is acceptable. That's it. Second thing is the premise, all information, additional information, and unrestricted access. Third thing is the management responsibility, that's preparation of financial statements and internal controls. And the audit engagement letter contains what all the engagement letter should contain. These were the terms of the engagement. Okay, relax. We'll see. While entering into any kind of agreement, what the parties should have a minimum thing about. Forget whether it's an audit engagement or anything. If you got a job or you have a task and the client of you was asking, or you and your client were doing an agreement, what all the things live in the situation. First, you have to know the responsibility of you and your client both. Second thing, what type of work has to be done, and till what extent the time has to be done, or till what extent the task has to be done, or the job has to be done, and whether how the output should be. How the output should be. You have to talk about the process, how it should be, and you have to talk about how the output should be. And again, like remuneration and time, legal matters, and all has to be included. Now, coming to the audit engagement letter, what shall it consist of? Live in the situation as an auditor. What you need to have? You need to have the responsibilities of the management, that is your client, and responsibilities of the auditor, that is you. Second thing, what you have to do. The objective and scope of the audit of financial statements. Till what extent you have to do? What's the objective and scope of the audit? And identification of applicable financial reporting framework for the preparation of financial statements. That is what the preconditions of the audit are. Reference to the expected form, that is how you wanted your output be. And content of any reports to be issued. You see, the reports that were expected from a bank were not same to be expected from an electricity company or a hospital, right? Hospital industry. So what kind of form, what kind of reports you wanted? Okay, responsibilities of both the client and how till what extent you have to be done, and the precondition, that is financial reporting framework. And second, and the last thing is about the output, what type of output you're having. And if you live in that situation, it is very easy. Remembering through mnemonics is a hectic task, and in the exam tension or under pressure, it's a high chance that you write answers of one to the another. Change in the terms of the engagement. Auditor shall not agree to the change in the terms of the audit engagement where there is no reasonable justification for doing so. We have discussed this in our keyword kit, right? With regarding to any kind of, regarding to, I didn't remember the number. Please do check it out. It's between 1, 2, 3. And with regards to change in terms of engagement, what the auditor should do, he has to not agree, and there was no reasonable justification is given. First thing, and if that changes conveys a lower level of assurance, the auditor shall determine whether there is a reasonable justification for doing so. What the auditor's objective is? Auditor's objective is to obtain a reasonable assurance or to provide a reasonable assurance. But it's such change in terms of engagement is lowering such assurance, then you should not accept that unless there is a reasonable justification. If terms are changed, the auditor and management shall agree on record the new terms of the engagement in the engagement letter. This is again the second part of our objective. It's like agreeing to the common understanding, right? Whenever there is change, both the parties have to mutually accept. First thing, he has to not agree whether if it's not having a reasonable justification. If it's lowering the assurance, he could accept with if it had a reasonable justification. And if the auditor is unable to agree to change of terms and is not permitted by management to continue the original audit engagement, that is implementing a restriction on the scope of the audit, then what the auditor shall do? First we have to withdraw from the engagement where possible under applicable law and regulation, and determine whether there is an obligation to report to circumstances and to other parties such as PCWG owners or regulators. You not only write these two, first how if there was any kind of limitation on scope by management, how the answer should be is that first he has to communicate to the management and ask for reasons. That's what they're talking about here. They're asking about the reasons, and if it's reasonable, you could perform alternate audit procedures and obtain sufficient and appropriate audit evidence, and that's fine. And if you cannot obtain sufficient and audit evidence, that is lower level of assurance, what you have to do is you have to communicate with higher authorities, that is PCWG, etc. And if they were also not giving it, and you're not satisfied with that reply, what you have to do, you have to find out whether you have to communicate with any kind of regulators, like if you have found a fraud, and whether there exist some regulations, right? You have to communicate with them, and then withdraw from the engagement. This is what's the process flow of that. Audit is mostly like a behavioral science, and if you live in that situation, it is very easy. So we have seen this portion, right? And there were 2 portions here, and we are coming to the end of this topic. Factors for determination of acceptability of the financial reporting framework. We have been previously discussed about that when the financial reporting framework is not acceptable, the applicable FRF is not acceptable. On what categories we could judge whether that FRF is not acceptable? Because by the nature of the entity. on which industry or in what kind of industry it is in, the nature of financial statement, both has to align. The nature of the entity and the nature of the financial statement has to be aligned. And the purpose of the financial statements also has to be aligned, whether they were CFAs or whether it's from standalone or interim financial statement, the purpose has to be also aligned. When these three were not aligned, when the nature of the entity financial statement and the purpose is not aligned, that is not an applicable, acceptable financial report framework. Applicable is different from acceptable. Don't get confused. The applicable should be acceptable. That is when the applicable FRF is acceptable, when its nature of the entity, nature of financial statement, and the purpose of financial statement are all aligned. And the hotel industry could not get aligned with the insurance industry and insurance to a banking industry, right? All the financial statements were different. And determining the acceptability of general purpose framework, this could be a direct question. And, you see, when these all things you could be remembered as a mnemonic, but try to remember from the question itself. You see, you have neutrality here. This was general purpose financial statements, and it goes with the NE there. When you find a general purpose framework, try to circle things that were easier to remember. That was easier for the answer. That's no better. So we could be less confused in that stress situation in the examination about the purpose. Purpose is for the relevance of the information provided in the financial statements. It has to be relevant, obviously. Why they are talking about the relevance and reliability and completeness of the information is sufficient, appropriate audit evidence. It all lies there. Auditor has to obtain sufficient and appropriate audit evidence. Sufficient is with regards to the quantity. Quantity is completeness. So, appropriate is more of relevance and reliability. They have to be more of the relevance category. Reliability is with regards to the more the management is not. If management is not integral, integrity is not maintaining integrity and has doing some frauds and all, that written representation that were given by the management were not reliable, right? That's when neutrality and understandability, understandability. These are the things. What the acceptability of general purpose framework. Relevance in that the information provided in the financial statement, completeness in that transactions, reliability in that information. These three you could easily write: relevance, completeness, reliability. Neutrality and understandability were two new words that you have to add into this one. And the objective of the auditor, and that's it for 210. Essay 220, quality control of an audit or financial statement. You see, first we'll discuss about what's the difference between SQC1 and Essay 220. SQC1 are the quality control procedures that were mostly done in audit firm. This was quality control procedures that were done while doing the audit. That is, quality control procedures have to be followed by all personnel who are in the audit firm, that is a clientee, that's the auditor. Here, the quality control have to be performed or have to be maintained by the engagement team, that is who have gone to audit an entity. And with that said, we'll move on to our first summary portion. And this summary portion is not so important, but you have to check this one day before the examination to get together all the fundamentals together in place to write your answers better. The objective of auditor is to implement quality control procedures at engagement level that provide auditor with reasonable assurance that he complies with professional standards, regulatory and legal requirements, and audit report issued is appropriate in circumstances. Okay, they are saying that the objective of the auditor under this standard is that he have to implement some quality control procedures at the engagement level, that is while performing an engagement, that is audit, to obtain reasonable assurance that what he has two duties. What is first thing? He has to comply with all the professional, ethical and regulatory requirements. What are professional standards? That is the standards on accounting, regulatory as per law, legal requirements. That is what independence, integrity, objectivity, professional competence and due care, etc. And why he had taken an engagement, why he had done is doing audit, is to provide an audit report. They're talking about that. Again, the responsibility of the auditor is to provide auditor's report which is appropriate. And second thing is, these are a few definitions that were given. We'll just go through it once. Engagement quality control review, a process designed to provide an objective evaluation before the report is issued. So we're talking about the objective evaluation here. You see, objectivity is a professional principle, fundamental principle of professional ethics, right? Objectivity. So they are asking us to recheck our objectivity through an engagement quality control reviewer before the audit report was issued. And who can be appointed as a engagement quality control reviewer? Any qualified external person or a partner other than the person in the firm. Monitoring. Monitoring is a process comprising on ongoing consideration and evaluation of firm systems of quality control, including periodic inspection of selected completed engagements, mostly like a peer review, designed to enable the firm to obtain a reasonable assurance that the system of quality control is operating. Mostly whenever we see monitoring, what we think of? We think that the engagement partner has to monitor the engagement team, or the entity or the management has to monitor the operations in the entity, right? But as per SA 220, what's monitoring they're talking about? It's a quality control procedure that the engagement team has to perform, that the auditor has to perform. With that said, we'll move on to our topic here, independence. With regards to independence, what all the things you have to write? Obtain relevant information to identify and evaluate circumstances and relationships that create threat to independence. You see, if you have got a client and whose son is also an article assistant in your firm, you cannot appoint that son in that engagement team, right? You have to deploy him into another engagement. You see, you have to obtain information with regards to such relationships and evaluate such information on identify breaches. That is, if the information has not got right, or any person in your engagement team was connected directly or indirectly with your client or the company there, you have to take appropriate action. This is what the golden rule is. Whenever you find any kind of irregularities, what you have to take some remedial actions. That's appropriate actions here. First, you have to obtain relevant information of threats to independence, then evaluate the breaches, that is non-compliance of this, non-compliance of information. Then with non-compliance, you have to what to take? You have to obtain proper action. That's it with regards to independence. This mostly talking about the engagement team independence to the client. And while talking about the engagement quality control review, for audits of financial statements of listed entities, if the firm had determined that an engagement quality control review is required, that is, this option is available when we audit the financial statements of listed entities. Then what for unlisted entities? There comes peer review, right? Peer review done obviously for all the phases, right? There was an amendment also. Do check out the amendment video. And the engagement partner shall for CA final. Yeah. And the peer review is the chapter only for CA final. CA final students can go and watch that audit amendments audit amendments video. And for the financial statements of listed entities, if the engagement partner think quality control review is required, engagement quality control required, then what he shall do? He should appoint the quality control reviewer. And what he has to do? He has to discuss significant matters and not date the audit report until the completion of engagement quality control review. You see, this point is widely tested in at least once in every examination. They're talking about is that mostly how this point could be asked is like, if there were any disputes between any non-compliance, or they're not agreeing to something, either the engagement partner or the engagement team, people of the engagement team can, because the responsibility lies with the engagement partner, they'll ask, because the responsibility of the engagement is helps with the engagement partner can issue the audit report without clarifying all the doubts and disagreements. But he should not do that. He should not sign the audit report unless there were no disagreements. Everything has to be clear. They are also talking about like that only here. They should not date the audit report until the completion of engagement quality control review. You see, why you appointed him? You appointed to discuss the significant matters that were arising during the engagement audit engagement, to check the objectivity of the client. So he shall not sign the audit report until completion of that. And here the engagement quality reviewer shall evaluate what he shall evaluate, what all the things he had discussed with shall evaluate, what were the things that were discussed, significant matters were discussed, and any kind of irregularities or difference of opinions were also should be evaluated, should be checked for. And financial statements and proposed auditor's report. Why audit was doing such engagement? He is doing engagement to form an audit report on the financial statements of the entity. So he shall also evaluate the financial statement and a proposed audit report. It's a proposed audit report. Please mention to write here proposed, because he should not issue the audit report until completion of engagement quality control review. And selected audit documentation. While performing the audit, what the auditor gains, what's his property, audit documentation is his property. So we have to also evaluate the selected audit documentation and conclusions reached and firm's independence that we are talking about. And if in consultation has taken place on matters involving difference of opinion, I have to evaluate all these things. Significant matters, financial statement, proposed audit report, audit documentation, firm independence, any difference of opinions. And in case of difference of opinion, the engagement team shall follow firm's policies and procedures for dealing with and resolving the difference of opinion. They have to follow the SQC1. That's all the quality control procedures they have when there was a difference of opinion. With regards to documentation, what the auditor has to document, he has to document the issues with relevant ethical requirements and how they were resolved. What are they talking about? They're talking about the independence here. Independence is an ethical requirement. This, you see, he has to document what? He has to document the appropriate actions that were taken, the issues and the breaches here, and the appropriate actions that were taken, issues with ethical requirements and how they were resolved, conclusions on compliance with independence and all the conclusions that were reached, and conclusions reached regarding acceptance and continuance of client relationships and engagements. That's what the things that we do prior to the audit. It's a 200. Consultations undertaken during the course of the audit engagement. What consultations they're talking about? They're talking about engagement quality control reviewer consultations. And with these things, these are all the things that the auditor has to document. You see, whenever you see what all the things that the auditor has to document, you have to check for. You see, that is not something from out of nowhere. He documents what all the things that he does under that specific act. In this essay, what he's doing, he's checking for independence. That's what we are all documenting. And he's taking consultation of the engagement quality control reviewer. That's what we are documenting. And what are the documentation that have to be done by EQCR? The procedures required by the firm's policies on engagement quality control review have been performed. What he had come for, he had come to check the firm's quality procedures while performing the engagement. What he has to document? He has to document what he's checking, the procedures of the engagement quality firm's policies, and has to review has to be been completed on or before the date of audit report. That again repeating the same thing here. The audit report has to not issue until completion of engagement quality review. And they are saying here the engagement quality control review has to be completed before the sign of audit report. Both were the same. The reviewer is not aware of any unresolved matters that would cause the reviewer to believe that significant judgments the engagement team made and conclusions they reached were not appropriate. He is giving a declaration that all the things he was discussed. You see, audit engagement partner, that is engagement partner, do not discuss all matters. He discussed only significant matters. Now the EQCR is declaring that he was discussed only few points, not all points. He is not unaware. He is not aware of unresolved matters. He is giving a declaration there, and these are the things that he has to document, all the procedures that he had come to check for, and all the and this is something the EQCR has to be completed before signing of audit report, and he is giving a declaration that he is unaware of unresolved matters. And the fundamental principles of professional ethics is all our favorite question. It's talking about only the 5 points: integrity, objectivity, professional competence, and due care, confidentiality, professional behavior. If you read it 2-3 times, you will get that. And most about essay 230, audit documentation. First, quickly we'll see the summary here. You see, the summary is just contains what all the things that we're discussing or that were discussed in this PDF. This is for the quick reference for the just one day before the examination. And first, we'll see the summary here. We have objectives of the auditor here. Why this? Under this standard, what the auditor is wanting. The objective of the auditor is to prepare documentation that provides a sufficient and appropriate record of the basis for auditor's report. What's the responsibility of the auditor? His responsibility is to obtain sufficient and appropriate audit evidence and give an audit report on the entity's financial statements, right? You see, the documentation has to be what? Sufficient and appropriate. The audit evidence have to be sufficient and appropriate, and even the audit documentation have to be sufficient and appropriate. On which basis he provides an audit report, right? Because what does audit documentation consist of? Audit documentation consists of audit report, audit procedures, audit evidence that were obtained, and the conclusions that were reached. On that conclusions, he gives the audit report. And second thing, as we have already discussed, audit, anything that was in document provides an evidence. Evidence for what? Evidence that the audit was planned and performed in accordance with SCs. We know that audit has to be done as per SCs and other legal or regulatory requirements, if at all he is working in some specialized entities like banks, insurance, and applicable legal and regulatory requirements. So it's to provide a sufficient appropriate record and an evidence that audit was planned and done as per SCs and applicable legal and regulatory requirements. Now we'll start with our audit documentation here. You see, anything that does has to have some benefits, right? Why auditor has to put so much of effort, effort to prepare audit documentation? What's the advantages of audit documentation? To plan and perform the audit, to direct and supervise the audit work, to be accountable for its work. You see, we'll boil down these 3 points into a single scenario. You see, when you say think you are an auditor or you are a senior, who gives oral instructions to your team members or your article assistants. Does this? It would be like a Chinese whisper that we have discussed in our OP, right? That we have our orientation program in our IPCC or CA Inter, right? Where a large paragraph boiled down into a 4-word sentence. It shouldn't be like that. All the instructions have to be followed. When you give 10 instructions, it is not that the article assistant remember 4 to 5 and perform that. It's not that simple. So, in order to plan and perform the audit, who has to perform? That engagement team to perform. Who plans that? The engagement partner plans that. To direct and supervise the audit work. In order to direct or supervise, what you need to have? You need to have ready document for you to supervise them with that. So you need to have a written documentation form, that's audit documentation. To be accountable for its work. You see, all the audit documentation also involves audit procedures that were performed. It also includes the matters who have performed the audit, which makes the audit team accountable. So these 3 things were boiled down to this point, this situation where the engagement partner gives audit instructions or audit procedures to its teammates to plan and perform the audit. Second thing, to direct and supervise. After giving some instructions, we have to direct them and supervise how the work is done. And third thing is with regards to audit team members, engagement team members to be accountable for their work. Third thing, retaining a record, and fourth thing, the retaining a record of matters of continuing significance to future audits. We have moved to next year now. There's a little bit progress had happened. We have been seniors now, and our juniors will see how we have performed the audit for their future reference, future audits. And the next one is enabling the conduct of quality control reviews and inspections, and enabling the conduct of external inspection like QCR and like peer review, quality control reviews, etc. They're talking about this. The audit firm also have to report to few authorities on how the quality control procedures that were being performed in its audit engagement, like peer review that you have got. Obviously, peer review have got so many amendments this time. We need to check out the audit amendments video there. But and moving on to here, enabling the conduct of quality controls and inspection and external inspections. And that's it. These were the advantages of audit documentation, that scenario, to plan the audit and for the future reference, and few inspections and reviews. And timely preparation of audit documentation. How the audit documentation be documented? It have to be documented in a timely manner. Timely manner is as soon as possible or immediately. Preparing sufficient and appropriate audit documentation. Whenever you have to describe an audit documentation, you have to describe it as sufficient and appropriate audit documentation on a timely basis to enhance the quality of the audit. You see, audit documentation enhances the quality of the audit. As we have already discussed here, when you give 10 instructions, the engagement team does 4 to 5, it is not a quality audit, right? They have to do all the 10 on 10. That's what quality of the audit lies there. It also facilitates the effective review, evaluation of the audit evidence obtained and conclusions reached before auditor's report is finalized. That is to review the audit evidence and review the conclusions, evaluate the conclusions. See, what's the responsibility of the auditor again? To give an audit report on the conclusion, on the audit evidence that he had obtained, right? In order to give an audit report, what you have to do? You have to review the audit evidence and evaluate the conclusions that were reached from the audit evidence, and an appropriate time limit within which to complete the assembly of final audit file, that is final assembly, is ordinarily not more than 60 days after the date of auditor's report. After the auditor had signed the audit report, within 60 days, there have to be final assembly of the audit documentation. This is widely tested in an MCQ. We'll see also the linked portion here. What are the changes made to audit documentation during the final assembly process? This is also an important question. This is a category question in this A20, SA 230 audit documentation. You see, after completion of all the audit procedures and everything, what are the things you have to do while final assembly of the audit? If you see, auditor is, when he's signing the audit report, by that time all the audit procedures should have been performed, all the disagreements have been reached into a conclusion, right? What have to do in the final assembly process? We have to sort things out and have to delete some files, or they have to eliminate or discard few unnecessary things. But at the final assembly process, you cannot go and do the depreciation calculations or assessment of risk there. This audit was completed here. After that, what you could do? You could delete or discard superseded documentation. What are superseded documentation? You see, audit is a process, right? You think of audit as a 10-step process. Audit is a 10 days process. You have got some information on day 3 and you have got some information on day 7 on the same aspect as on the day 3, that is superseding, that is overriding the information, or in addition to that, where your conclusions or where your thinking process gets changed or gets into another direction. So with which information you will give more weight to, on day 3 or day 7? Obviously day 7, right? Day 3 were the superseded documentation, or all the documentations, all the conclusions reached in day 3 were superseded by day 7. That is what superseded documentations were. Deleting and discarding such superseded documentation, and sorting, collating, and cross-referencing working papers. You have to collate the working papers. Collating is like combining 2 different audit working papers into a single set, where like someone who had physically verified the assets of the entity and someone who had verified the accounting depreciation or depreciation, we have to combine them and sort them and cross-reference those working papers, and signing off on completion of checklist. As we have already discuss, they have given 10 instructions, out of which 10 on 10 has to be done. You have to sign that all the 10 have, or 10 on 10 have to be had done by that engagement team head. And documenting audit evidence that auditor has obtained, discussed, agreed with the relevant members of the engagement team before the date of the audit report. What we should not have any disagreements with the EQCR he is taking a reference of, or auditors, experts, or management or audit team engagement members, audit engagement team members. We have to reach some conclusions. You have to document those things. These were all the things that should be changed in the final assembly process. What are the things? Deleting and discarding superseded documentation, sorting, collating, and cross-referencing working papers, signing a checklist, and documenting audit evidence that were obtained by the engagement team. And now we'll discuss the form. We'll see audit documentation have to be done in which form, what all the content should be in the audit documentation, and till what extent the audit documentation have to be done. You see, there were two parties, the auditor and the client. We have to check both the categories which would influence the audit documentation. First, all the size and complexity or the nature of the client has to be first influence the audit documentation. Second thing, what were all the audit procedures that were done by the auditor also influence the audit documentation. This is what before preparation of the audit. But while during the preparation, while during the audit, what influences the audit documentation or audit evidence? All the significant matters, if at all any fraud or material misstatements that had happened, these things influence the audit documentation. This first we'll see what all the things that influences the form, content, and extent of audit documentation. The size and complexity of the entity, on how big the entity was, or how complex the transactions in the entity was, influences the audit documentation. The nature of the audit procedures performed. These also we have discussed. This is with regards to the client, with regards to the auditor before the audit. The identifying risk of material misstatements while during the audit, while doing the audit. The significance of audit evidence that was obtained. How significant the audit evidence is. If it's from third party or it's being contradictory to the audit evidence that were already obtained, it also influences the audit report, audit documentation. The need to document a conclusion. As we have seen here, we have to review the audit evidence and then obtain conclusions. Whenever you obtain an audit evidence, you have to also document how you have reached the conclusion. There's a flow chart type, because we have reached this so and so audit evidence and we have reached this so and so written representations and external confirmations. It is being concluded that we have to reach conclusions like that for future reference audit, for future audits reference. And the audit documentation is obviously the property of the auditor, and that's it. And we'll see what all the things that we could document, what all the things we call it as an audit documentation, the audit programs, that what the instructions that engagement partner had given to his team members, analysis, it's like analytical procedures and analyzing how the internal controls were being performed, etc., on the accounting process, etc. Issues memoranda. Issues memoranda is something of brief summary or brief description. Issues is problems that you find in the entity. So it's a brief description of the problems or irregularities that you find. Summaries of significant matters and letters of confirmations and written representation, letter of confirmations from third parties and written representations from the management, and then checklists. These are all few examples of audit documentation. These all together constitutes audit documentation. Audit need not include superseded drafts of the working papers. As we have already discussed superseded drafts, right? These need not be included. You could delete those superseded documents. Oral explanations by auditor do not represent adequate support for the work auditor performed or conclusions the auditor reached. What they are saying is they are emphasizing that the audit documentation have to be in a written format. Oral explanations do not represent adequate support for the work auditor performed. Now we'll see documentation of significant matters. As we have seen here, he has to Yeah, here. Audit documentation includes summaries of significant matters, right? We'll see what are those significant matters. You see, whenever there's any kind of question that rises, you have to think from both perspectives to write your audit answer completely. First, with respect to the entity and with respect to the auditor. With regards to entity, what we see the risk and internal control procedures, etc. Right? And therefore, with regards to the auditor, what we check how the audit procedures were being performed, and we'll keeping those two things in mind, we'll just figure out what all the documentations of significant matters could be. Matters that give rise to significant risk. Okay, they're talking about the entity here, the significant risk. Circumstances that cause auditors significant difficulty in applying necessary audit procedures, like limitation of scope that was infused by the management or something other. They're, they're restricting the auditor in performing the audit procedures. They're talking about the auditor here. Okay. Findings that could result in modification to the audit opinion. Again, they're talking about the auditor. After doing some audit procedure, if there was any kind of limitation of scope, what he has to do? He has to modify the opinion or provide a disclaimer of opinion, right? That's what they're talking about. That's the duty of the auditor. So why have auditor had gone to the entity to give an audit report on how the financial statements were prepared by doing some audit procedures. We see here he had got some significant difficulty in applying necessary audit procedures. So what he have to do? He have to do some modifications to the audit opinion, whether giving a qualified opinion or doing a disclaimer of opinion, anything. This all both deals about the auditor. And the results of audit procedures indicating that, okay, here he had got some significant difficulty in applying audit procedure, but he had done some audit procedures. But what that results is, that results that financial statements are materially misstated. Okay, when the financial statements are materially misstated and a need to revise auditor's previous assessment of risk of material misstatement. That is, we have obtained some audit evidence which is not, which is contradictory to the audit evidence that had previously obtained. So he has to, or he had came to know that the management were involved in frauds and they do not have integrity, and he has to re-evaluate the risk of material misstatements that he has done at the planning stage of the audit. So what are the documents, what are the significant matters, what are the things we have to document? Significant risk, all the circumstances that cause difficulty in applying the audit procedure, and all the findings that could result in modification of opinion. And if, after he done the audit procedures, that results in that the financial statements were materially misstated, and his assessment of risk of material misstatement has to be revised. And with regards to completion memorandum, as we have described, a summary or description. The auditor may retain as a part of audit documentation a summary that describes the significant matters identified during the audit and how they were addressed. And also, we also have done something like completion memorandum, right? In our keyword kits, right? We have taken some issues with regards to fraud or that's happening or any deficiencies on how to communicate. We have formed an outline on how to write answers in audit, right? Likewise, the auditor also gives an outline on how to address the significant matters that he had found. The auditor may retain a portion that describes the significant matters, that's what we have also already described there, and identify on how they have to be addressed, how the audit procedure have to be performed and how they have to be addressed. And I think this we have discussed this changes to the final assembly process, and that's it. We have completed our SA 230, 240. The auditor's responsibilities relating to fraud in an audit of financial statement. Now, first we'll move on to the objective of the auditor with regards to SA 240. The objectives of the auditor are to identify and assess the risk of material misstatement in the financial statement due to fraud. That is, first you have to identify what risk of material misstatement in the financial statement with fraud. Only fraud, not by error here. Fraud, what's the difference between fraud and error is the intention of the party who was the fraudster, who had committed the fraud. First, we have to identify whether there exists any risk. Second thing, after identifying any kind of risk, he had to assess the risk and confirm whether there were any fraud that had taken place or not. For that, what he has to do? Has to obtain some evidence. What evidence? Sufficient, appropriate audit about the assessed risk of material misstatement. That is, in this step 2, he had already assessed that there was a risk that the financial statements contain a material misstatement due to fraud. So, how could he obtain sufficient and appropriate audit evidence? Through designing and implementing appropriate response. How he have to respond that. There were five cases or five types. How could an auditor obtain sufficient and appropriate audit evidence is through inspection, inquiry, observation, reperformance, and recomputation. By usage of these five, any of them, not all five, he can obtain sufficient and appropriate audit evidence. After obtaining that, after confirming that fraud had happened, what he has to do? He has to respond appropriately to the identified or suspected fraud. That's it. These were the objectives of the auditor. We first dive into the SA 240. Responsibility of prevention and detection of fraud. Who has the responsibility to prevent and detect fraud? It lies with the management and TCWG. How could we confirm that it lies with the management and TCWG? Is because the implementation, design, implementation, and maintenance of internal controls in an entity lies with the management. So that by internal controls or to properly implement the controls in the entity, that the financial statements are reported as per applicable financial reporting framework, and there were no errors in the financial statements. And moreover, the preparation of financial statements also the responsibility of the management. With taking those two, we have concluded that the responsibility to prevent and detect fraud lies with the management. Management and higher authorities, and the management is TWG. Those charged with governance. How they have to do? Place a strong emphasis on fraud prevention. That is, they have to put some controls, or they have to communicate strongly within the entity and its employees, which may reduce opportunity for fraud to take place. And fraud deterrent. Deterrence is something to eliminate all the circumstances, situations, people that cause fraud. This is what fraud deterrence, which could persuade individuals not commit. Persuade is something to forcing, which is affecting the individuals or influencing the individuals not to commit fraud. When there were stringent rules or controls, or have eliminated all the circumstances, situations that could cause fraud, then what the individual will do? They not commit fraud because of likelihood of detection and punishment. What are the responsibilities of the auditor here? These were all the responsibilities of the management to prevent and detect fraud. Then now what are the responsibilities of the auditor? An auditor is responsible to obtain reasonable assurance. He has to obtain what? Reasonable assurance that the financial statements taken as a whole are free from material misstatement, whether caused by fraud or error. This is the phrase we often use in our audit answers with regards to responsibilities of the auditor. There is nothing much we could take from it. What is the risk of the auditor? Risk of the auditor is auditor have come to the entity to achieve something, some objectives. What are those objectives? To obtain sufficient and appropriate audit evidence, to give an appropriate audit evidence, audit opinion. You see, there were a few kinds of inherent limitations of audit. That type one of inappropriation of audit opinion is he auditor is giving a unqualified opinion when there were material misstatements in the financial statements. That is type 1 error. Type 2 error is he is giving a qualified opinion when there were no misstatements in the financial statements. Both were not appropriate. So those were the risk of the auditor, and risk of the auditor is also that he is not able to detection risk. He could not able to detect the material misstatements or any kind of irregularities that had been in the entity or entity's financial statements, even though the audit procedures were planned as per SEs. That is what detection risk is. I've discussed about inherent risk and detection risk. And control risk is something that the internal controls were not planned appropriately. And that deals with the management. With regards to auditor, inherent risk and the detection risk is something we have to discuss about, and we have done that. And the risk of the auditor not detecting the material misstatement, that is detection risk resulting from management fraud, is greater than employee fraud. That is, but the detection risk is higher in place where there was a management fraud. Why management fraud? Why that detection risk is greater in management fraud? Because management frequently in a position to directly or indirectly manipulate accounting records. They could manipulate the accounting records as a whole. An employee do not get so much of scope in manipulating all the accounting records and present fraudulent financial information or override control procedures designed to prevent similar frauds by other employees. You see, who makes the rules only breaks the rules. Management puts the strong emphasis on the fraud deterrence and put some internal controls to prevent the fraud, and they only override such control. These two things got like they could manipulate the accounting records and override the controls. These two factors would make the risk of the detection risk of the auditor detection risk is being greater in case of management fraud than in an employee fraud. And owing to the inherent limitations of an audit, there is an unavoidable risk that some material misstatements or financial statements may not be detected, even though those audit is properly planned and performed as per SG. Again, they're talking about the detection risk. Here, they're talking about the detection risk is greater in management fraud than the employee fraud because of this manipulating of accounting records and overriding controls. One thing. And second thing is that even though the audit procedures were planned, planned as per SCs, there were still some limitations for audit that the material mistake cannot be identified or detected. Those were the risks of the auditor. In addition to that, you could also write the inherent risk of the auditor. Auditor shall make inquiries of management internal auditor TCWG employees to determine whether they have knowledge of any actual, suspected, or alleged. Alleged is something without a proper evidence. It's mostly like a bus that was going on, that there was so much air in the entity that someone had done this much of fraud affecting the entity. The management auditor has responsibility to obtain sufficient and appropriate audit evidence with regards to the assessed risk of material misstatement. We have discussed how many ways he could do that. He could do it by inspection, inquiry, observation, reperformance, and recomputation. Now he's doing inquiries. He's obtaining sufficient and appropriate evidence through inquiries. What is he's inquiring? He's inquiring management. You see, you could replace with internal auditor TCWG employees here and write that, depending upon the situation asked in the exam. And most suitable thing is management's assessment. Management's assessment of risk that financial statements may be materially misstated due to fraud. You have to inquire how the management assessment, whether they had assessed whether there were any risk of financial statements that could be misstated. He's asking about the management's assessment of that risk. Second thing, management's process for identifying and responding to the risks of the fraud in the entity. First, he's asking about assessment of the risk here, and second thing, after assessing how they were responding to the risks of fraud. That's what the table or flow that we also followed here, right? We first assess the risk of material misstatement, and then we have done some audit procedures to obtain audit evidence. Even they are asking, we are also inquiring, auditor is also inquiring the management in the same flow. How they have respond to the risk of the financial statements that could be materially misstated. And management, after identifying that, whether the management has communicated regarding those processes that they were implemented here in the second step for identifying and responding to the risk of fraud in the entity, that they have communicated all the processes that have been implemented in with regards to the risk of fraud. And third and the last point is management's communication to employees regarding its views on the business practices and ethical behaviors. This is like the management's or TCWG's ethics, or what they wanted to the employees, how they wanted the employees to work, all the rules and regulations. First thing, assessment of risk. Second thing, response to that risk. Third thing is whether they have communicated what all the process that were done there. And fourth one is their views. There's a conclusion. And responses to the assessed risk of material misstatement due to fraud. This response is with the auditor. With regards to auditor, what he has to do, he has to assign and supervise personnel. Personnel is the engagement team, or personnel in our audit firm, the engagement team here. Evaluate whether the selection of application of accounting policies indicate fraudulent financial reporting. That is what all the accounting policies that the entity had selected, whether they could indicate a fraudulent financial reporting or not. The financial reporting framework that the entity has to prepare financial statements should be acceptable. It should be acceptable, not fraudulent. And we have to check that accounting policies and incorporate an element of unpredictability, that is professional skepticism, to be alert. That is, and be dynamic in selection on of nature, timing, and extent of the audit process. Whenever we be unpredictability, or whenever we infuse an element of unpredictability, we'll be dynamic in changing the audit procedures or audit program. Whenever we find any kind of information that is could not be achieved, or objective that could not be satisfied with the existing audit program. And this is what with regards to the response. So this is how the auditor has to respond to the material misstatement due to fraud. He has to assign and supervise personnel. He has to check the accounting policies there, and he has to incorporate an element of unpredictability. Management overriding controls. This is the main reason why the detection risk is greater with management fraud than the employee fraud, right? The management's ability to manipulate accounting records and prepare fraudulent financial statements by overriding controls that otherwise appear to be operating effectively. These were they're talking about those 2 points that we have discussed here, right, in the risk of the auditor. Manipulate accounting records and override the control procedure. They are overriding the controls. If they haven't overridden those controls, the controls were normally operated effectively only. From now onwards, put some extra attention, because these were the topics where you could get direct questions on something, a sequence or a flow of things that we could easily understand. We have to learn some new terms here. The auditor, but nothing so difficult, much difficult. These are all the things which we often see in our FI, but we have to incorporate into audit also. The auditor shall design and perform audit procedures to what? Test the appropriateness of the journal entries. Now what? See, he had found that a fraud had happened. What he has to do? He has to He have to respond, right? He has to respond appropriately. We are responding now. The auditor is designing some audit procedures for what? To test appropriateness of journal entries. Why only journal entries? See, the fraud had happened in financial statements, right? So what do financial statements contain? Financial statements contain some journal entries. What he has to do? He has to operate some sufficient and appropriate audit evidence. How could he obtain? He could obtain by inspection, inquiry, observation, reperformance, and recomputation. Now what he has doing? He's doing inquiries. Inquiries to whom? He cannot go and ask the HR about the journal entries, right? He could ask those individuals who is involved in financial reporting process. This is the accounting department. Make inquiries of individuals involved in financial reporting process. The accounting department. Select journal entries. That is, selecting is audit sampling and other adjustments made at the end of the reporting period. Have to select few journal entries and all the other adjustments in the end of the reporting period, year end, and consider the need to test journal entries and other adjustments throughout the period. First thing you have to do, you have to compulsorily review few journal entries and all the adjustments the reporting period end. But you also have to test the need to consider the journal entries throughout the period and other adjustments throughout the period. Have to check for that. This is mostly considered when the fraud was so significant. First thing, what he has to do, he has to test the appropriateness of journal entries. Second thing, he has to review accounting estimates. Why accounting estimates only? Because a lot of frauds or a lot of window dressing in the financial statements happens in the accounting estimates only. Retrospective review of management judgment. Okay, there was a policy in the financial statement reporting is that all the 20% of the sales were treated as a provision. The provision of bad debts was estimated to be 20% of the sales. That was fixed by the management a long ago. When you go and ask when you make inquiries with the individuals who were involved in financial reporting process, what do they say? That's a judgment of the management long ago. You have to review those accounting estimates, even the estimates that were retrospective, thus past. Evaluate whether such judgments made by the management indicate a possible bias. That is, whether those have any bias on the part of entities management, that management had placed some bias, had put bias to represent a risk of material misstatement due to fraud. That 20% provision for bad debts, whether that indicate a risk of material misstatement due to fraud, we have to evaluate that. And after that, for significant transactions that are outside the normal course of a business for the entity, that is mostly they're talking about the not arm's length price, the close length price and the related party transactions, or that otherwise appear to be unusual given the auditor's understanding of entities and its environment. So what he have to do? After finding fraud, he have to test the appropriateness of journal entries, review accounting estimates, and the significant transactions. He have to check for that. And why fraud is done? As we are talking a lot about fraud, why someone does fraud? This could incentives or pressures to commit fraudulent financial reporting. We have few problems in our FR, right? If you're CA final or if you're a CA Inter, you could get few things like if the profit is crosses this to this year, then the employees get this much bonus or ESOPs, etc. Right? Those incentives or sales personal pressure to commit some or to meet some sales targets, right? Those incentives and pressures to commit fraudulent financial reporting. A perceived opportunity to commit fraud. Here, what's the management's responsibility? Management responsibility to do fraud deterrence and reduce the opportunities for fraud. But there exists some fraud, there exists some opportunity to commit fraud. Then what do? They commit fraud. Incentives, that is something that forced. Option B was an opportunity. Third one is individuals may able to rationalize committing a fraudulent act. That is individual, they themselves voluntarily do fraud. First thing, someone forces or some external factor forces the individual. Second thing, there exists an opportunity to. Third thing is the individual themselves voluntarily commit a fraud. Some individuals possess an attitude, character, or a set of ethical values which are unethical that allow them to knowingly and intentionally commit a dishonest act. With regards to fraudulent financial reporting is done by how the fraudulent financial reporting is done by manipulation, falsification, forgery or alteration of accounting records or supporting documentations from which the financial statements are prepared. What they're manipulating, falsifying, and altering. They're altering, manipulating, falsification, falsification, alteration, manipulation. What are they doing? Therefore, doing for the accounting records and the documentation on which financial statements should be representation or intentional omission. The financial statements from the financial statements and any kind of events or transactions or any other significant information. That was the events or transactions or any information that misrepresenting intentionally or omission. They're omitting from the financial statement. That's another kind of fraudulent financial reporting. First of all, what they have done, they had manipulated, falsified, altered the accounting records and some documentation. Second, they're omitting and intentionally misrepresenting few transactions, events, and information. Intentional misapplication of accounting principles relating to amounts classification or presentation disclosure. This is what something amounts classification, presentation, and disclosure was something you already know. And they're what misapplying the accounting principles. By these three ways, they could achieve fraudulent financial reporting. How the management do frauds? What are the ways management could do frauds? They does frauds with regards to financial statements. How could they do? Record fictitious journal entries. What financial statements contain? They contain journal accounting records contain. They contain journal entries. What they could do with journal entries? They could record fictitious journal entries. Inappropriately adjusting assumptions and changing judgment. They could what the journal entries also contain. The journal entries contain accounting estimate. That's the second biggest thing. Inappropriately changing the judgments and adjusting such exemptions and omitting, advancing, or delaying recognition. Omitting, they have omitted recognition of few events and transactions they're advancing. That is the event that had occurred in the next year, that is later on financial statements, they have accounted that in the previous financial year. So they have made that event or transaction in advance or delayed. The event, something that had occurred this year, they were carried forward to the next year. Anything would be a management fraud technique. Concealing or not disclosing facts. They were like concealing or not disclosing the facts that had happened, like factory fire accident, etc. Engaging in complex transactions and altering records and terms relating to significant and unusual transactions. So with regards to complex and unusual transactions, first thing, what they could do? They could record fictitious journal entries, inappropriately make assumptions and change, omit, advance, and delay few events and transactions, conceal or not disclose facts, engage in complex transactions, altering records with unusual transactions, and misappropriation of assets. You have to, whenever you write misappropriation of assets answer, what you have to do is you have to check for financial and non-financial or big plant and machinery or buildings, etc., and write those points. With regards to cash, how could they misappropriate cash? They could embezzlement of risk. After that, we'll move on to few next class of assets. Stealing of physical assets or intellectual property. That is mostly like a stock in trade or in intangible assets, right? Intangible assets, they could also steal that, like software, code, or etc. Causing an entity to pay for goods or services that were not received. Again, with regards to stock, using entities assets for personal use, like few plant and machineries that we could use, right? You could use that for personal use. You see, embellishment of receipts, stealing physical assets or intellectual property. This is mostly done when the asset was smaller in size but higher in value. Could or do steal the physical assets or intellectual property, causing an entity to pay for goods and services that were not received, mostly for the stock in trade, and using an entity's assets for personal use. These are the ways you could misappropriate the assets. What are the exceptional circumstances that question the auditor's ability to continue performing the audit? That is like limitation of scope, or the management have the not at all responding to what all the queries, or you see auditor has but had doing so much of inquiries, right? If they're not responding to that, he cannot obtain sufficient and appropriate audit evidence, so he have to leave the audit engagement. We'll see what all the circumstances he could leave. The entity does not take the appropriate action regarding to fraud. You see, they were not at all responding. The management is not at all responding with regards to the fraud. That is, whenever find any kind of fraud, what the responsibility of the auditor? They communicate within 2 days to the board or management or TCW, any other higher authority. And what do they have to do? They have to give responses. They're not giving. If the fraud is 1 crore or more than 1 crore, they could give what the auditor could do. They could report to the central government. But for the less than 1 year, he should consider discontinuing the audit. And the auditor's consideration of risk of material misstatement due to fraud and results of audit tests indicate a significant risk of material and pervasive fraud. That is, he found that everything was fraud. Everything was fraud. It's completely fraud. All the financial statements were completely fraud, and he is not at all obtaining any sufficient or appropriate audit evidence. If he's not only receiving any audit evidence, and he could leave a disclaimer of opinion and then withdraw from the audit, or the audit has a significant concern about the competence and integrity of the management and TCWG. That is, the integrity that is lacking in the management and TCW. All the three circumstances, he could withdraw. You have to question his ability to continue performing the audit when the management is not responding to the fraud, whether and the risk of material misstatement indicate a significant risk of material and pervasive fraud, that the whole financial statement fraud, and the auditor had to question the competence and integrity of the management and team. These all things he has to question the audit, and this is I've already discussed, and this is the 250 consideration of laws and regulations in an audit of financial statements. First, we'll see summary of the SA 250. The auditor is required to remain alert, that is, to show professional skepticism throughout the audit to possibility that other audit procedures applied for the purpose of forming an opinion on financial statements. That is, why the auditor had gone for the entity. He had went to form an opinion on the financial statements that were prepared by the management of the entity. So he's applying few audit procedures. In that audit procedure, he came to know that he instances of identified and suspected non-compliance. There were few non-compliances. He has to maintain professional skepticism throughout the audit. After after such normal applying normal audit procedures, he have found few instances of non-compliance. What he has to do? He has to put some specified audit procedures to assess their impact on the financial statement. This is what generally auditor does. Now we'll see the objectives of the auditor as per SC 250. First, he have to go and obtain sufficient and appropriate audit evidence regarding compliance with the provisions of those laws and regulations generally recognized to have a direct effect on determination of material amounts and disclosures in the financial statements. Okay, what they're talking about? They're talking why the auditor had gone, why he had gone to obtain sufficient and appropriate audit evidence with what? With regards to the compliance of provisions of compliance of laws and regulations which have a direct effect on material amounts like litigation fees or any kind of profit or disclosures in the financial statements. And to perform specified audit procedures, see, he had applied some normal audit procedures and found few instances of non-compliance. Now what he has to do? He has to perform specified audit procedures to help identify instances of non-compliance with other laws and regulations that may have a material effect on financial statements. You have to perform specified audit procedures to find an instance of other laws and regulations which would also have a material effect, and to respond appropriately to non-compliance or suspected non-compliance with laws and regulations identified during the audit. What is our golden rule? Whenever auditor finds any fraud, irregularity, or error, what he has to do? He has to respond to that risk. He has to respond to that risk or error and communicate to the management unless they were involved in such irregularity or fraud. So here the auditor is responding. And this just a definition, what is the non-compliance? It acts of omission or commission by an entity, either intentional or unintentional. This could be test wide in a examination when in situation based, whether the management has no intention to non-compliance, but does that would be a non-compliance or not? Yes, it is a non-compliance, but when it is done intentionally, it is a fraud. When it is done intentionally or unintentionally, it is a non-compliance. They have to face consequences for that. But when it is done under intentional, he has to also face the compliance of fraud also, including non-compliance, or contrary to the prevailing laws and regulations, that they have omitted or committed few missed acts that were intentional or unintentional, which are contrary to the prevailing laws and regulations. And now we'll dive into SA 250. Auditor shall obtain a general understanding of. You see, as per SA 315, on what he has to obtain understanding. He has to obtain understanding on the business environment, including its internal controls. But in SA 250, what he has to obtain understanding of? Also, legal and regulatory framework applicable. No, make a note here. This is not a financial reporting framework. This is a legal and regulatory framework as we are considering laws and regulations here. And how the entity is complying with that framework. Okay, whenever we find any rules or regulations that the entity has to follow, what we have to check? We have to check whether they are complying with that or not, and obtain sufficient and appropriate audit evidence regarding such compliance. This is to obtain audit evidence so that we could go and have conclusions in the audit documentation and then form an audit opinion. Okay, general understanding of the legal and regulatory framework and how the entity was complying with and sufficient and appropriate audit evidence. And the audit procedures when non-compliance is identified or suspected. These were the specific audit procedures. These were those other, where's here? Yeah, those other audit procedures, and here the specified audit procedures which would be applied when we find any identified or suspected non-compliance. What we have to do? We have to obtain understanding of nature of the act and the circumstances in which it has occurred. See, this is the act of non-compliance. You see, these were the acts plus the circumstances in which it has occurred, like the incentives that it might gain or the pressures it is facing. We have to evaluate that act, that specific act plus circumstances, and further information to evaluate the possible effect on the financial statements. So see, auditor, everything he has occurred or he has gained all the information in the audit, it all boils down to the financial statement, because he had gone to the entity to form an opinion in the financial statements. So he has to evaluate the possible effect on the financial statement. Third thing, discuss the matter with the management, as with our golden rule. Whenever we find irregularity or non-compliance, we have to discuss with the management and shall consider need to obtain legal evidence. You see, what we need to have an understanding of legal and regulatory framework, not financial framework, which we are specialized in. We have to consider non-compliance of laws and regulations, which we are not specialized in. So we have to take legal advice, that is auditor's expert. Using the work of auditor expert, we could take legal advice if necessary, evaluate the reliability of written representations, and take appropriate actions. You see, whenever we find any fraud or irregularity or any kind of non-compliance in which the management has to do, that's a responsibility of the management to comply with few things or to form an internal control, then what we have to do, we have to check the competence, we have to reevaluate or reconsider the integrity and competence of the management, plus we have to check and evaluate or the reliability of the written representations given by those management, because the fault lies with the management here due by non-compliance of the laws and regulations, and we have to do that, and how to prevent and detect the non-compliance. This is a responsibility of the management. You see, it could be asked like there had been a non-compliance which was unintentional, as we have discussed here, and the management want to rectify it in the next year. They ask the auditor on what ways, how could they prevent and detect the non-compliance. What are the ways that the management could prevent and detect non-compliance? Monitoring legal requirements, ensuring that operating procedures are designed to meet them. You have to design the operating procedures in an entity in such a way that they could meet all the legal requirements for the entity, and put in appropriate systems of internal controls, code of conduct, ensuring employees are properly trained, engaging legal advisors to assist in monitoring legal requirements, maintaining a register of significant laws and regulations with which the entity has to comply. Internal audit function, audit committee, compliance function. Can we remember all this? That's highly impossible, right? We'll figure out how could we write it in an examination. First thing, maintaining a register with all the significant laws and regulations in which the entity has to comply. First, learning the scope or the syllabus kind of thing, if we talk it about students' words. This is so simple to remember. Second thing, these were something which we already know, like internal audit function, audit committee, or compliance function. These are something which we often use in our audit corporate governance chapter or etc. and other companies audit chapter also. So these four are the things that you could remember easily. And internal controls were the responsibility of the management. As we are also discussing about prevention and reduction of non-compliance with the responsibility of the management, this could also be remembered easily. So all these 5 points could be remembered easily. If you could have so much of time and you could remember the other points, you could also remember the other points also. And plus one, as a bonus, you could also remember the legal advisors also here. This also had been repeated here, from which legal advice is also taken by the auditor. So the management can also take legal advices here. 1, 2, 3, 4, 5, and a 6 points. The 6 points could be remembered simply, easily, without no tension, with not so much of effort to be remembered. And with regards to the indications of non-compliance, this is with respective to the auditor's perspective. When he gone to audit of an entity, what are the indications of the non-compliance? First, the purchasing prices are significantly above or below the market price. That is, purchasing prices or sale price which were significantly above or below the market price. Those were what? Unusual transactions which companies registered in the tax havens like Mauritius, Dubai, and payments without proper exchange control documentation. Unauthorized transactions or improperly recorded transactions, investigations by regulatory organizations, and adverse media comment. These are all the circumstances which indicate a non-compliance. They are talking about the transactions here, and they're talking about the payments without a proper exchange control, like they're just simply giving the payment, like or to the foreign operations, etc., without a proper documentation in written, like they're not purchasing any kind of property or bag or goods, or they're not taking services in written, and they're having unauthorized transactions where, you see, there were few transactions where the board of directors or management has to take prior approval of audit committee before entering into transactions. When they have not taken such kind of approvals, or that those were the unauthorized transactions or improperly recorded transactions or fictitious journal entries, and investigation by regulatory organization by and an adverse media comment. And this is what with regards to SA 215. This SA 260, communication with TCWG. First, we'll see the objectives of the auditor, as we always do. The objectives of the auditor under SA 260 were to communicate clearly with TCWG the responsibilities of the auditor. First of all, what he's wanting to communicate? He was wanting to communicate the responsibilities of him in relation to the financial statement audit. That's why he came to the entity, and an overview of the plan, scope, and timing of the audit. Yes, he could also discuss the estimated plan, scope, and the timing and extent of the audit with TCWG. Responsibilities and scope and time, nature, timing, and extent. And to obtain from TCWG the information relevant to audit. In order to do an audit, what he want sufficient and appropriate audit evidence. Who gives that? It was given by the entity itself. A part of the entity is a TCWG, so it also have to give information. So the responsibility of the auditor or objective of the auditor is to obtain such information, to provide TCWG with timely observations arising from the audit that are significant and relevant to their responsibility to oversee the financial reporting process. What the auditor has to do, he has to communicate with TCWG with regards to any kind of significant observations or circumstances or significant difficulties or matters that were relevant to his responsibility, relevant to their responsibility. Here, there is TCWG's responsibility. Before communicating, the auditor also has to check whether to whom we are communicating, whether the matter that we are wanted to communicate is within their scope or not. If we could settle that matter with regards to uh, with audit committee or internal auditor or management, we could settle there. We need not go to the such higher level of TCWG. So we also have to check the responsibility of the TCWG and how significant the matter was. And to promote effective two-way communication between the auditor and TCWG, obviously communication is a two-way process. So what they were expecting here is that as we communicate to TCWG, we also have to respond to TCWG's queries or questions in order to be the communication two-way effective. And with that said, these were all the objectives of the auditor. First thing, he has to communicate his responsibilities, nature, timing, and extent of the plan, scope, and timing. And he has to obtain relevant information from TCWG, and he has to give his observations timely, which were relevant to their responsibility, and a two-way communication. With that said, we'll move on to our standard now. The auditor shall communicate with TCWG in writing on a timely basis. What all the things you have to communicate with TCWG? All the significant qualitative aspects of the entity's accounting process. As per SA 315, he has to obtain understanding of entity's accounting process and risk management process. He have to communicate with TCWG significant qualitative aspects, including its with regards to accounting practices, including its accounting policies, accounting estimates, and financial statement disclosures. Why he has to communicate this? Because he have come to the entity to audit the financial statements. Financial statements were prepared with the use of accounting policies, estimates, and those disclosures. And any significant difficulties. What are the significant difficulties? We'll see here. Significant difficulties were such situations where significant delays by the management that the written representation that the auditor asked were not being delayed by the management. They were, and the communication or information that has to be given by the management was being delayed. That's a significant difficulty. An unreasonable brief time, that is the time period in which the audit has to be completed, is very brief. That is very lesser amount of lesser time period within which to complete the audit. So it would be very difficult to do or perform all the audit procedures as per SGs. And an extensive unexpected effort required to obtain sufficient appropriate audit evidence. What they are talking about here, that unexpected effort is such additional audit procedures. That is, if we wanted to confirm the balances of some trade payables or trade receivables, the management is putting a restriction on few trade payables and trade receivables and giving a reasonable explanation. There's no problem with that management, but it's happening every time. It's happening extensively. That unexpected effort to obtain sufficient appropriate audit evidence is being so extensive, unexpected efforts has to be in place. Those were of significant difficulties and restrictions imposed on the auditor by the management. There were restrictions on the scope, etc., by the management on the auditor. These were all the significant difficulties in the audit. This has to be communicated with TCWG. Written representations by the auditor is requesting to communicate with regards to the written representation they were auditors seeking and the circumstances that affect the form and content of the auditor's report. What is the form? It could be a qualified or unqualified form, or the content is like including of key audit matters or other matter paragraphs or basis for the qualified opinion. These would all affect the circumstances that would affect the content or form of the audit report has to be communicated with TCWG. Statement that engagement team and others in the firm are appropriate and the firm have complied with relevant ethical requirements regarding independence. That is, they have to communicate with TCWG that the engagement team had complied with relevant ethical requirements regarding independence. That's the thing they have to communicate with TCWG. What all things they have to communicate? They have to communicate about the significant qualitative aspects with regards to entities' accounting practices, significant difficulties, written representations, circumstances affecting firm and content, and that the firm or engagement team is complying with independence. What are all the considerations that the auditor has to take while talking or communicating with TCWG? What all the considerations has to make was the respective responsibility, whether the matter that the auditor is communicating, that what the matter they are communicating was within the scope of was the responsibilities of TCWG or not. That is what's even the objective of the auditor also. Communicate yearly, sorry, that was relevant to their responsibility or not, to provide observation that was relevant to their responsibility. So what do they have to consider? They have to consider the responsibility of that party we are communicating to, the nature of the matter to be communicated, and the relevant legal or regulatory requirements. If the authority has to take action in relation to the information communicated. You see how what they were taking considerations were the nature of the matter, whether that's significant or not, and the relevant regulatory authority. That is the consequences, legal consequences, or what's the entity's legal environment is asking to comply with. And if the authority to take, if it has the authority to take action, that is, they're asking to put some remedial measures with regards to the matters or significant deficiencies that the auditor is trying to communicate. These are all the considerations. This is their responsibility, and this is their ability to that they has the authority to put some remedial actions here. And these were the regulatory requirements that they are talking about, and the matter nature of the matter, that's just a description of the matter. And now we'll discuss that how the auditor and audit committee will communicate or how what the relation should be between the auditor and audit committee of the entity. The auditor will be invited to regularly attend the meetings of the audit committee. That is, a regular invitation for the auditor is given for all the meetings of the audit committee. But, the audit committee will meet auditor without management at least annually. That is only auditor and audit committee, no management involved in between. This is with regard to the meeting, and the chairperson of the audit committee will liaise with auditor periodically. Liaise is something to work closely, works proximity, that regularly updating the work. That is what they're talking about. That is, the chairperson should communicate with the auditor with regards to the how far they have come, how much the work has been completed. They have to discuss with the chairperson of the audit committee there. This is with regards to the meeting. Regularly attend the meetings and one at least annually meet without management, and the chair of the audit committee will liaise with the auditor periodically. And these are the significant difficulties which we have discussed earlier. And what are all the significant matters? Significant matters were something that we should talk with TCWG or higher authorities. Significant events or transactions that occurred during the year, business conditions affecting the entity, and the concerns about the management consultations with other accountants. These were all the significant matters which we could also communicate with to TCWG. Matters override of controls. Management's ability to manipulate accounting records and prepare fraudulent financial statements by overriding controls that otherwise appear to be operating effectively. See, this phrase has to be put in your answer sheet in the examination whenever the question contains a situation where the management overriding the controls. This is also, we have discussed the same thing here in essay 240 video also with regards to that. What is the responsibility of the management? The responsibility of the management is to prepare the financial statement and design, implement, and maintain the internal controls. They have put the controls there, but they are only breaking or overriding the controls which otherwise operate effectively. The rules were very good that they operate effectively and put a sufficient, it satisfies the auditor that the financial statements were true and fair, but the management is overriding the controls. You see, they could, why we are mostly concerned about the financial statement is we auditor have gone to the entity only to audit the financial statements. So these overriding controls could, or management has the ability to manipulate the accounting records as a whole. You see, the detection risk in where the management fraud is higher than the employee fraud because they could frequently, they have a power to manipulate all the accounting records. Employees have a limited scope, but the management have a larger scope for the accounting records. They are the higher authorities. And no mention of engagement partner name. The auditor, you see, what's the difference between auditor and engagement partner? Auditor is of maybe a firm or is a person or individual. Auditor could be a firm or an individual, but engagement partner is the one who supervises the engagement teamwork. That he is an individual. So the auditor intends not to include the name of the engagement partner in the auditor's report required to discuss this intention with TCWG. If the auditor don't want to mention the audit engagement partner name, they have to discuss that intention with TCWG to inform the auditor's assessment of likelihood and severity of a significant personal security threat. Why they were not mentioning engagement partner name is because they have a personal security threat. And this is a famous question, right? This is an important question though. Threats to independence. Self-interest threats, self-review threats, advocacy threats, familiarity threats, and intimidation threats. What is self-interest threats? Self-interest threats that auditor has a personal interest in the outcome of the audit, like a financial interest, like they might have been a debtor or creditor of the company, or they have held some shares. Actually, an auditor is not eligible to do audit when he holds some shares, but he had some financial interest with regards to that. So that those were the self-interest threats. Self-review threats. You see, the internal auditor doing the statutory audit. This is a perfect example of a self-review threat, where someone reviews their own work, like the um, like they lack the objectivity and they lack the unbiasedness. So this is what the self-review threats were. Advocacy threats. Advocacy threats were auditor is too involved in a person. Like, you see, you think Ratan Tata as your role model and have started a firm, and you are a auditor of the Tata group. Then what do? You advocate that company. That is, you put your words, or you are on the side of the company. That is your bias to that company. So that is what advocacy of threats. You do not have so much of unattached or unbiased. Somewhere or the other, you are attached to the company that they're doing good. And this is what you are advocating the company. You have to be an auditor, you have to be unbiased and put some professional skepticism, but you're advocating that company. You're standing on behalf of the company. That is a threat for independence. Familiarity threat. Familiarity threat is that auditor is too familiar with the company's management, or the TCWG, or the persons being in the entity. So the auditor could be tempted to overlook the problems, like it's a more friendly nature. Advocacy is something you are on behalf, you're advocating for the company, and familiarity is that you're being a very friendly nature and all, that you're overlooking that. Intimidation threats. Intimidation threat is the someone else is carrying or bullying the auditor or influencing the auditor to change his opinion, or to work in a only certain way. That is bullying, is intimidation threats. Self-interest threats is where you have some personal interest. Self-review threats was that, like, someone reviews their own work. Advocacy threat is like you're too involved or attached to that company. And familiarity threat is that you're very familiar with the company, etc. And intimidation threat is someone is trying to bully the auditor. Auditor gave to TCWG. What auditor had given? Auditor has communicated all these things, right? These all the things were given to TCWG, and that TCWG had given to third party. In that situation, what happens? Can the third party rely on that communications given by auditor? There's a question with regards to that. The communication has been prepared only for the sole use of TCWG and should not be relied upon by third parties. Auditor gave it only to the TCWG, and there is no responsibility assumed by the auditor to third parties. You see, the auditor gave to TCWG. His responsibility lies only till TCWG, not to the third parties, where the TCWG had extended that communication to third parties. If for that, auditor will not take any responsibility. Any restrictions on disclosure or distribution to third parties, like it is restricted that such communication was not to be disclosed or distributed to third parties. Now we are going to discuss about SA 265, which is communicating deficiencies in internal control to those charged with governance and management. And auditor had gone to audit the financial statements in an entity. But as per SA 315, what he has to do, he has to also obtain understanding of a business environment, including its internal control. While understanding the internal controls, what he has to find, if he had find any deficiencies with regard to any kind of internal financial statements, what he has to do, he has to communicate them with TCWG or management. Now, we'll see the objective of the auditor under SA 265. The objective of the auditor is to communicate appropriately to TCWG and management what deficiencies in internal control that auditor identified during the audit, and in auditor's professional judgment, are of sufficient importance to merit their respective attentions. What he has to communicate? He has to communicate the deficiencies of internal control. How did he find deficiencies in internal control? Well, during the audit. Okay. But why he has to communicate to TCWG or management? Were they so important? Yes, in auditor's professional judgment, they're sufficiently important to merit respective attentions. That is, it is important to drag the attention of, to put the attention of TCWG and management in those deficiencies in internal control. What are deficiencies on internal control mean? Deficiency in internal control exists when a control is designed, implemented, or operated in a such a way that it is unable to prevent, detect, or correct misstatement in financial statements on a timely basis. See, what's the responsibility of the management? Responsibility of the management is to prepare financial statements and design, implement, and maintain internal controls which help the financial statements to be material free from any kind of material misstatement or error or any kind of fraud. But there exists a control which is designed, implemented, and operated, which is unable to prevent, detect, correct misstatements in the financial statements. You see, control exists, but it is unable to do its work. In that case, it's a deficiency in internal control. And second thing, a control necessary to prevent, detect, and correct misstatement in financial statement on a timely basis is missing. There doesn't exist a control itself. Here it exists, but is unable to do its job. Here the control itself isn't existing. So this any kind of these two situations cause a deficiency in internal control. Significant deficiency in internal control is a deficiency that in auditor's professional judgment is sufficient important to merit the attention of those charged with governance. You see, by this time you would have understood what's the key phrase of it. In order to add a significant here, like the phrase, you have to put it in the answer. You have to put that in auditor's professional judgment, it is sufficient important to merit attention of TCWG and management. And with this is what this summary portion is something to not so important, but a foundation level where you have to compulsorily revise it one day before the examination to write your answers better for a better understanding. These are the things that you already know, but giving a just brushing up so that you could write it better. And first, we'll dive into SA 265 now. Auditor shall communicate with TCWG in writing on a timely basis. Okay, what are the things how he shall communicate with TCWG and management? All the significant deficiencies in internal control. What are significant deficiencies? That as per auditor's judgment, they were sufficiently important to give the attention of TCWG or management. What are significant deficiencies here? Significant deficiencies are that are leading to material misstatement in financial statements. These deficiencies in the internal control lead to material misstatements. Not misstatement, it is material misstatement. It is significant deficiencies which lead to material misstatement, not general misstatement. This doesn't apply to normal exceptions in the internal control or not few deficiencies which lead to misstatement. It leads to material misstatement. We have to make a note out of it. Suspectability of a loss of fraud which is related to asset or liability, which leads to any loss of fraud. Subjectivity. You see, auditor and management has to be objective. They should not show any kind of bias. So if they are showing any bias like subjectivity and complexity in accounting estimates, such as fair value accounting estimates, this also leads to a significant deficiency. Volume of activity that are occurred or could occur in the account balance or class of transactions exposed to a deficiency or deficiencies. You see, any kind of volumes of activities or transactions that were happening in such accounting balance. You see, internal controls also exist with a class of transaction. Like there were few internal controls with regards to sales and few with regards to collection from debtors. Like those particular account balance, if the volume of depends upon the volume of the activity, that could have a deficiency of that with regards to that internal controls relating to that class of or account balance transactions. And significant transactions which are in which management is financially interested and not being appropriately scrutinized by TCWG. These were unusual transactions or transaction in which management was financially interested. You see, when we discuss about the hierarchy of the company, first comes the employees and then management, and above management TCWG. All the transactions or that entered by the management has to be reviewed by TCWG or audit committee if applicable to that company. They were not properly scrutinized by TCWG. So this is a significant deficiency in the internal control system. And identification of management fraud. Is management is doing fraud. Here we have found suspectability of any kind of fraud. here the management is doing fraud here. Absence of risk assessment process within the entity. Design, implement, and maintenance of internal controls has to be done by the management, but the management itself is not doing any kind of risk assessment process with regards to that internal controls it is being implemented. There exists a significant deficiency. That is, the control here is absent here. And here is a management fraud and fraud or loss with regards to any asset or liability, and any deficiencies that could lead to a material misstatement or complexity of transactions in the accounting estimates, and the transactions that were entered by the management were not scrutinized by TCWG, and there's a volume of activity that occurred in accounting balance expected to be deficient. These were all the significant deficiencies which auditor has to communicate. And what he has to communicate along with that when he found that significant deficiency. This is what all is identification of significant deficiencies. Now, after identification, what he has to do? He has to communicate with the TCWG. What he has to communicate? He has to communicate the description of deficiencies and explanation of their potential effects. As we have discussed in our keyword kit 2, I think we have discussed how to communicate, what all the things we have to communicate. An outline has been given there, right? The same was applied here. You see, these were not something of my own. These were all by ICA. But what did I try to do is that to figure out a common outline so that we could read less and retain long for a longer period of time and retrieve the answers fast in the examination. You see how long we prepare or how much we study. ICA only tests how much we analyze the question and how well we could write the answer. If you read it in an outline basis, it is very easy to fit all the information into that outline, and you could write it so simple, and you could write or infuse all the keywords that ICA is wanting you to write. So that's what we are also doing here. Significant deficiencies. After that, what he has to communicate? He has to describe that and its potential effects on the financial statement. Why he has to mention the potential effects? Why auditor has went to the entity to audit the financial statement? So he has to also give the explanation why, what are the potential effects that the financial statements were facing due to these internal control deficiencies, and sufficient information to enable TCWG management to understand the context of communication. There might be a few. This is mostly useful when in a situation where the management asks the auditor, why are you so concerned with the deficiencies in the internal auditor? For that, this is what the answer for that. The purpose of the audit. What is the purpose of the audit? Purpose of the audit is to audit the financial statements to form an opinion on that they were materially free from any kind of misstatements or error or any kind of fraud. That's what the purpose of audit we have to communicate. And audit included considerations. It also includes the internal controls. Audit has to be done as per SCs. Under SA 315 here, it also has included internal controls with regards to maintenance of preparation of financial statements. So we have to also tell that auditor include consideration of internal control relevant to preparation of financial statement in order to design audit procedures. If the internal controls were satisfied, we could do prepare audit procedures to that level. If they were not satisfactory and there exists a risk of material misstatement, then we have to put some extra effort, some other extra audit procedures in order to obtain sufficient and appropriate audit evidence. So we have to also give our justification with regards to that, and matters being reported are limited to those deficiencies that auditor has identified during the audit and that auditor has concluded are sufficient to report to TCWG. Auditor has to report all the deficiencies in the audit that he's doing, right? And the auditor has to conclude they are sufficient to report to TCW. He, with his professional judgment, has to conclude whether these deficiencies or all the matters that he found were sufficient to report the TCWG. And what all the other information for further consideration were about the management's understanding of actual or suspected causes of deficiencies and a preliminary indication from management of its response to the findings. You see, again, we have to discuss about the management's responsibility regarding internal control. They have to design, implement, and maintain that. While doing that, while maintaining, whether they have any preliminary indication of that findings or response to that findings, and management's understanding of that deficiencies of actual or suspected cause or the parties who are overriding such controls, and exceptions arising from deficiencies that management may have noted. What are these exceptions? These exceptions were not significant enough. They were not significant that would uh, bring attention or merit the attention of TCWG, but there exists some kind of a deviation from the internal control, how it has to be worked. And these all the three things also have to be checked by the or taken into consideration by the auditor while communicating the deficiencies. What management's understanding of actual or suspected causes of deficiencies, all the exceptions or preliminary indication from management of its response to that findings. That is how the management is responding to that after we communicate. And we have discussed the significant deficiencies, and the last part is the factors that auditor may consider in determining appropriate level of detail for the communication. These are the things he has to communicate. Till what extent he have to communicate depends upon this. Depends upon the nature of the entity, size and complexity of the entity, nature of the significant deficiencies. This is the subject matter here. Nature of the significant deficiencies and nature of the entity were two things we have to discuss about. And the size and complexity of the entity is something usually we get it every time when we find similar kind of point like this. And entity's governance composition. What is governance composition? Whether there exists any TCWG or there exists any kind of audit committee in between, etc. Like that. Depending upon the management TCWG audit committee governance hierarchy to whom they have to report what all the deficiencies they found in the internal control system, and legal and regulatory requirements, which is a gray area, which we always write with regards to any kind of, if we found any kind of word that is fraud, we'll write legal and regulatory requirements. And with that said, we have completed SA 265, SA 299, this joint audit of financial statements. First of all, usually we'll go to the objective session where we could get a brief overview or outline of the standard, what it is talking about. The objectives of this standard are to lay down broad principles for the joint auditors conducting the joint audit. Who are joint auditors? When two or more audit firms are working for a single entity or a single set of financial statements, those were joint auditors. And in such an engagement, it is known as a joint audit. What is the standard? The standards tells about some few principles how the auditors have to conduct the joint audit and to provide a uniform approach to the process of joint audit. For various engagements, a uniform approach has been designed by the standard to identify the distinct areas of work and coverage thereof by each joint audit. It is distinct is something but separation of work, individual work, allotting the work to each joint auditor. That is, we have to identify that distinct areas of work. To identify individual responsibility, as we have segregated work here, for that segregated work each joint auditor has individual responsibility, and for the unsegregated or common work, undivided work, the joint responsibility shall be also put in place. We have to identify that responsibilities also, and that joint responsibility is joint and several. And we'll move on to the next call out here. The joint auditor are required to issue common audit report. Why auditors? Why we went to entity? We went to entity to form an opinion on the financial statements and give a audit report. So how that audit report should be? That audit report should be common. One financial statement, one audit report. Even though how many auditors does the work, so they should give a common audit report. However, if they have any disagreement in the opinion, they could issue a separate audit report. But while issuing separate audit report, what they have to do? They have to make a reference to other audit reports. That is, audit reports that were given by other joint auditors we have to make a reference of it. And the joint auditor is not bound by the views of the majority of the joint auditor regarding the opinion or matters to be covered in the audit report, and shall express opinion formed by said joint auditor. Here, you see, we are not a bunch of judges to follow the views of the majority. Each auditor has his opinion. If he wanted to give separate audit report, he could give that. And each joint auditor is responsible for reviewing the audit reports or returns of divisions or branches allocated to them and ensuring that they are properly incorporated into entities accounts. That is, we have discussed here, right? They have distinct areas of work. They have separately given the divisions of branches for each joint auditor or joint auditor. What do they have to do? They are responsible for such divisions of branches that were allocated to them. But if they were not allocated, if any kind of branches or divisions that were not assigned to any joint auditor, what do they have to do? They have to agree among themselves on such a division for reviewing those branch audit reports or returns. And with that as foundation, we'll move on to the CA 299 standard. The joint auditor shall jointly establish. What do they have to jointly establish? First thing, as with our foundation, what we have learned? They have to issue a joint audit report. And for that, they have to have overall audit strategy. They have to jointly establish overall audit strategy, one financial statement, one audit report, one audit strategy. Discuss on develop a joint audit plan, one audit strategy, one audit plan. Identify division of audit areas and common audit areas. This was the objective of the standard. Ascertain the reporting objectives. You have to ascertain the reporting objectives, how the report has to be given. The factors that significant in directing the engagement team efforts, why all the preliminary activities or assessment of risk of any kind of material misstatement that was done before the conducting of an audit, understanding the business environment and all. Why do we do that? The benefits of audit plan is to direct the engagement team efforts and to uh, give more attention to the significant matters. This is something that you could easily write whenever you find an audit plan here. Consider the results of preliminary engagement, nature, timing, and extent of resources. Obtain common engagement letter and common management representation letter. You see, how could we remember all this? First thing, by the auditor had got, you have to jointly establish what? Audit strategy, audit plan. And then with that audit plan, what you have to do? You have to, what's the benefit of an audit plan? The factors that are significant to direct the engagement team's effort, and that's it with regards to that. And identifying and dividing the common audit areas and separate audit area division, that was in the standard 4 points over there. And the fifth one is why the auditor had went to give an audit report. For that, you have to ascertain the reporting objectives, and you have to do some preliminary engagement activities prior start of audit. And common engagement letter, that was on common management representation letters. This was during the course of the audit that we take management representation letter or written representations from management. And this engagement letter is something, an agreement to do the audit. This is what shall be established jointly by the joint auditors. And joint auditors shall be jointly and severally responsible for. Here what they said, they have to identify individual responsibility and joint responsibility. What are those? What are those joint responsibility? What are situations or what are the circumstances that joint auditors are jointly and severally responsible for the work that was undivided? Is audit work? If the work is divided, they have individual responsibility. If the work is undivided, they have jointly and severally responsible. And decision that taken by all joint auditors, and matters which are brought to notice by the joint auditors by any one of them. Like, as the audit or work has been divided, if they found any significant matter or a fraud or a deviation, that has to be communicated to the other joint auditors as well. All those matters that were communicated. Here, when the work was undivided and when decisions were taken by all, and when the work was divided, but the matters were discussed to the other joint auditors. All the three scenarios, jointly and severally responsible. And examining that financial statements of entity comply with requirements of relevant statute. As we said, one financial statements, they were jointly and severally responsible because financial statements only one, audit strategy one, audit plan one. For all the one things, they are jointly and severally responsible. About regarding financial statements, requirements with relevant laws or rules and regulation or statutes, and presentation of those financial statements, and the audit reports. Even audit report is one, so they are jointly and severally responsible. And these three, when audit work is not divided, decisions taken by all, but when audit work is divided here, but the matters were discussed with other joint auditors, jointly and severally responsible. Here, financial statements, requirements with relevant statutes, presentation and disclosure of financial statements, and audit report, compliance with relevant statutes, jointly and severally responsible. And joint auditor is entitled to assume that what are the presumptions of joint auditor? other joint auditors have carried out their part of audit work and the work has been actually performed as per standards on auditing. What's the responsibility of the auditor? The responsibility of the auditor is to do the audit as per standards on auditing. You see, a joint auditor has gone to audit the financial statements of the entity, but not to review the work of other joint auditors. For that, peer review is there. So we have to assume that the other auditor is doing his audit as per standards on account auditing, and the financial statement of a division, branch are audited by one joint auditor. That's what we have discussed here, right? When they were divided the branch or allocated to them, they have to they are individual responsibility for review that. So whenever there's an individual responsibility with regards to division or branch, what you have to think that all the financial statements that they have audited for that division or branch allocated to other auditors comply with legal and regulatory requirements and present a true and fair view. We have to think that is, we are not assuming that some error had happened in the financial statements of the other auditors audit, other auditors in what they have audited, and the other auditors have brought to said joint auditors notice any departure from applicable financial reporting framework. You see, here we have discussed that the matters which were brought to the notice of joint auditors by one of them shall be jointly and severally liable. That is, whenever an auditor find any kind of deviation, they will communicate with the other joint auditors. He have to presume that all the deviations, all the significant matters were discussed and no matter that was left behind. So this is what they're talking about. The other joint auditors have brought to said joint auditors notice all the departures from the applicable financial reporting framework. And with that said, what are the presumptions? That the other had done the work as per standards on accounting and all the financial statements that were audited or allocated by other joint auditors were true and fair, and all the joint auditors have brought to said joint auditors notice any departure from AFRF. I'm going to discuss about SA 300, planning and audit of financial statements. As we always do, first we'll see the objectives of the auditor under the standard. The objective of the auditor is to plan the audit so that it will be performed in an effective manner. That is, effective means getting the desired result, getting what we wanted. Auditor shall update and change the overall audit strategy and audit plan as necessary during the course of the audit. When we do audit strategy and audit plan prior to starting of the audit, but even during the audit, if they have to update with having of new information or sufficient appropriate audit evidence, so that it would demand the audit strategy and audit plan some changes, you have to update that, and even the audit procedures with regards to that audit plan. Planning is not a discrete phase. It is not at the discretion of the auditor or the management or with the engagement letter. It is a continual and iterative process. It's a continual process. Iterative process is like repetition, repeating the work that was already done or repeating the work several times. That is what they're talking about, updating of the overall audit strategy and audit plan. In other words, the overall audit strategy and audit plan remain the auditor's responsibility. It is the responsibility of the auditor. It's not a discretionary phase. It is not the discretionary or the auditor phase. Now, with that said, we'll move on to SA 300 series with regards to preliminary engagement activities as per SA 210 and 220. SA 210 is agreeing to the terms of audit engagement. SA 220 is quality control for an audit of financial statement. You have to write what all things you remember in SA 210 and 220. You need not read it from here. You see, the performing the audit or performing procedures required by SA 220. What are those? Evaluating compliance with ethical requirements like independence, etc. And we have, remember, whatever you think or you could write with regards to SA 220 with all the quality control procedures, but that has to be followed during the audit of a financial statement, and establishing an understanding of terms of engagement with regards to SA 210, like communicating with predecessor auditor, etc. And in establishing the overall audit strategy, what the auditor has to do. What is his objectives? He has to form overall audit strategy and audit plan. While establishing audit strategy, what he has to do? He has to identify the characteristics of the engagement that defines the scope. what he has to check? We have to identify the scope of the engagement and why the auditor had went to the entity to form an opinion on the financial statements and give an audit report. So he has to ascertain the reporting objectives also and the factors that significant in directing the engagement team efforts. While doing the overall audit strategy, what he could do, he has to find out the factors that could direct the engagement team efforts, like significant matters, etc., like complexity of the transactions. All these factors were identified to direct the engagement team efforts. Consider the results of preliminary engagement activities. Preliminary engagement activities were all the 200 series activities, like agreeing to the terms and communicating to predecessor auditor or checking the quality control procedures, etc. Ascertain the nature, timing, and extent of the resources. Resources is a personal or auditor expert or use of the work of internal auditor, any kind of things that the auditor uses. For the software also, obtain sufficient and appropriate audit evidence regarding opening balances. In the overall audit strategy, what he has to do, auditor, he has to obtain sufficient and appropriate audit evidence with regards to opening balances also. What he has to do, identify scope and reporting of certain reporting objectives and factors that significant in directing the engagement team's effort, like a risk of material misstatement or complexity or a lack of internal controls, efficiency in the internal controls. These are the factors they're talking about, and results of preliminary engagement activities, nature, timing, extent of resources, and sufficient and appropriate audit evidence with regards to opening balance. And what's the second duty he has with regards to SS 300 is to develop an audit plan. What he has to do, the nature, timing, extent of planned risk assessment procedures as per SA 315. SA 315 is you have to identify and assess the risk of material misstatements through understanding the entity and its environment. What you have to do, you have to know till what extent the risk assessment procedures or planned risk assessment procedures have to be done. What does audit plan consist of? Audit plan consists of audit procedures. That's it. And the nature, timing, extent of planned further audit procedures. They're asking about planned risk assessment procedures and planned further audit procedures. When we use further audit procedures, when we find any kind of information which regards some extra effort to obtain sufficient and appropriate audit evidence, which cannot be achieved through planned risk assessment procedures and other planned audit procedures which do not have a risk there, risk of material misstatement. They were normal audit procedures that have to be followed. These are all the three kinds of audit procedures that have to be followed while developing an audit plan. And what the documentation, what the auditor has to document as per SA 300, what all the things he had done has to be documented. What he had done overall audit strategy, he did audit plan, and he had done also some changes to that overall audit strategy or audit plan, like updating and being a continued iterative process. So he has to document that overall audit strategy, audit plan, any kind of significant changes in that audit strategy or audit plan. And why we have to do audit strategy or overall audit strategy or audit plan? What are the benefits for that? How it helps the auditor? It helps the auditor to devote appropriate attention to important areas. Yes, with the factors that he had determined to direct the engagement team efforts, he could find what all the areas, all the important areas to devote attention. That's one thing. And second thing, identify and resolve potential problems on a timely basis. You see, you have to make changes and update the overall audit strategy, audit plan. What is overall audit strategy or audit plan? Audit plan consists of audit procedures. Why audit procedures? To solve, resolve, or put some remedial actions to remedial actions for all the problems that he had found on a timely basis. He has to update whenever he finds a need for that. And properly organize and manage the audit engagement performed in an effective and efficient manner. Effective is achieving the desired result. Efficient is economical, being economical. And how long the audit team or has to be worked, or whether we have to use any kind of internal auditors, or we could have to go for external legal opinion or auditors expert. We have to also check could organize or manage that engagement, audit engagement, and assisting in selection of engagement team members depending upon their qualifications and competence, and coordination of work performed by the auditors, and direct and supervision of engagement team members' work and review their work. This is done mostly by the engagement partner. These are all the benefits, like devote attention to important areas, resolve problems on timely basis, organize, manage audit engagement in effective and efficient. This with regards to that engagement, and all the three here were with regards to the engagement team members, like selection of engagement team members, coordination of the work they have done, and direct supervision of the engagement team members and reviewing their work. And with that said, we have completed our Essay 300 series. Today we are going to discuss Essay 315, identifying and assessing the risk of material misstatements through understanding the entity and its environment. As we always do, first we'll go and see the objectives of the auditor with regards to this Essay 315. The objective of the auditor is to identify and assess the risk of material misstatement, whether due to fraud or error, at financial statement and assertion level, through understanding the entity and its environment. You see, it's all of a title of Essay 315. It's also discussing that the objective of the auditor is to do what was said in the title. It is to identify and assess the risk of material misstatement due to fraud or error. They're asking the reason, whether that reason would be a fraud or it would be an error at financial statement level and assertion levels. Financial statement level is where such risk of material misstatement influences more than two or influences a large kind of class of transactions or account balances disclosures as a whole, like it influences a lot of them. Assertion level is where that risk of material misstatement influences only a particular class of transactions or a particular account balance or a particular disclosure. And through understanding the entity and its environment, including the entity's internal control, you also have to obtain understanding about entity's internal control, thereby providing basis for designing and implementing responses to the assessed risk of material mistake. What is our golden rule? Our golden rule is whenever we find any deficiency, risk, or fraud, what he has to do, auditor has to put some remedial measures by responding them appropriately. They are also saying the same thing here. He has to respond for the assessed risk of material misstatement. This will help the auditor to reduce the risk of material misstatement to an acceptably low level. This is what the benefit for assessing the risk of material misstatement, so that the auditor could respond to them and implement those audit procedures and perform those audit procedures so that that risk would be reduced to an acceptably low level. And these were few definitions, and this is not so important also, just revise it once, one day before the examination, and that's it. That's it. We'll move on to Essay 315. Yeah. The auditor shall document. What the auditor should document, what all the things he had done, he should document that. Under Essay 315, what is he doing? He's identifying the risk of material misstatement. He's identifying and assessing that. Or he has to document the identified and assessed risk of material misstatement at financial statement and assertion level. What we have seen in our objective, financial statement level, assertion level. And he has to understand the entity and its environment. So what he has to document? The risks that were identified relating to the controls about which auditor has obtained an understanding. He has to also understand the entity's internal controls, right? Without a risk he had identified in the internal controls, he has to document that. And he also the key elements of understanding obtained regarding each of the aspects of entity, its environment, and the risk assessment procedures performed. What else he has to document? He has to document the key elements that he had found while understanding the entity and its environment. He has to find, okay, after all this, what all the things he has to do when he find any kind of a risk of material misstatement during the planning, while planning the audit, he has to discuss with his engagement team to plan and perform the audit effectively with desired audit procedures, etc. So, what do he also has to document? The discussion among the engagement team and significant decisions reached. He has to document all the four things. Assess the risk of material misstatement and the risk with regards to internal control and key elements of understanding the entity and its environment, and discussions of engagement team and decisions reached. Risk assessment procedures and related activities. What we have discussed? We have discussed that auditor has to assess the risk, identify and assess the risk. when he has to do that, while he has to do only prior to the audit, or while planning the audit, or during the audit, or after completion of audit, he has to do at 2 stages. That is, while planning the audit and while during the audit also. And after the audit, that comes under subsequent events. Prior to audit, it comes under SA 200 series, like preliminary activities. For this 300, it is while during the audit and during the audit plan, deals with SA 300 series, whole 300 series. So, obtaining an understanding of entity and its environment, including entity's internal control, is a continuous dynamic process, updating and analyzing information throughout the audit. All the risk assessment procedure, he has to assess the risk and change the overall audit strategy or the audit plan or the audit program with regards to the risk that he had found during the audit. So it's always a dynamic procedure. Auditor plans the audit and exercises professional judgment throughout the audit. On what are areas he applies professional judgment, and how does he plan? First thing, assessing the risk of material misstatement of the financial statements. See, what's the objective of the SA 315? It is to assess the risk of material misstatement. Where were those risk of material misstatement content? Were the misstatement contents in financial statements? Okay. And second thing is, why the auditor went for an entity to audit the financial statements, right? While doing the financial statements, what he has to check? Financial statements were prepared by management through their applicable financial reporting framework, which consists of accounting policies and accounting applications, estimates, right? He has to also consider the appropriateness of selection and application of accounting policies and adequacy of the financial statement disclosures. Where has to check that? We has to check that because he went to audit the financial statements only. And while doing the audit of financial statement was the main duty of the auditor to obtain sufficient and appropriate audit evidence. While evaluating the sufficient and appropriate appropriateness of the audit evidence obtained. And he has to respond to the assessed risk of material misstatements with regards to this SA 315. And he has to determine when there were risks and obtaining audit evidence, he could use the audit sampling or etc. Right? Then at that situation, he has to also determine the materiality as per SA 320. As they had find some significant areas where the risk of material misstatements could occur, you have to identify that areas where special audit consideration is necessary. So while doing all these things, while planning audit, these were all the things that required for the auditor to plan the audit, or to frame an audit plan, where in that procedure he has to use some professional judgment with regards to that. What are all the things with regards to SA 315? Assessing the risk of material misstatement with the fraud, and identifying the areas where special audit consideration is required, and responding to the assessed risk of material misstatement. These were with regards to or specially customized for SA 315. But in general, why auditor had went to audit financial statement? You have to check the appropriation and selection of accounting policies and evaluate the sufficiency and appropriateness of audit evidence obtained. And after that, when there were risks and the financial statements audit evidence, what you have to do? You have to do audit something. For that, you need to determine materiality also. SA 315 materiality will be discussed in SA 320. That's tomorrow. We'll discuss that. Information obtained as audit evidence to support assessment of risk of material misstatement. That the auditor had got some information that emphasize more that the risk of material misstatement exists. Then what he has to do? He has to obtain audit evidence about such class of transactions or account balance or disclosures and the related assertions, and about the operating effectiveness of the controls. Controls here was internal controls, even though such procedures were not specifically planned as substantive procedures or tests of control. They're talking about that he had got some new information with regards to some risk of material misstatements, while he has to dynamically enhance the audit procedures or put some extra efforts and plan further audit procedures, even though they were not planned as per audit plan. So he could change those things. As we have discussed that auditor has to obtain sufficient and appropriate audit evidence. How can auditor obtain sufficient and appropriate audit evidence? Through inquiries or observation or inspection of any kind of documents, reperformance, recalculations, etc. Right? Now the auditor is doing inquiries within the entity and to whom he is inquiring and for what information he is inquiring. We'll just discuss that. Inquiries directed towards TCWG may help the auditor understand the environment in which financial statements were prepared. This is where even it's the objective of the auditor under 315 also, right? With to understand the business entity environment. As we have gone to audit the financial statements, they have said that in which financial statements were prepared, and that's it. And after that, below TCWG, what do we have? We have inquiries directed towards internal audit personnel. We have to gain more information with regards to internal audit procedures that were performed, whether we could use the work of the internal audit, or we get in information whether how we rely on the internal audit reports, etc. And inquiries of employees involved in initiation, processing, and recording complex or unusual transactions. This is with regards to the financial statements, right? Financial statements. Inquiries directed towards in-house legal counsel in order to obtain more information with regards to any kind of litigations, compliances with laws and regulations, and knowledge of fraud, and directed towards marketing and sales personnel with regards to marketing strategies, sales trend, or contractual arrangements. Why has to inquire this thing? Inquire marketing and sales personnel is to obtain an understanding that this entity is going concern, to evaluate the going concern of this entity. TCWG with regards to the business environment in which financial statements were prepared. After that, internal personnel with regards to internal audit procedures, and with regards to unusual transaction has to inquire employees, and in-house legal counsel with regards to any kind of litigations of knowledge of fraud and non-compliance of any kind of laws or regulations, and inquire towards the marketing and sales personnel with regards to sales trends and contractual arrangements in order to obtain understanding of going concern concept. And analytical procedures. Analytical procedures perform, you see, what are analytical procedures is, into tell it as in short, that is comparison of financial and non-financial information, like comparison of salaries to the number of employees and rent to the square feet that was rented or got leased. Why this is because to find a range of, you see, average range was there for every kind of industry all the entities were in, right? To evaluate whether this entity is having the expenses or the profit margins were within the range or not, or there were any kind of unusual transactions or fictitious expenditure or window dressing had happened or not. And with that said, we'll just move on. What are the analytical procedures here? Analytical procedures as risk assessment procedures may include both financial and non-financial information. Okay, analytical procedures are talking it as an audit procedure now, which includes both financial and non-financial information. And the analytical procedures may help. They're talking about the benefits of analytical procedures, why we have to do. To identify the existence of unusual transactions or events, that amounts, ratios, and trends that might indicate that they have audit implications. They are talking about to identify any kind of unusual transactions or events, like the transactions were not of an arm's length price, etc. That what we see in our international taxation DT if you're a final student. They're talking about like that. And when analytical procedures use data aggregated at a high level, the results of those analytical procedures only provide a broad initial indication about whether a misstatement may exist or not. It is like we are doing ratios within a range, right? Then when there were ratios were unusual or they were too high or too low, we would get a doubt on that, right? And that is not a particular misstatement, or that doesn't signify that, but it helps to direct the engagement team's efforts with regards to that there exists some unusuality in that class of transactions or that account balance. So it just gives a broad initial indication. That's just an indication that there could exist a material misstatement. Information obtained in prior periods. With regards to information obtained in prior, how does this information obtained in our prior periods, that auditor's prior period or entity's prior period, would help the auditor in this current period? The auditor's previous experience with the entity, that this auditor, this entity, and audit procedures performed in previous audit may provide the auditor with information about such matters as the first thing they're asking about, the combination had repeated. Now there's a combination that was changed here, that this auditor had audited some other entity and this entity's previous year auditor was somebody else. In all the situations, what are the previous prior period information that could be help the auditor in audit of this current year, this entity, about the past misstatements, the past misstatements that the entity had done, or the past misstatements that auditor has experience with other entity. That one. And the nature of entity and its environment and entity's internal control, including deficiencies of internal control, would help the auditor with regards to that. But it depends upon the nature of the entity, whether it's a hospital or whether it's a hospitality industry, whether it's steel business or oil exploration business, and its environment, that environment, all the laws and regulations that the entity has to follow, and the internal controls and the deficiencies of the internal controls that were identified in the previous year or were made in the previous year, and the significant changes that the entity or its operations may have undergone. That is, last year they had few kinds of operations or a few changes or within the entity's internal controls or its environment. Then it's the playoff period financial period, which may assist the auditor in gaining sufficient understanding of the entity to identify and assess the risk of material misstatement. Since there were this time, there were few changes in the entity for this current period. From nowhere, he need not understand the entity. He could compare with the previous year's operations or internal controls, and he could just use them and apply with the changes that had happened in this current year. These are all the things, information that would help the auditor in audit of this current period in this entity with regards to the information that he had found or obtained in the previous periods of the entity or the auditor himself, or the misstatements with regards to misstatements and nature and entity's internal controls and such changes in the operations that the entity has undergone. As we have been said, that the auditor has to obtain understanding of about entities and its environment. What does business entity and its environment consist of? Relevant industry factors, including industry conditions such as competitive environment, supplier and customer relationships, and technological developments. As we know, we have to understand about the industry conditions, but why competitive environment? Competitive environment is because of its to evaluate the going concern, and with regards to customer and supplier relationships and technological development, and with regards to the relevant regulatory factors, including its regulatory environment. While inquiring the internal legal counsel, we have asked about the legal regulations and compliance of laws, right? So the regulatory environment also has to be checked. An understanding of nature of entities enables the auditor to understand such matters as whether the entity has, while understanding the entity and entity environment. What is the entity and entity environment here? The competitive environment, supplier customer relationships, and technological developments have the regulatory environment. These are the things you have to obtain understanding. And while understanding that, he should also understand whether the entity has a complex structure or not. A complex structure is like whether it has investments in various companies and it had branches in all over the globe, and with regards to the subsidiaries and ownerships with regards to that, and ownerships and relationships with related party transactions or etc., any kind of relationships and ownerships, and in business operations, that the foreign business operations that were they having, or investment activities and financing activities. Operations, investment, and financing. Have you got any kind of vibes here like cash flow, right? Business operations, investment, and investment activities, financing, and financing activities. So it's easier to remember like that when you categorize or mix in with that cash flow statement. And why we have went for the audit? We have went to audit the financial statement. What the financial statement was prepared. The financial statement was prepared through accounting policies, and they have entity has a business and their objectives and strategies and their risk, right? And we have to also talk about obtain understanding about that, and measurement and review of financial performance. You need not remember these two, and we would tend to forget that, but all the above the things were something that we already know. We could easily understand and replicate it in our examination. As we have to obtain understanding with regards to the internal control, what are internal controls means? Internal control is designed, implemented, and maintained to address identified business risks that threaten the achievement of entities' objectives that concern This internal implementation, design implementation, maintenance was the responsibility of the management. Why they were implementing that? To identify the business risks that would threaten in achieving the objectives or hold back in achieving the entity's objectives. That were reliability of the entity's financial statements. When the internal controls were not designed, implemented, and maintained, they create a threat so that the financial reporting would be not reliable. The effectiveness and efficiency of the operations would get affected, and with regards to the compliance of applicable laws and regulations and safeguarding of assets. These are all the areas where we have to implement the internal controls so that to achieve our entity's objectives with regards to reliability in financial reporting and its operations effectiveness and efficiency. Effectiveness is where to get the desired output. Efficiencies to done on an economical way with a minimal effort or with minimal amount of money that was involved to get the desired output that we want to achieve in compliance with all the applicable laws and regulations and safeguarding assets. And internal controls can provide an entity with a reasonable assurance that about achieving entity's financial reporting objectives. It is even the preparation of financial statements was the responsibility of the management. So they have to implement internal controls that give a reasonable assurance in achieving financial reporting objectives, as financial statements have to be prepared as per applicable financial reporting framework. And even though why only reasonable assurance? Because why they cannot give full assurance or an absolute assurance? Because there exist some inherent limitations of internal control, like human judgment and decision making, which could make a fault or breakdown in internal control or any kind of human error or with human intervention. And that's why they're giving reasonable assurance here with regards to achieving entities' financial reporting objectives. Controls can be circumvented by collusion of two or more people or inappropriate management override of internal controls. How well the internal controls were designed, but when two or more people collide or management itself overrides those internal controls, there might be a collusion like breaking down of the internal control so that they do not operate effectively. That's what with regards to the internal controls in SA315. We'll see what all the components that internal control consists of. This again, or it could be asked, it was widely asked as a direct question. It's favorite, I say favorite question also. Control environment, entities risk assessment process, the information system including related business process relevant to financial reporting and communication, control activities and monitoring of controls. You see, whenever we think of internal controls, what do we think? We think about the control activities. That is, who were implementing that in operation, who were doing that internal controls. Okay, first that, and who were doing those internal controls, and who there should be someone who monitors the one they are doing. So, in control activities and those who monitor those controls, two things. And there should be someone who should frame those internal controls, all the rules and regulations on policies and procedures, right? Here is a control environment. This is mostly done by the top level management, at least that has to be done. The entity's risk assessment process. There also should be a risk assessment process. This is mostly done by the management who evaluate assess the risk that the internal controls do not achieve the entity's objectives. Management has to assess the risk of that process and all the information system, including all the process. And that thing is that they have formed the policies and procedures, but there should be a system so that the one who is doing the internal control activities has to know them, right? How to do them. For that information system, like a system to communicate with the people who are doing the internal control should be there. This is a cyclical process. First, we will design policies and procedures, and the management shall do assessments whether such policies and procedures could achieve the objectives of the entity or not. They have to assess the risk with regards to that, and that has to be all the policies and procedures that they have decided has to be communicated to whom? To the one who does the internal control activities, and who does they have to be all a monitor, like a manager who monitors the controls. That's it. It's very simple. You could remember and write it in your exam. Manual or automated elements in internal controls. Controls in a manual system may include such procedures like approval and reviews of transactions and reconciliation, follow-up, reconciling items. These all comes under Manual controls, manual internal controls. Controls in IT systems consist of combination of automated controls as well as manual controls. Manual controls for what? Approvals, reconciliation, follow-ups, that what humans do. Automated work IT uses to initiate, record, process, or report transactions or other financial data for inclusion in financial statements. The systems and programs may include controls relating to corresponding assertions for material accounts may be critical to be effective for functioning of manual controls that depend on IT. You see, all the approvals reconciling was done by manual. But what does IT do? IT initiate, record, process transactions or financial information which is used in financial statements which were critical in effective functioning of manual controls, because based upon those data we do analysis and take decisions as a management. So they're talking about the interrelationship between manual and automated controls and what are automated and manual controls, and that's it. And what's control environment? Control environment includes the governance and management functions and the attitudes, awareness, or actions of those charged with governance and management concerning the entity's internal control and their importance in the entity. You see, how the entity, the soul of the entity, how the management philosophy or the organization philosophy or values, code of conduct, these all comes under the control environment, all the policies and procedures. What are the elements of control environment? Like communication and enforcement of integrity and ethical values, commitment to competence, participation by ECWG, management philosophy, operating style, organization structure, assignment of authority and responsibility, human resource policy and practices. These are all the things that were elements of control environment. If you read it 2-3 times, you mostly write 60% of this answer. But the control environment in itself do not prevent or detect or correct a material misstatement. This was asked on 2 to 3 times in the MCQ booklet, which we have discussed there. Do check out the videos there. It may influence the auditor's evaluation of effectiveness of other controls and auditor's assessment of risk of material misstatement. You see, even control environment is a manual control, as we have mentioned here. The approvals or decisions that were very critical affect the manual controls, the approvals or the follow-ups or reconciliation, because it is widely dependent on IT. And here also they're talking that the control environment is a manual control which do not prevent, detect or correct material misstatement by itself, which widely affects the auditor's evaluation of effectiveness of controls and assessment of risk of material misstatement. Control environment affects the auditor's evaluation of internal controls and risk of material misstatement. They are talking about that. And what are the different types of potential misstatements? We have to assess what? Risk of material misstatement. What those misstatements? What are the categories of misstatements? Assertions about class of transactions or events for period under the audit. The occurrence, whether the transaction and the event has been recorded that have occurred or pertain to the entity. You see, whether the event or transaction had been occurred, about the completeness, whether all the transactions have recorded or not, with the accuracy with regards to the amounts and data that's recorded were accurate or not. And cutoff is where transactions have been recorded in the current accounting period. It is not including the next year finances, next year transactions in this current year only. It should not be that. There should be a proper cutoff also. And classification. Classification is regards to classifying under headings like standard, substandard with regards to banks and current, non-current, like that. Assertion about account balances at the period end. You see, events record, this is mostly with regards to the profit and loss account. This is with regards to the assertion in balance sheet. And these were with regards to the presentation and disclosure, and that's it. With regards to existence, what do balance sheet consists of? Balance sheet consists of assets and liabilities, whether they exist or not. And with regards to the ownership, the rights and obligations, the entity holds the control, or whether the entity has obligations to pay the liability or not. And with regards to complete, whether all the assets and liabilities have been completely recorded in the balance sheet or not. And with regards to the valuation and allocation of assets and liabilities equity, including in financial statements, were appropriate, and the allocation adjustments were appropriately recorded or not. With regards to P&L amount, what we have to choose? Occurrence of that event, completeness, accuracy, cutoff, and classification. Here we have to see the existence, Here they have occurred or not. Here they have existed or not. With regards to rights and obligations and completeness, as there were assets and liabilities, rights and obligations obviously should follow on. Completeness, here also completeness. And with regards to the valuation and allocation, we are here doing the accuracy. With regards to the amount within P&L account is accuracy or not. Here it's there were valuation and account allocation of assets and liabilities. And with here the cutoff and classification. And with regards to assertion about the presentation and disclosure, the occurrence and rights and obligations, or the disclosed events. This is presentation like notes to accounts or disclosures that were given below the financial statements about the occurrence of events or right and obligations of assets and liabilities. And completeness, obviously, classification and understandability. The financial information is appropriately presented and described, and disclosures were clearly expressed or not. And with regards to accuracy and valuation, the financial and other information were disclosed fairly at appropriate amounts or not. And with today we are going to discuss about SA 320, materiality in planning and performing the audit. As usual, first we'll dive into the objectives of the auditor with regards to SA 320. The objective of the auditor is to apply the concept of materiality appropriately in planning and performing the audit. The auditor has to first determine the materiality and then apply it in the audit. What is performance materiality? Performance materiality is something that is amount which is lesser than materiality amount. Why he's choosing performance materiality even when there was a materiality amount that was already determined? Because when we apply some materiality concept, few amounts do not come into the ambit of the materiality because of being lower or smaller in number. But all such misstatements which are not material as per the materiality concept but were put together, were in aggregate, would be exceeding the materiality. So in order to lesser that situations, in order to make that risk lower, auditor performs or determines the performance materiality. It's an amount which is set by auditor less than the materiality for financial statements as a whole, to reduce appropriately the low level of probability that aggregate of uncorrected or undetected misstatement exceed materiality for that financial statements as a whole. You see, materiality can be for financial statement as a whole, or for class of transactions, or a particular class of transaction, or a particular account balance, or a particular disclosure. But performance materiality was for a financial statement as a whole. And with that said, we'll dive into SA 320. What the auditor shall document. What does he do? He shall document. What is he doing? He's preparing the materiality and performance materiality. He has to document that only. Materiality for the financial statement as a whole. Materiality for a particular class of transactions, account balances, or disclosures. You see, materiality has to be for financial statement as a whole and for such particular class of transaction or account balance or disclosures. You can prepare the materiality amount for any of this kind. And performance materiality, financial statement as a whole, and any revision that was done to the materiality. And determining materiality. While determining materiality, what are all the considerations that the auditor has to consider? The elements of the financial statements, all the assets, liabilities, equity, revenue, and expenditure. Materiality is like a percentage on some amount, like for the stock, what's the materiality? A percentage on COGS, like 1%, 0.5% of the COGS that was sold. And for the debtors, for the bad debts, it could be like a 5% of the debtors. It's like that. Materiality would be determined like that. Whether there are any items on which attention of users, particular entities' financial statements tend to be focused on. You see, like litigations that were happened, even though the litigation amount, the expenses with regards to the non-compliance or with regards to payment of lawyers, though the amount was comparatively smaller with regards to other elements in the financial statement, they tend to signify or they tend to drag the attention of the users of the financial statement. So we have to also check the materiality, check all such items while determining the materiality and the nature of the entity. Whether it's a construction company or a real estate company, or it's a service-based entity, anything, you have to obtain the nature. You have to also consider the nature of the entity and its economic environment. and its operating cycle or life cycle. And the entity's ownership structure and way it is financed. Ownership structure is with regards to the associates or subsidiaries or investment companies or related party transactions, all this. And with regards to finance or the equity, the share capital that was invested or the long-term loans that have been taken also have to be taken into consideration, and the relative volatility of the benchmark. Benchmark is, as we have discussed for the bad debts, it's the debtors. Debtors is a such 5% of debtors is a benchmark. Like benchmark is with regards to the industry, usually in that entity that in which it is situated in that industry, there would be a common benchmarks for that, common ratios or percentages. When establishing the overall audit strategy, the auditor shall determine materiality for the financial statement as a whole. You see, this was asked in an MCQ also, but don't get mistaken with here and materiality. As materiality here is for the financial statement as a whole, and you also have to determine the materiality for a particular class of transaction. But with regards to while establishing overall audit strategy, that is when overall audit strategy was done at the planning stage of the audit, you don't get more into the financial statement, so that you determine the materiality for whole financial statement as a whole, not for that particular balance or particular account class of transactions. So make a note out of this. While establishing the overall audit strategy, materiality is only for the financial statement as a whole. While you do the audit in more detail, then you form materiality for that particular class of transactions or particular disclosures, etc. If one or more class of account disclosures for which misstatement of lesser amount than materiality for financial statement as a whole, auditor may determine materiality to be applied to those class accounts or disclosures. The auditor shall revise materiality for financial statement as a whole on becoming aware of information during the audit which caused the auditor to determine a different amount initially. That was, they're saying that it is as like overall audit strategy and overall audit program or audit plan, how they were dynamic and they could change with the information that was get by the auditor. Likewise, even the materiality could also be revised. And if auditor concludes lower materiality for financial statement as a whole, the auditor shall determine whether necessary to revise performance materiality and whether nature, timing, or extent of further audit procedures appropriate. Now, he got some information which revised the materiality. Now, lower the materiality. When the materiality was lowered by the auditor, at that time, he also have to check whether it's necessary to revise the performance materiality, because performance materiality is always lower to that of materiality. When that gap was not maintained adequate enough as to the previous materiality or the old materiality concept, it doesn't serve for the purpose, the performance materiality. So he has to check whether he has to revise the performance materiality or not. Discuss about SA 330, the auditor's response to assessed risk. First, will you see the objective of the auditor here? The objective of the auditor is to obtain sufficient and appropriate audit evidence about the assessed risk of material misstatement. When he had assessed the risk of material misstatement in SA 315. This is so much of link to SA 315. Do watch that video if you haven't, and then continue this 336. It would be more relevant for you. So what the auditor has to do? Auditor has to obtain sufficient and appropriate audit evidence for the assessed risk of material misstatement. How he could respond, how he could obtain the audit evidence with regards to that material misstatement through designing, implementing appropriate responses to those risks. And see, what is our golden rule? Whenever we've had any kind of deficiency, fraud, or irregularity in the entity, the auditor has to put some remedial actions, and before using that remedial actions, he has to respond to them and then follow up those remedial actions. And here are a few definitions with regards to that. Tests of controls and audit procedure designed to evaluate the operating effectiveness of controls. Here, the auditor is testing or evaluating the operating effectiveness of the internal controls in the entity, whether they were preventing, detecting, and correcting material misstatements at assertion level. SA 320 or 330 deals mostly at an assertion level. Everything is in detail because they have risk of material misstatement. So everything has to be on assertion level to that specified or customized to that particular class of transactions only, and not at a financial statement level in general. Substantive procedure. What a substantive procedure? An audit procedure designed to detect material misstatement at assertion level. You see, it is mostly like an investigative part, right? Investigative or detective part, where they are detecting at even assertion level. The substantive procedure comprises of tests of detail. Test of details were, they were checking, the auditor is checking each and every minute detail, even with regards to the journal entries also. He's using mostly reperformance or recalculation in order to obtain sufficient and appropriate audit evidence. And substantive analytical procedure. As we know, analytical procedures were like comparison of financial and non-financial information like salary to employees, rent to square feet, etc. With that, the basics, will move on to SA 330 here. What the auditor should do in SA 330. Have to design and perform further audit procedures. Why I had to do further audit procedures? Why not planned audit procedures? Even this was discussed in SA 315. I want to repeat it here now. You see, while planning the audit, he had planned some audit procedures, but during the course of the audit, he was finding some information which could result in some risk of material misstatement. So for that, in order to even audit such risk of material misstatements, he has to plan some further audit procedures in order to have more corroborative audit evidence and more sufficient and appropriate audit evidence. For that, since he is auditing the risk of material misstatement, and that risk, this risk, other normal matters were with planned audit procedures, it would be sufficient. But since there were areas of risk of material misstatement, he has to perform further audit procedures whose nature, timing, extent are based on responsive to assess risk of material misstatement at assertion level. Make a note here, this is the key word, that assertion level. You have to write assertion level only. Why? Because financial statement is of a general level. Here you are going in detail, testing each and every point which has so much of risk that was involved in. So you have to go in detail. So that's why you are putting an assertion level here. Assertion is for that particular class of transaction or for that particular account balance or that particular disclosure. And what the auditor should consider the reasons for assessment given to the risk of material misstatement at assertion level for each class, transaction, account balance, and disclosure, including what he has to do. Whenever he found any fraud or any irregularity, what he has to find? He has to find the source, the parties involved, and the reasons for such irregularity or deviation or deficiency. He has to consider the reasons for such misstatements at assertion level. Like what? Likelihood of misstatement. Likelihood of misstatement is if the auditor had found so much of manual intervention in an audit, like he has to figure out like what percentage, like what likelihood, like 70% of likelihood that the material misstatement could happen with regards to that assertion level due to that internal control. So he has to find that likelihood of misstatement, whether the second thing is whether the risk assessment takes into account the relevant controls or not. He has to also take the internal controls, relevant internal controls also. Obtain more persuasive audit evidence. Persuasive is almost all audit evidence that higher the auditor's assessment of risk. As the auditor's assessment of risk is higher, he has to obtain more persuasive. That is, he has to increase the quantity. He has to obtain almost all audit evidence. Deviations from controls. There were some deviations from the controls. You see, controls were established by the management, but while operating the controls, there were few deviations with regards to that control. Why such deviations? What the auditor has to respond, how the auditor has to respond. The auditor shall make specific inquiries to understand these matters and their potential consequences. The auditor had done the first step to do. What's the first step initially? He has to inquire the management and evaluate the controls. And then what he has to do? He has to determine whether the tests of control that have been performed. Tests of control were performed by whom? They were performed by the auditor. monitoring of controls were done by management. This was discussed in SA 315. That who put the controls, policies and procedures, and who operates that, who tests the policies and controls. This was all discussed in 315. This deviation is occurred through whom? The one who is operating the controls. And this tests of controls were done by the auditor while he's testing the controls and have been performed, provide an appropriate basis for reliance on the controls. Have to test the test of controls that have been performed, provide an appropriate basis for reliance on the controls. That he has to determine whether his test of controls, that his audit procedures provide an appropriate basis for that reliance on that controls or not, and he has to do additional tests of controls. Like, since we have got some risks here, we have done further audit process, right? Here also have to do additional tests of controls if necessary. If he found the degree of likelihood of misstatement was high, he has to do additional tests of controls also. And the potential risk of material misstatement need to be addressed using substantive procedures. What are substantive procedures for? Test of details on substantive analytical procedure. You have to address those risk of material misstatement with regards to that assertions, like with regards to the journal entries that it had done or the ratios. He has to address those misstatements. And substantive procedures alone cannot provide sufficient appropriate audit evidence at assertion level. Then the auditor performs tests of control. If the auditor feels that the substantive procedures were not giving sufficient and appropriate audit evidence, which is the objective of the auditor under SA 330 here, to obtain sufficient and appropriate audit evidence with regards to assess risk of material misstatement, then what he has to do, he has to perform tests of controls also. First, what he have to do, he has to, if there were any deviations in internal control, he will directly do tests of control. But when there were no such deviations there, what he has to do, he has to perform substantial procedures. What is that? Tests of details and substantive analytical procedures. If he cannot obtain sufficient and appropriate audit evidence, then he has to move on to tests of controls also. When the approach to a significant risk consists only substantive procedures, those procedures shall include tests of details. That is, we also know that substantive procedures include tests of details. Auditor shall document. What do auditor shall document? What all he has done, he has to document. What he had done. He had done some further audit procedures and he responded to the assessed risk of material misstatement, and he had done some tests of controls, etc. He has to document only that. The overall response to address the risk of material misstatement at financial statement level, and the nature of timing extent of further audit procedures, and the linkage of the procedures, that the further audit procedures at assertion level, and the result of audit procedures, including the conclusions where these were not otherwise clear. That is, conclusions were clear. And these are the things he has to document. And retesting of controls. Yes, retesting of controls will link it to the methods how he could obtain sufficient and appropriate audit evidence. He could do reperformance or recalculation of what? He could reperformance or recalculations of any kind of balances or any kind of calculations that were done by the management in financial statements. Now, he should also retest the controls. First, he has to do tests of controls. Where are those? He had to do tests of controls. But when the risk for that, when the deviation for that control was significant, he has to retest those controls. When to what controls he has to do retesting, that is, he has to do testing twice when there's a deficient control, when deficient monitoring of controls. Retesting is like at testing of controls at assertion level. First, what the auditor do? Auditor tests all controls at financial statement level. When there were any deviations or deficient control, he has to retest that control. Deficient monitoring of controls. We have discussed that in SA 315, that one who operates the controls and one who monitors the control were two different categories. So here, whenever there's a deficient in that categories, he has to retest the controls. Any significant manual intervention, he has to retest. Personnel changes that significantly affect the application of change. When there were manual intervention, significant manual intervention, and when the personnel changes also, he has to do retesting of controls. Changing circumstances that indicate need for change of changes in the control, that is any kind of events or that had happened or circumstances that indicate change for that control. And deficient general IT controls. These are all the things, these are all the case scenarios. If these qualifies for any internal controls, he has to do retesting of such controls. The length of time between retesting such controls is also a matter of professional judgment, but is required to be at least once in every 3 years. Once in at least 3 years, he has to retest the controls of these things. And with that said, we have completed our essay 330. Audit considerations relating to an entity using a service organization. What's it's called? It's in our daily term usage, it's known as using an outsourcing entity. It's outsourcing a process of its internal control system or a part of its internal control system. Why auditor is so concerned about these service organization is that since auditor has to audit and give some like a report on the internal controls or any kind of deficiencies in the internal controls with regards to financial statements and all. So he has to check the internal controls. For that, since a part of the internal controls are being outsourced to this service organization, auditor is also concerned about this internal controls in the service organization. This is the importance of the SA 402. And first we'll see the objective of the auditor with regards to SA 402. The objective of the user auditor. Who is user auditor? User auditor is an entity that user auditor, an auditor who audits and reports on the financial statement of a user entity. What is a user entity? An entity uses service organization service and whose financial statements are being audited. This user entity is the client, is a client of the auditor, is a company that we are going to audit. Yeah. So the user auditor is someone, that is we, who audits the user entity. When the user entity uses the service of service organization like BPO, etc., to obtain an understanding of the nature and significance of the services provided by service organization. That is what part of internal controls that are being outsourced to that service organization, obtaining understanding with regards to that services and their effect on user entities' internal controls. You see, these services are a part of internal control system, which would affect the internal controls in the user entity. That's the entity we are going to audit. Sufficient to identify and assess the risk of material misstatement. This is what comes with SA 315. It's an extension for SA 315 to identify and assess the risk of material misstatement. To design and perform audit procedures responsive to those risks. What is our golden rule? Whenever auditor finds any fraud or deficiency, irregularity, any risk, what he has to do? He has to respond to them and provide some remedial actions for those risks. So he is performing audit procedures in responsive to those risks. And who is service auditor? Service auditor is who audits that service organization. That is the third party from whom we are taking that service. The entity is taking some services, right? That organization auditor. Service organization is that third party organization. Complementary user entity controls. Complementary user entity controls were such controls. You see, the auditor, the client of the auditor, that the company user entity, say, is outsourcing some services or some part of internal controls to the service organization, and service organization is having that thought that the user entity also had some internal controls with regards to whether the services that are provided by the service organization were relevant to them or whether accurate to them or not. That is, it's expecting that the service organization is expecting that the company is having different controls. What company? User entity is having different controls to make sure that even if the control fails, that is, even if the control fails in the service organization, there are some other controls to protect their information or protect their kind of internal control system, etc. That is, these are controls in user entity that service organization is presuming. And this is the soul of the SA 402, type 1 report and type 2 report. This is so simple. We'll just see it here. Type 1 report is such report on description and design of controls at service organization. You see, This is a report given by whom? The service auditor, the service organization's auditor, the third party auditor. What he's describing the description and design of those controls in the service organization, the description of service organization systems controls and related controls that are designed and implemented, and a report by service auditor that includes service auditor's opinion, or service auditor report includes his opinion on description of service and the controls that were suitable for the design of controls to achieve the specified control. First, what type 1 report consists of? It consists of description and design, and it also consists of a report by the service auditor on his opinion on such description and design. Okay, what is type 2 report? Type 2 report it's a report on description design. That is, description and design was covered in type 1. Plus, operating effectiveness of controls at service organization. You see, description and design were like policies and procedures or rules and regulations or the structure of the environment that was created. Operating effectiveness is the maintenance. That is how well the internal control system that was designed or curated by the management, how well it is being operated by the employees or operating staff. What do it need to contain? A description of the services that were designed, implemented, and their operating effectiveness. Plus, what is second part? A report of service auditor, what? Describing the description, suitability of the designs of the controls and operating effectiveness. And since he's saying he's putting his opinion on the operating effectiveness, how he had done that, what audit procedures he have done, that audit procedures, that is tests of controls, that was used by the service auditor, were also given in this report. And with that said, these were type 1 and type 2 reports. Obtaining an understanding of the services provided by service organization, including internal control. We have seen this phrase somewhere in the objectives of the auditor here, right? Obtaining understanding of the services provided by service organization, right? What we have to know? We have to know the nature of services, nature and materiality of the transactions, and the degree of interaction between service organization and user entity, and the nature of relationship between user entity and service organization. You see, they have nature of services and nature of relationship between them, and they have nature and materiality of the transactions processed or accounts. That is, like if they have outsourced a payment, payroll expenditure, or any kind of traveling expenditure. If it's a traveling company, all the ticket bookings and all, the travel company, if it wants to concentrate only on its core activity of acquiring the tourists, etc., all the ticket booking and hotel management and all was outsourced to some other party, some other organization, service organization. Even that transactions and the interaction between SO and service organization and user entity, the degree of interaction. Nature of services and nature and material of the transactions and nature of relationship between them and the degree of interaction. See, when there should be a relationship, there obviously comes interaction, right? You have to make a note like that. And auditor plans to use type 1 or type 2 report as audit evidence. Why auditor had went for the entity? He went to give an auditor's opinion on the financial statements, including internal controls. For that, what he has to do? He has to obtain sufficient and appropriate audit evidence. That's all we know that. Now, in that sufficient and appropriate audit evidence, if he includes type 1 and type 2 report, which were including the description and design of controls, he has to evaluate that. What he has to do with those, what he has to evaluate, what are those in the type 1 and type 2 report, only he has to evaluate that. What does type 1 and type 2 control consist of? Description and design of the controls in the service organization. Have to do that. Evaluate the sufficiency and appropriateness of audit evidence. What we have discussed in our earlier videos. Whenever there's an audit evidence, if the auditor has to evaluate, he has to use the adjectives sufficiency and appropriateness of the audit evidence. We don't want any other like fluke of audit evidence. We want only sufficient and appropriate audit evidence. That's what needed to form an opinion. By the report, further understanding of user entities' internal controls were relevant to the audit. Determine whether complementary user entity controls identified by SO are relevant to UE. What we have discussed about complementary user entity controls, that SO has presumed that few controls were there also in the user entity to check the services made by the SO. That's what. Even such audit procedures or such internal controls were relevant or not, we have to check. Because what he's evaluating, he evaluating internal controls in the service organization. Now he is evaluating, he should determine whether those complementary user entity controls, that is, the controls in the user entity were relevant to UE or not, that were presumed by service organization. Evaluating whether the tests of control performed by service auditor are relevant. How he know whether, how could he evaluate in type 2 report? In type 2 report, what he have also provided, he also provided description of the tests of control in order to comment on operating effectiveness. So he also have to evaluate that. This is so simple answer. If you know what is type 1 and type 2, what all it consists of, you could write that. You could write that auditor has to evaluate this, that, and etc. These were all the things that were in type 1 and type 2 reports, and this is all specific for type 2 report. And this is something you have to remember, complementary user entity controls that were identified by SO, and the time period cover by the test of control and the time elapsed. Only thing you have to make an effort is with this and the time period. That's it. You were good to go with that. And this is the last portion here. Yeah. Type 1 and Type 2 reports that exclude services of sub-service organization. What is sub-service organization? As user entity is taking service organizations help or outsourcing work of to service organization, even service organization also outsourcing its services to another sub-service organization. You see, user entity is a traveling company. It outsourced the ticket booking to a service company. Now that service organization had outsourced all the Europe tickets, traveling tickets to another sub-service organization, or it had it had outsourced like hotel bookings or food, or like to train tickets, etc., to different kinds of sub-service organization. Then what the auditor has to do? If SO uses a sub-service organization, the service auditor's report may either include or exclude the sub-service organization relevant control objectives or not. You see, they are saying that if a service organization, if SO is using SSO's SSO services, it may include or exclude. There's no regulation with that. If it includes that, it is called inclusive method. If it excludes those, it is carve-out method. When if the type 1 and type 2 were using this carve-out method, that is excluding the SSO's internal control, the auditor has to evaluate with his professional judgment whether those were also required to apply the essays or not, relevant essays or not, depend upon the relevance of those control. And with that said, we have completed essay 402. Discuss about essay 450, evaluation of misstatements identified during audit. As always, we'll go and see the objectives of the auditor here. So first, the objective is the effect of identified misstatements on the audit. You see, all the misstatements that were identified under identified and assessed, all the misstatements under essay 315. Now what he has to do? He has to evaluate those identified misstatements. So what he has to evaluate? He has to evaluate the effect of that identified mistake and the effect of uncorrected misstatements, if any, on the financial statements. He has to evaluate the identified misstatements and the uncorrected misstatements, financial statements. The auditor shall also determine whether the overall audit strategy and audit plan needs to be revised. If whenever we identify any kind of material and identify any kind of material misstatements, or what we have to do, as such information was got by the auditor during the audit, what he has to do is he has to change accordingly the overall strategy and the audit plan, detailed audit plan, which was made prior to the starting of the audit, at the initial stage of audit, and revise the materiality also, and then do perform the relevant audit procedures that was with respect to the revised overall audit strategy and detailed audit plan. The auditor shall determine whether they have to be revised or not if the nature of the identified misstatements and the circumstances of their occurrence indicate that other misstatement may exist that could be material. You see, what we have identified misstatements and circumstances which indicate other misstatements. So we have to revise
the overall audit strategy and audit plan, and aggregate of those misstatements could accumulate together would be material. And prior to evaluating the effect of uncorrected misstatements, like here, this is the second objective, right? Evaluating effect of uncorrected misstatement, he has to reassess the materiality that was defined. And with that said, we'll dive into essay 450 here. The misstatements may result from: what is the reason for the misstatement? Inaccuracy in the data in which financial statements were prepared, omission of any amount of disclosure, or incorrect accounting statement from overlooking or clear misinterpretation of facts, and judgments of management concerning the accounting estimates were unreasonable. See, misstatements were happening in financial statements. What do financial statement contains? It contains some financial items with regards to them, journal entries and assets, liabilities, all the transactions and accounting estimates, and disclosures and notes to account. You see, all the data here was inaccurate. The financial statements used the data which was inaccurate. That's one thing. And omission of any kind of amount or disclosures. The second thing, this is with regards to the data. Inaccurate data, omission of data or disclosure. Second thing is accounting estimate. The accounting estimate was incorrect from overlooking or misinterpretation of facts. Anything, the reason, but the accounting estimate that was in the financial statement was incorrect. Inaccurate data, incorrect accounting estimate, omission of any amount or disclosure, and the judgments of management with regards to those accounting estimates were unreasonable. These were the four methods, like two with regards to accounting estimates and two with regards to data or amount that was disclosures in the financial statement. And clearly tribal. There was a small gap, a small difference between the clearly tribal and performance materiality. We often don't read as often as we read the performance materiality. So pay some more attention here. We'll discuss what is clearly tribal is. Matters that are clearly tribal will be smaller of magnitude than materiality. Even performance materiality is also of smaller magnitude. That's a smaller amount than of materiality. But what's the main difference? It's come here. Will be the matters that are clearly inconsequential, whether they have taken individually or in aggregate, whether judged by any criteria or size or nature. You see, they were no, they don't have significant amount, even they were aggregated together, but when they were aggregated, they were material, that there comes the performance materiality, that one. So these all the matters which are clearly travel. Performance materiality is a materiality amount that was smaller in magnitude, that should also be, if any matter that crosses this performance materiality have to be taken into account, because while aggregated, those could lead to a material misstatement. But clearly tribal were those material matters which, even though they were aggregated, those deviations do not lead to a material misstatement. And when there's any uncertainty about the clearly tribal, the matter is considered not to be clearly tribal. So what they are saying is there should not be any doubt with regards to the clearly tribal. If you have any doubt with whether it's a clearly tribal or not, do not consider it to be clearly tribal. Where clearly tribal is something, is a safer zone. Factual misstatements, judgmental misstatement, projected misstatement. We'll see all the three ones. Factual misstatements were those misstatements, no doubt they were misstatements only. Okay. In fact, they were misstatements. That is, judgmental misstatements were those misstatements where there's a disagreement between the management judgments that it's a misstatement or not, and auditor is not agreeing with that, whether it's a misstatement or not. There's a difference between those misstatements. That is, one party is saying it as a misstatement and another party is seeing it as a non-misstatement, not material misstatement. Those were judgmental misstatements. Differences arising from the judgments of the management concerning accounting estimate that the auditor considers unreasonable. You see, there was a difference between the management judgments and the auditor judgment with regards to accounting estimate. Projected misstatements are the auditor's best estimate of misstatements in populations. Projected misstatements were the auditor is estimating that these misstatements could happen in a population while doing samples while working on the samples that were drawn from the population. If he had got some one misstatement for the 20% of sample he had done, he is estimating that he's projecting that the whole population consists of 5. That is 1 into 20. If one misstatement for 20%, then for 100%, 5 misstatements. So he's projecting that misstatement. These is the difference between factual, judgmental, and projected misstatements. Now we have come to our last part here, effect of uncorrected misstatements. What we have, our objective is the effect of uncorrected misstatements. For all the uncorrected misstatements, what the auditor has to do, what he has to evaluate. Prior to the auditor's evaluation of the effect of uncorrected misstatement, it may be necessary to revise the materiality. That's what even we have seen here. Prior to evaluating the effect of uncorrected misstatement, the auditor shall reassess materiality. That's one thing. With respect to the uncorrected misstatement, the auditor shall determine whether uncorrected misstatements are material individually or not, individually aggregate or not. Whenever there were uncorrected misstatements, he has to check whether they were material or not. Whenever you see, whenever we find any misstatements, we want to check whether they were material or not. If they were material, further audit procedures and giving a qualified opinion and checking whether there could occur a fraud or not, could do for the further improvisation of the misstatement. That's a thing that the auditor could do. And the auditor shall consider the size and nature of the misstatement for the class of transaction or account balance or disclosures and financial statements as a whole, effect of uncorrected misstatements related to prior periods. You see, now he has to consider the misstatement which was related, which could affect the prior periods also. What he has to done, first he has to revise the materiality. Second thing, he has to check whether they were material or not. First he have to revise materiality, check whether material or not. Third one is you have to check the prior period also, whether they could affect the prior period also. Then auditor shall communicate with TCWG and their effect. Here comes communication part. If the effect of the uncorrected misstatement is immaterial, here what he is checking whether they were material or not, right? Now if he found that they were immaterial, they shall request the written representation from management. If management refuses to adjust financial information, that is what they were, that is why they were called as uncorrected misstatement. The management is not at all adjusting in the financial statements. Why only management has to adjust the uncorrected misstatements? Because preparation of financial statement is the responsibility of the management. If the management is only refusing to adjust the financial statement and auditor is not able to conclude whether the aggregate of uncorrected misstatement is not material, auditor shall express a qualified and adverse opinion. See, there were two nots here. You have to cancel and read it simply. The auditor is concluded that the uncorrected misstatements are material. If they are material, what he has to do? He has to qualify the report. First, what he has to do? Revise materiality and check whether the material or not, and check the effect on the prior period. If he thinks if it was immaterial, ask for written representation. If not, shall communicate with the TCWG the uncorrected misstatement. The management, if refuses, he has to qualify the report. And that's it. We have completed our SA 450. We'll see SA 500. As usually, we'll go with the objectives of the auditor first. The objective of the auditor is to design and perform audit procedures in such a way as to enable the auditor to obtain sufficient and appropriate audit evidence to able to draw reasonable conclusions on which basis the auditor's opinion. Okay, what the auditor has to do, auditor has to design and perform audit procedures. Why he has to do that work? Why he has to do audit procedures? To obtain audit evidence. How the audit evidence should be? It should be sufficient and appropriate. It should be sufficient and appropriate. Why it has to be sufficient and appropriate? To draw reasonable conclusions. Why? To draw reasonable conclusions in order to give a reasonable assurance. Okay, that's what the objective of the auditor is, to design and perform audit procedures in order to obtain sufficient and appropriate audit evidence in order to draw reasonable conclusions. Okay. As of to regarding sufficient and appropriate, what does they mean? Sufficient amount of sufficiency with regards to the quantity of something. What the quantity of here is audit evidence. Sufficiency is with regards to the quantity, quantum, amount of. Okay. Appropriateness is mostly the quality, relevance to the relevance to the assertion that what you're doing. And audit evidence is a definition of audit evidence. This was mostly given to just for 1 hour before the examination, just to write the MCQs portion and all. It would be helpful for you to write any case-based scenarios also. And it's an information used by auditor to arrive at conclusions on which audit opinion is based. And relevance deals with the logical connection with the purpose of audit procedure and the assertion under consideration. You see, in order to watch or in order to audit the trade papers, what he has to do, he has to do some external confirmations and all. That is, external confirmation is the audit procedures to obtain audit evidence. Assertion is the correctness, checking the correctness of the trade payables. So there has to be a logical connection in order doing that. So like doing comparison of all the sales and the litigations and all, salaries of the employees, all this doesn't form a logical connection, right? So there has to be some relevance to the audit procedures with regards to the assertions they were trying to. Tests of control are designed to evaluate the operating effectiveness of control. Tests of control is like testing the internal controls of the entity. Why internal controls? Internal controls was such controls that were designed, implemented, and maintained by the management. That's the responsibility of the management to do what? To prevent, detect, and correct material misstatement that would be occurred in the financial statement at assertion level. Assertion level, okay. I want to clear one thing is assertion level and financial statement level is what two different things. Assertion level is that any material misstatement or any kind of misstatement that affect only one particular class of transaction or a one particular disclosure or one particular account balance. Like there were some irregularities with regards to the internal controls for the salaries. Say salaries. For salaries, only the salaries or employee benefits column only gets affected. That's at misstatement at assertion level. If not, there were some internal control flaws that would affect the stock valuation or kind of stock valuation or like sales valuation and all. Or there were kind of internal control deficiencies with regards to modifications of the data. They have unauthorized access of like that. They would have their impact on various kinds of accounting balance. For the stock, you have it on opening balance, closing stock, and that would also affect on the profit. So there were a lot of them have been affecting. And if they have unauthorized access to any kind of database by the unauthorized people, they have access to almost all the account balances, right? That's what, so that was at financial statement level. Then it was when the misstatement is affecting on more than one assertion level, it's on financial statement level, okay? And substantive procedures are designed to detect material misstatement at assertion level. Okay, they comprise of tests of details. What are tests of details? It's like checking in details, checking the journal entries, etc. Substantive analytical procedures were mostly comparison, forming a ratios with the financial information and the non-financial information, like rent to the square feet and the number of employees to the salary amount. And with that in mind, we'll just dive into SA 500 auditor shell, what the auditor has to do. When using the information produced by the entity, the auditor shall evaluate the information that is sufficiently reliable for the auditor's purpose. When the auditor, you see, audit evidence, how the audit evidence should be. Audit evidence should be sufficient and appropriate. So it's all about the qualifications of the audit evidence or the qualities of how the audit evidence has to be. It has to be sufficiently reliable. Okay, in obtaining the audit evidence about the accuracy and the completeness of information and evaluating whether information is sufficiently precise and detailed for audit purposes. These were the keywords that you have to remember. They have to be sufficiently reliable. If you found a management that a fraud that was made by the management, the reliability on on the audit evidence that you have obtained or the written representations you have obtained have create a significant unreliability with regards to the audit evidence. It should not be that. The audit evidence has to be reliable and it has to be any data. Audit evidence is something or information or data. Information has to be what? Reliable, it has to be accurate, and it has to be complete. And it has to be sufficiently precise and detailed. This is with regards to numericals. This is with regards to non-numericals. Inconsistency or doubts over reliability. If when the auditor will have a doubt on the reliability of the audit evidence, when the audit evidence obtained from one source is inconsistent with obtained from the another. Okay, when two different sources or for the same audit evidence, the results were different, then it would cast a doubt on reliability. And the auditor doubts over the reliability of the information to be used as an audit evidence, as they were contradictory audit evidence. Corroborative audit evidence is something that support each other. Contradictory, that was opposite. Okay, the auditor shall determine the modifications or additions to the audit procedures as they were giving a contradictory audit evidence. What the auditor has to do, he has to perform further audit procedures, that is modifications or additions to the audit procedures. It seems simple. Okay? And sufficient appropriate audit evidence. This is the favorite answer, right? Reasonable assurance is obtained when the auditor has obtained sufficient appropriate audit evidence to reduce audit risk to an acceptably low level. Okay, what the auditor has to obtain, he has to obtain reasonable assurance. How he obtains that? By obtaining sufficient appropriate audit evidence. Why he has to do that? To reduce the audit risk. Audit risk is something that you're forming an inappropriate opinion or to an acceptably low level, and sufficiency and appropriateness are interrelated. Sufficiency is a measure of quantity of the audit evidence, and the quantity is need to be affected by auditor's assessment of the risk of material misstatement. Okay, they're saying that risk of material misstatement is in relation with sufficiency. When the risk of misstatements which was identified or assessed under SA 315 or higher, the sufficiency, the quantity that the auditor has to obtain the audit evidence also has to be higher. Okay, the quality of such audit evidence, which is higher the quality, less may be required. Obtaining more audit evidence, however, may not compensate its poor quality. They're also talking about the quality. Quality also has to be higher with regards to the risk of material misstatement, but having a poor quality from an you see, audit evidence from a third party was having more weightage and more independent, and the audit evidence that was obtained directly from the auditor has more independence. So in order being that, if the auditor was just inquiring the management with regards to everything, that is of poor quality. How much and all the quantity might be high, it's of a poor quality, it cannot compensate from the high quality. High quality is from independent third parties and auditor obtaining directly from the himself directly. And the reliability of the evidence is influenced by its source. Yeah, that is the source that we are talking about, third party and from the internal organization management, and by its nature. By its nature is oral or written, any kind of. And more assurance is ordinarily obtained from the consistent audit evidence obtained from the different sources or a different nature. Okay, more assurance was obtained when it's obtained from different sources, as we have said, from where it has started. When audit evidence obtained from one source is different or inconsistent with the another. From different sources, we are getting more assurance, that is corroborative audit evidence. Information from sources independent of the entity data you see they are talking about the information have more reliability with regards to independence with regards to entity confirmation from third party analyst reports, etc. And how the audit evidence has to be obtained. It has to be obtained from the risk assessment procedures and further audit procedures. Further audit procedures contain tests of control, substantive procedures including tests of details and substantive analytical procedures, which we have discussed prior. And what are the sources of audit evidence? As while dealing with the MCQs and or doing all the questions, what are the sources of audit evidence? How the auditor could obtain audit evidence? Inspection of any documents, observation of any process, external confirmation with regards to uh, confirming balances, and recalculation is recomputation of any kind of balance that was already done by the management. Reperformance is any kind of controls with regards to that was again performed by the auditor. Analytical procedure is just comparison of like financial and non-financial information. That's it. These were the inquiry with regards to a questionnaire, asking questions within entity or outside the entity also. This has to be come for you by hearted. Okay, inspection of documents, observation of process, same thing. Recalculation of any kind of amounts, and reperformance of any procedure. Observation and reperformance are with regards to procedure. External confirmation, balances, analytical procedures, comparison of financial, non-financial, inquiry, any kind of background or any kind of related party transactions, etc. will be going under inquiry. Generalization about the reliability of the auditor. What are some generic words or generalization about the reliability? When the audit evidence is increased, when it's obtained from independent source. Reliability of audit evidence generated internally is increased when related controls are effective. First thing, when audit evidence is obtained from internal sources, is have higher weightage. It's more reliable. When it was obtained from internal source, but if the controls were effective, then also it is reliable. Okay. Audit evidence obtained directly by the auditor is reliable. In documentary form is reliable, and original documents is more reliable. Okay, and these were with regards to the generalizations of the reliability of the audit evidence. And while evaluating the objectivity of the management expert. What is objectivity with regards to management expert? Is management is hiring some expert with regards to valuations of few shares or transaction, financial instruments, or actuarials, etc. The interest and relationship creating threats like financial interest with regards to the management's expert to that of the entity, and business and personal relationships, provision of other services also like self-review threats. Okay, financial, business, or personal, or some provision of other services also would evaluate the objectivity of the management expert. And why we have to evaluate the objectivity of the management here? In order to use the work of the management expert. Okay, obtain information regarding competence, capability, and objectivity of the management expert. What we have to evaluate is personal experience and discussion with the expert, and discussion with the others with who are familiar with that expert work, knowledge of expert qualification or any kind of published paper, book, or written by that expert. Personal experience, discussions with whom? With that expert only, and with the others who are familiar with that expert, and the knowledge of the expert and any paper or book that was written by the expert. Okay, while evaluating the appropriateness of the management expert work, how do you evaluate the appropriateness of the work? What are the This is like again a important question with regards to this. Do remember this. Relevance and reasonableness of expert findings and conclusions, and their consistency with the audit evidence, and whether appropriately reflected in the financial statements. That is what we have to evaluate. We have to evaluate the relevance and reasonableness of the expert findings and conclusions. Okay, remember this: relevance and reasonableness of findings and conclusions, and how they were reflected in financial statement, and how they were inconsistent with the audit evidence. Okay, if the expert work involves any kind of assumptions, the relevance and reasonableness. What's the key hero or key word here, key phrase? Relevance and reasonableness of what findings and conclusion, relevance and reasonableness of the assumptions and methods. If the expert work involves any source data, relevance, completeness, and accuracy of the source data. What we have seen here, something relevant source data, completeness of source data. First one, the audit evidence author shall find that it would be sufficiently reliable if that was accurate, completeness, and sufficiently precise and detailed. The same thing. You see, all the adjectives with regards to any kind of data. This is all data. Data's adjectives were it has to be reliable, accurate, and sufficiently completeness, and the source has to be good. Okay, and that's it. We have completed essay 500. And now we'll discuss essay 501, audit evidence of a specific consideration for a selected items. We'll see what all the selected items and objectives of the auditor. The objective of the auditor is to obtain sufficient appropriate audit evidence with regards to existence and condition of inventory, completeness of litigation and claims involving in the entity, presentation and disclosure of segment information. These are the three things we are going to discuss in this essay 501, inventory, litigation and claims, segment information as per AFRF. If the physical inventory counting is conducted at a date other than the date of financial statements. Financial statement consists of on which date the closing stock, on the date of the year end. It is impracticable to count all the stock when all go down for all the companies on 31st March, right? So for that, what the auditor could do, auditor could perform audit procedure to obtain audit evidence whether to the changes of the inventory, like subsequent sales or subsequent purchases between the count date and the financial statement recorded date. And the auditor is unable to attend physical inventory counting, that is even at the later date, the auditor is unable to attend the physical counting, then he should do that on an alternative date and perform audit procedures that are intervening the transaction. And if the attendance at the physical inventory counting is impracticable, that is which is very health hazardous, like for chemicals, etc., what he has to do, he has to do again alternative audit procedures. You see, all the distance and cost or time, that does not lead to an impracticable situation. Only health hazardous situations, etc., will lead to that. And that's with regards to the inventory. And we'll see first the inventory portion here. Attendance at physical inventory counting, understood. That's what the auditor has to do. He has to evaluate management procedures for recording and controlling the results of the entity's physical inventory counting, first one. And second thing is observe the performance of management count procedures. You have to observe what process management counting process, and inspect the inventory. Inventory is like their condition, whether they were or like any kind of, if they were your doing any inventory with regards to the perishable items, whether they were they were perished or something, they were rotten, etc. You have to check their condition of the inventory well and perform test counts. What you have to do, you have to observe management count process and perform test counts, and performing audit procedures over the entity's final inventory records to determine whether they accurately reflect the actual inventory count results or not. That is tallying that things. First thing you have to ask how the management procedures with regards to the counting, and then observe the counting process, inspect the inventory condition and perform test counts, and just tally them. And that's with regard to that. And when our inventory, that's the entity's inventory, was at custody of third party like job worker, etc., what you have to do, the auditor has to obtain sufficient and appropriate audit evidence regarding existence and condition of the inventory. Why counting procedures here? Because of the existence. Why he has to inspect the inventory? Because for the condition of the inventory. You have to check both of them. Through what? Request confirmation from third party as to the quantities and the condition of the inventory. You have to get a confirmation and perform inspection, that is obtaining audit evidence directly by the auditor in appropriate circumstances. Mostly usually we write only this in the what, like the case or scenario or something that was given in the examination, also do write this inspection also point. And this is with regards to litigation and claims. We'll just move on with that. Yes, now we are talking about the litigation and claims. The auditor shall design and perform audit procedures in order to identify litigation and claims involving the entity which may give rise to a significant material misstatement. Okay, what he has to do, he has to identify litigation and claims that give rise to risk of material misstatement, including what he has to do, how he has to design and perform those audit procedures. Inquiry by the management within the entity and in-house legal counsel, reviewing the minutes of meetings of TCWG and external legal counsel. With the what he has to do, he has to inquire management and in-house legal counsel, review minutes of meetings of TCWG and legal counsel, and reviewing the legal expense account. Have to seek direct communication with the entity's external legal counsel. This is something that the evidence that was obtained directly by the auditor is more reliable. The auditor shall go through a letter of inquiry prepared by the management and sent by the auditor requesting the entity's external legal counsel to communicate directly to the auditor. Observe the process here. You see this management is preparing that this so and so were the our auditors, please provide the some support or be cooperative with them for all the information they ask for. The management has to give a word unless until we can auditors cannot directly go and ask some legal external legal counsel there, right? So management has to give permission to the external legal counsel to discuss their legal items or legal matters to the auditor of that. So if the management refuse to give that permission, what the auditor has to do? The auditor is unable to obtain sufficient appropriate audit evidence by performing the alternate audit procedures, he shall modify under SC 705. Okay, that's the thing with regards to that. And now we'll see a letter of that inquiry that the prepared by the management and sent by the auditor to external legal counsel should contain a list of litigations and claims and management assessment of identification of litigations and their financial implications, including any costs involved, like any kind of cost that was with regards to the penalties they have to fine or fines that they have to pay or compensations, and a request that entity external legal counsel to confirm reasonableness of management assessment and provide the auditor with further information, the list of incomplete and incorrect. First, what he's giving list of litigations and claims and management's estimate of the financial implications. And what he's asking whether if the above list was incomplete or incorrect, please provide that information and also provide that management estimates on the financial implications were reasonable or not. He's asking whether these two were right or wrong. That's it with regards to the litigations, and now we'll move on with the segment information. How methods used by management with respect to segment information. What all the information have to be given. All the presentation and disclosure. The sales transfer or charges between. Charges is like when a segment was giving a loan or any kind of while transferring the inventory from one segment to the another. The fixed charge, the one we see in our SCMP, like a dual rate system, a fixed charge. Yes, that was an elimination of intersegment profits, etc., transactions, and a comparison with budgets and expected results against standard costing here, and the allocation of assets and costs among them, assets and costs among them, and the like HO cost and the cost and assets with regards to that, and consistency with prior periods, adequacy of the disclosure and inconsistencies. That is with regards to SA 501. And now we'll see SA 505. That is external confirmation. As usually, we'll move on with objectives of the auditor. The objectives of the auditor using the external confirmation procedures to design and perform such procedures to obtain relevant and reliable audit evidence. As we know, external confirmation is a procedure to obtain the audit evidence, and they are talking mostly only with regards to the external confirmation here. External confirmation is an audit evidence obtained as a direct written response to the auditor from a third party. So that's why the reliability would be more. And there were two types of the confirmation request. That's positive confirmation, negative confirmation report request. A positive confirmation request is a request which urges the third party to respond if he agrees to that or disagrees to the information in the request. There were trade payables or debtors, so they could agree or disagree. They have to give a response to that. And there was a chance that they may blindly, without checking, could just say or agree with that. So in order to reduce that risk, the auditor may what he could send a blank confirmation request to just enter the amount. They have to put some effort and check the balance with regards to that, and then put the amount and then communicate with to the auditor. But there was also another risk, the risk of lower response rate. There could be a non-response for that because it involves some extra effort to do that. So that is with regards to the positive confirmation report. And negative confirmation request is such thing that the third party only communicates to the auditor when he disagrees, only when he disagrees with the information that was provided in the external confirmation request. And non-response is not responding to the external confirmation request. That's a non-respond. And exception is they have communicated, but there's a difference between the amount that was mentioned in the external confirmation request and the amount that was provided by the third party. That's all with regards to the terminology to be discussed here. And we'll dive into, let's say, 505 here. First, yes, with regards to external confirmation procedures, how the procedure has to go through a step-by-step process. First, you have to determine the information that what you wanted to request or you wanted to get confirmed and selecting the parties and designing the confirmation request and sending the request to the follow-up requests, etc. And you see, this is mostly discussed in the keyword kit series also while you're communicating. I don't remember the number, it might be one or two. While in that keyword kit, we have discussed that the auditor, while communicating to the management, TCWG, or communicating to third parties or external legal counsel, anybody while auditor is communicating, or any communication that was going in an audit, how it has to be done. The same thing, if you put that beside and read this, you could easily go and write that. First, the information, and then the to address the confirming party, and how you have to design that. And you're following up the things. And the management refusal to allow the auditor to send a confirmation request. Okay. Now you see, even for the external legal counsel, what the management had done first, it had communicated to the external legal counsel that these are our auditors, so and so are our auditors, please provide or cooperate with them for the information that they have asked for. Like that, they also have to communicate with the third parties that he so and so is our auditor, please for the audit purpose confirm the balances or provide information that they were asking for. Like that, they have to give to the management, otherwise some other third party cannot will not in a usual basis provide information that to the confidential information to a auditor like us. So that's why if the management is refusing the auditor to allow or send a confirmation request, what they have to do. This is also discussed in the keyword kit, or management holding or putting a restriction. I think it's three, I think three or five. That is, first you have to inquire the management about the reasonableness for that refusal, and you have to evaluate the implications on the audit procedures. You have to perform alternate audit procedures if you are not able to obtain sufficient appropriate audit evidence through alternate audit procedures. Then what you have to do, you have to communicate to TCWG and then determine you to modify the audit report under SA 705. And as we also have seen, there were two types of requests, positive and negative, right? When to use negative confirmation request. Negative confirmation requests were used when you find the internal controls were so effective. Second thing, when there's a large number of transactions in the financial statement. Why these two has to be first? Because as an auditor, you went to the entity to do the financial statement audit. So in the financial statement, you have almost a small and homogeneous accounting balance and transactions with regards to the financial statements. And also you have to evaluate the internal controls. And the internal controls have found most effective the negative confirmation request. And what are the results you're expecting? You're expecting a very low exception rate. Exception rate is the difference between the what is that was given in the what external confirmation request and the confirmed by the third party. Though you expect a very low rate, and the auditor is not aware of any circumstances or condition that would cause the recipients of the negative confirmation to disregard with request. That is, he's thinking that there were no circumstances or condition that the third party will be disagreed to the external confirmation request. Only these 2 points you have to remember with some effort, and these two were simply like financial statements. In financial statement, there were a small and homogeneous account balance, and internal controls were effective. And what are the factors you have to consider while designing the confirmation request? And what all they have to the assertions that are being addressed, whether you are seeing the if you are seeing like a third party stock, you are going with the ownership with regards to the ownership of the inventory. While you're doing some external confirmations with regards to them, you have to you're seeing ownership there. And while checking the trade payables, you're seeing the accuracy of the account balance there. And with regards to the any kind of list of invoices or sales, you're seeing the completeness of the bills there. So you have to make sure what assertion you're doing, and the risk of material misstatement with no fraud risks, and the layout and presentation of the confirmation request, and some prior experience, and the method of communication, and the management's authorization and ability of the confirming party. Okay, there were a lot of things that were here. How to remember it in one go? First thing, external confirmation is a communication based thing. What for communication, what you have to do? First, you have to know what all the things you wanted to do. What's your result? What you're expecting? Some assertions are being to addressed. What are the your objective? Second thing, since it's a written format, it has to be in a layout, and the method of communication, whether it's a physical letter or an electronic format. These two go hand in hand. Okay, layout and presentation and method of communication. And what are all the parties involved? The management, other than auditor, the management and the third party. So you have to see the management encouragement for authorization and encouraging the third party to reply back, and the what that's the responsibility of the management with regards to external confirmation, and third party's ability to confirm. So these are with regards to parties and the letter that was involved, that is here, and the assertions of the matter that was in the external confirmation with regards to that. And you have already written 5 points that were more than enough. You see, don't remember through mnemonics. In examination in a very stressed situation, it is highly impossible to remember something that's from out of the box, where that E stands for, where that P stands for, M stands for. You see, all this create very stressful situation in that stress situation that you're already in. So you have to understand the process, put your heart there, how the process is going through. This is audit is a behavioral science. You have to know how the parties behave. It's mostly deals with the people, how the people are behaving, and how we have to respond to them, and what all the things that were that done. And I think by this, you have understood how you could write without using of mnemonics, by understanding the process. What are the things that were involved? External confirmation was involved, and how has to be communicated, and what the layout, and what the matter has to be, and what all the parties, other than the auditor, management, and the third party. That's it. 5 points. These were more than enough. And risk, if a confirming party uses a third party to respond to the confirmation request. Okay, you're doing some confirmations of some trade payables who have named some Raj, and some Raj is not responding, how his PA or his son or daughter, they were responding, they were not authorized to do so. Raj only has to respond to that. That's what the proper source may not be from the proper source, and the respond may not be authorized to respond. The source might be different, and there might be, authorization, no authorization with regards to that, and the integrity of the transmissions may have been compromised. That was his saying, agreed for everything, because they know that entity were friends and familiar and all. So there were that may be on a lack of integrity that might be happening there. And categorize the results of the confirmation request. What are the results? How could we categorize that? A response by appropriate confirming party indicating agreement with the information provided in confirmation request, information without exception. That is result number one. Responding, first thing, they have responded and there was no deviations, there was no exceptions or no differences in the first one. Second thing, they had responded but deemed unreliable. And third thing, there's no response only. Fourth one, there's a response but they're indicating an exception. First thing, no response, reliable, and no exception. Second thing, there's a response but unreliable. Third thing, there's a response but having an exception. Fourth one, no response at all. These were four types of results that we could expect from our external confirmation. And we have completed essay 505 here. And now we'll see essay 510, that is audit of opening balances. First, we'll go with the objectives of the auditor here. The objective of the auditor with regards to opening balances is to obtain sufficient appropriate audit evidence with regards to opening balances. Whether two things is whether the opening balances contain misstatement that materially affect current period financial statements. You see, these opening balances have some misstatements that affects current year financial statement in which the auditor is auditing. That was one thing, has to check whether obtain sufficient appropriate audit evidence with regards to that. And second thing is whether the appropriate accounting policies reflected in the accounting balances. That is, the accounting policies that were reflected in the opening balances were consistently applied in current financial year also. The two things, whether the balance that they're having were contains any misstatement. Second thing, the accounting policies were consistently applied in the financial current year financial statements or not. These two things you have to write. You have to remember this phrase. You see, all the call outs here have to be remembered. You have to know that. And you see what all the things you remember or not, but anything with regards to a particular essay, you have to remember the essay number with regards to the essay title plus its objective also, its objectives of the auditor also. It's so simple. You could read it 2 to 3 times, you'll remember by this time. If the auditor concludes the accounting policies, what's the objective of the auditor, that they have to be consistently applied in the current period financial statement also. And he found that those accounting policies were not consistently applied, accounted, or presented or disclosed, shall express a qualified opinion or an adverse opinion as per SC 705. Okay. The initial audit engagement is something that's so simple. Initial audit engagement, that is the auditor and then entity. In both their combo, the audit is for the first time. That is, the auditor might have done of audits of different entities, and the entity had various auditors that have done the entity, but the combo is for the first time. That is what we call the initial audit engagement, or the entity is having audit for the first time. The prior period were not audited at all. The prior periods were not audited at all. That's what with regards to the initial audit engagement. And opening balances definition was these were closing balances of the prior period. And with that, we'll move on to the essay 510. What the auditor shall do. Auditor shall determine whether prior period closing balances, that is the opening balances, have been correctly brought forward to the current period, or any adjustments have been disclosed as a prior period items. That is, they have been properly carried forward or not. You see, when it was regarded as opening balances after brought forward, after carrying forward, then Until then, it would be closing balance of the current period. That's why they have used this phrase here. Don't get confused with regards to that. Determine whether the opening balances reflect the application of appropriate accounting policies, and determine whether accounting policies were not there or not. That's in the objectives of the auditor also. So we could write all the two things here. Just repeating the objectives of the auditor and performing one or more of the following. What he has to do? He has to find whether the prior year financial statements were audited. He has to check the copies of those audited financial statement and evaluate whether audit procedures performed in the current period provide evidence that are relevant to the opening balances, or performing specific audit procedures to obtain audit evidence with regards to opening balances. You see, you have to write the objectives first, and then second thing, if the prior periods were audited, you have to check those financial statements. Second thing is that you have to perform audit procedures and specific audit procedures. That's it. We have completed essay 510. And now we'll see essay 520. That's with regards to analytical procedures. Objectives of the auditor under this 520 were to obtain relevant and reliable audit evidence while using substantive analytical procedures. That is, using substantive analytical procedures. For that, what he has to obtain? He has to obtain relevant and reliable audit evidence and design and perform analytical procedures that assist the auditor when forming an overall conclusion as to whether financial statements are consistent with auditor's understanding of the entity. You see, this is something in relation to understanding of the entity and the relevant and reliableness of the audit evidence. With regards to it is something that's different from sufficient and appropriate audit evidence, right? It because it has more financial and non-financial information and all that things. Only for the analytical processes, we want relevant and reliable information. Reliable is something, it's again talking about the source of the information. Relevant is with regards to the relationship. It has to be more logical connection with the assertion that we are doing. So that's with regards to that. That's how to analyze the objective of the auditor. And so it would be very easy to write any kind of vague or random questions that were being asked by the analytical procedures and in the examination. And analytical procedures means evaluation of financial information through analysis of plausible relationships, that is forming a ratios and all among both financial and non-financial data that we have been talking a lot since then. Substantive analytical procedures applicable to a large volume of transactions. Substantive means a large, that tend to be predictable over time, just like rent, salaries, sales, etc. Unsophisticated predictive model is like a non-financial information to our financial information ratio. And the result of such analytical procedures may identify a previously unrecognized risk of material misstatement. Why they have included here 315 is with regards to only this clause, with only with this objective, that is uh, it would assist the auditor in finding something that were consistent with the auditor's understanding of the entity, that his analytical procedures results and his understanding of the entity were relevant. That's what they're talking about. Say 315 here. That's also again talks about identifying and assessing the risk of material misstatement with understanding the entities and its internal, including its internal controls, right? That's why for that. So to revise, if they were not consistent, he has to revise the assessment of risk of material misstatements and then modify the planned and planned audit procedures to modify the planned audit process. And we'll move on with essay 520 here. What a substantial analytical procedure, what you have to do. First, you have to determine the suitability, that is relevance, the relevance that what we seen in the objective here, the suitability of the particular substantive analytical procedure for the given assertion, whether you're checking the accuracy, completeness, etc. For that, you have to check the relevance, logical connection. and you have to check the reliability of the data. Again, it's in the objective. You have to check the reliability of the data and relevance of the information available and controls over the preparation, and develop an expectation results, whether there is sufficiently whether that amount evaluate whether the exception is sufficiently precise to identify a misstatement. That's also again they're talking about the objective. What the result should be equal to the auditor's understanding of the entity. In the second objective, right, they're also talking about the same thing with regards to the understanding of the entity, means the identifying of the material misstatement, the risk of misstatements in the entity as a 315 that has to be equal to that, and determine the difference recorded and expected values that is acceptable. That is, if there were any differences here, you have to determine that difference also. That is difference from the substantive analytical procedures to all the identifying of risk of material misstatement and understanding of entities environment in SA 315. SA 315 one side, and analytical procedures, substantive analytical procedures one side. Any difference between them you have to identify and determine. That's all with regards to this. And reliability of data is influenced by what? This is another a generic question. It depends upon the, you could write the generalization that we have discussed earlier, depends upon the source and depends upon the nature, that's whether it's a oral or written, etc. And comparability of the information, that is, it has to be a more corroborative audit evidence, and the controls over the preparation of financial information. That's all. We have completed the SA 520 analytical procedures. First thing is that it all lies with the objectives of the auditor only here. Most of the essays were with that, like that only, that it has to be relevant and reliable audit evidence, and it has to be inconsistent with what all the things we have done in SA 315, understanding the entity and identifying and assessing the risk of material mistake. And that's it. With the, we have completed SA 520, and now we'll discuss SA 530 audit sampling. As always, we'll go and discuss the first objectives of the auditor. The objective of the auditor when doing audit sampling is to provide a reasonable basis to draw conclusion on the population on which sample was selected. You see, the audit procedures and the audit sampling was done on a sample. But what he's doing, he's obtaining a reasonable basis. He's obtaining conclusions about the population as per a reasonable basis. So that is, he's forming an opinion on whole population while auditing the some samples. And this is the definition of audit sampling, that is application of audit procedure to less than 100% of items within the population. And they have the samples have a chance of selection. Every sample has a chance of selection, and they provide a reasonable basis to draw the conclusions on the entire population. This is the key phrase that you have to use in this standard 530. Sampling risk is the definition of sampling risk. The risk that the auditor's conclusion based on a sample may be different from the conclusion if had done the entire population. That is, he had got some conclusions by auditing a sample, but there's a risk that his opinion might change when he audits the entire population. That is what the sampling risk talks about. There were two types of sampling risk. First one is, that is, he had been more on a positive side. That is, the controls were not that effective, but he thinks they were more effective than they actually are. And while doing tests of details, he found that there were no material misstatement, but in fact there were actually as. That's the first one. Second thing, he's been more pessimist, he's been more negative. That the test of controls, the controls are less effective than they were actually are. And in case of tests of details, the material misstatement exists when they're actually not. These were two sampling risks that the author might have. And anomaly is the definition of anomaly, which is a misstatement or deviation. Misstatement with regards to financial information on a statement or assertion. Deviation with regards to the internal controls. That is demonstrably not representative of a misstatement or a deviation in a population. Normally means a deviation, or that's something that was unexpected while auditing samples. That's not need not be a misstatement or a deviation in the population. And these all the statements with regard for definitions: statistical sampling, stratification, tolerable misstatement, and tolerable rate of deviation has to be read. You have to do rewrite that things. You have to know these four definitions before going to the examination. An approach to sampling that has following characteristic. What does statistical sampling has? They use probability theory to evaluate sample results. The samples have some results, right? They will use probability theory in order to ascertain that if they have what like they have you taken 20% of the population as samples, and they have got some like one misstatement for the 20%, and by using of popular probability theory, as for the 100% there were total five misstatements that would be happen. So they use probability theory, that's a statistical sampling, include measurement of the sampling risk. Okay, and they use random selection of sample items. They have to use sample items and use probability theory. This is what a statistical sampling is. If anything, these do not comply, that's a non-statistical sampling. Stratification is just by dividing the population into groups having similar characteristics. Okay, like a tolerable misstatement. Tolerable misstatement is that monetary amount that the auditor is willing to accept as a misstatement in his audit procedures, etc. Willing to accept that. Tolerable rate of deviation is such that that particular deviation that the auditor is willing to accept in the internal controls. Tolerable misstatement, something that's related to the financial information, and something that was related to the internal controls is rate of deviation. Okay. Monetary amount set by auditor in respect of which auditor seeks to obtain an appropriate level of assurance that the monetary amount set by the auditor is not exceeded by the actual misstatement. And the tolerable rate of deviation is the rate of deviation from the prescribed internal controls set by the auditors in respect of which auditor seeks to obtain an appropriate level of assurance that the rate of deviation set by the auditor not exceeded by the actual rate of deviation in the population. Okay, these were the tolerable. The auditor is tolerable in this amount of misstatement, and this rate of deviation with regards to internal control. And with that said, we'll just move on to the SF 513. Non-sampling risk. Non-sampling risk is that type of risk that it's not due to the risk that was not due to the sampling, that was with regards to something other else. That is with regards to the audit procedure, the auditor might have found or misinterpretation of the audit evidence, or failure to recognize a misstatement, or any other reasons other than sampling. That is, you see, when the sampling risk was there, what's the sampling risk? Sampling risk is that auditor's conclusion would be different if he had done the population entirely. Okay, that is not through the not because of the sampling units. The risk is not due to the sampling units. It is because of the audit procedures or interpretation of the things, etc. And misinterpretation of the audit evidence, and failure to recognize some misstatement or deviation, and the auditor reaches a erroneous conclusion for any reason that was not a sampling risk. Auditor shall evaluate the results of the sample and whether the use of audit sampling has been provided a reasonable basis for the conclusions about the population that has been tested. These were all objectives of the auditor. What are reasonable conclusions were not reached with audit sampling? If the auditor concludes that audit sampling has not provided reasonable basis for conclusion about the population, you see what we are saying, auditor will apply audit procedures on few samples, selected samples, and obtain a conclusion on the population. Now he is not getting reasonable conclusions with regards to population. Then what auditor could do? Auditor could request the management to investigate misstatements that have been identified and potential for the further misstatements, that he had already found few misstatements. and he requesting the management to further investigate for the further misstatements and tailor means modify the nature, timing, and extent of the further audit procedures, which also we have discussed in the objectives of the auditor. And auditor shall determine a sample size sufficient to reduce the sampling risk to an acceptably low level. You see, one for 100%, when the risk of misstatements were high, he cannot go for 2%, 3% of sample size. He have to do almost 40% to 60% of the sample size, right? So they are talking about the sample size have to be sufficient with regards to the quantity. Select items for the sample in which by way each sampling unit in the population has a chance of selection. And audit procedure is not applicable to the selected item. Perform the procedures on a replacement item. If the audit procedures that were made by the auditor were not applicable to a few selected items, like few selected where the risk of material misstatement was high and few important parties, etc., then what he has to do, he has to perform the procedure on a replacement item, and he has to replace that to the another item. And unable to apply the designed audit procedures, treat that item as a deviation from the prescribed control in case of test of control, or a misstatement in case of test of details. If he is unable to apply the audit procedures, that could be a test of deviation from test of controls, or a misstatement from the test of details. To use a statistical or a non-statistical sampling approach is a matter for auditor's judgment. Sample size is not a valid criteria to distinguish between the statistical and non-statistical approach. You see, there will be no question with regards to all these 4 points. Uh, it is just for the common understanding purpose, just to know it is there. And stratification and value weighted selection. Stratifications were a group of having similar characteristics, and value weighted items were with regards to only particular monetary limit, etc. We'll see the difference between stratification and value weighted selection. Stratification is when performing tests of details, the population is often stratified by monetary value. This allows the greater audit effort to be directed to a larger value items, and these items may contain greatest potential misstatements in terms of overstatement. You see, all the large value items here have been divided or have been created as a group. But this is what stratification was. There's a quality involves there. When performing tests of details, it may be efficient to identify the sampling unit as an individual monetary unit that make up population, having selected specific monetary units from within the population. This is with regards to the value weighted selection. Now we'll see an example like this. You see, all these were like debtors balance, if you guess it as a debtor balance, and we are picking up samples from $100 to $25,000. You see, customer 6 is having $950 sing, and customer 20 is having 25,000. That was nearer to 25,000. What happens in a value weighted sampling is that customer 6 has lesser number of chances than customer 20, because the monetary amount which is higher has a higher chance to be picked up as a sampling unit. And that's it. That is what the only thing that's the difference between stratification and a value weighted selection. That is, more the value of that particular population or that particular sample has, it has more chance of being selected as a sample. Whereas stratification is all the large value items was categorized and grouped and together, and they were selected. We are making a group, and here we are randomly selecting from a particular monetary range, and for that the random selection is more the weights, more the amount was higher to the more weight the monetary limit was, it had more chance to be selected, and that's the difference between that. And with regards to the methods of selecting samples, it's a random selection and systematic selection, like a size, you give a particular sampling interval. For example, you have determined a starting point for the 50 and each 50th unit will be selected thereof. The systematic sampling and a block selection were mostly similar, but here we select only one particular thing. But in block, we select a particular block of items. In our keyword kit series, we have discussed all the difference between the block sampling and cluster sampling and all. Please go and check there. And the monetary unit sampling is same as value weight selection. The in the entire population, the items that have higher value have more prone to get selected as a sample. Haphazard sampling is objectivity by the auditor. And with regards to this sampling size, I will just see this here. Sampling size of tests of details and sampling size with regards to tests of control. When there's an increase in risk of risk assessment, obviously sample size increases. An increase in tolerable rate of deviation, sampling size decreases. That is, tolerable rate of deviation is something the auditor is accepting to be wrong. So that's why the sampling size would decrease. And an increase in the expected rate of deviation, then sampling size would increase. That is, again, the risk was being higher. An increase in the auditor's desired level of assurance. You want more assurance, more sampling size. This is with regard to the sufficiency. And an increase in the number of sampling units in the population, it has a negligible effect on the sampling size. Okay. Now, with regards to the, this was even tested in the MCQ, that's negligible effect. Or don't skip this part. Do remember this. Do check out just 1 hour before the examination. It's an important part. Sample size, or you may take a screenshot of it. Sample size of test of details is that with regards to increase in risk assessment, sampling size would increase, and increase in use of substantive procedures at same assertion. Then you see you are applying more procedures means you are increasing the quality. So the sampling size could decrease. An increase in the auditor's desired level of assurance. Its desired level of, if we wanted to increase his assurance, sampling size would increase. An increase in tolerable misstatement, you know the answer, sampling size decreases because he is willing to accept a lot of misstatements to be in his work. And an increase in the misstatement, the auditor expects there is a chance of risk. So their sampling size would increase. Stratification of population when appropriate. Then sampling size decreases. Stratification is what, like they were using stratification means they are pulling up, they're grouping the things. So obviously size would decrease as they are eliminating all the unnecessary part. The number of sampling units in the population has a negligible effect. The number of units with regards to population has always a negligible effect. And that's with regards to 530. And that's it. We have completed our essay 530. And now we'll see essay 540, that is auditing accounting estimates, including fair value accounting estimates and related disclosures. There's even a question that was asked in MTPs, so listen to this carefully. First, we'll see few call-outs. That is the difference between the outcome of an accounting estimate and the amount originally recognized and disclosed in financial statement. That is, you see, due to lack of precise measurement, what the management had done some accounting estimates, and the outcome that had turned to be different from the what the management had estimated. That doesn't represent a misstatement. That's what they're talking about. And that's the same thing with regards to the prior period financial statements as well. And the objective of the auditor was to obtain sufficient appropriate audit evidence in the context of applicable financial reporting framework that accounting estimates, including fair value accounting estimates that were recognized or disclosed, are reasonable. That has to be reasonable. The accounting estimates have to be reasonable and the related disclosures are adequate. We have to see it, we have to make sure that they were reasonable and disclosures were adequate with regards to that. And for the next thing, we'll see few definitions with regards to accounting estimate. It's an approximation of monetary amount in absence of precise means of measurement. That is, a monetary amount that was not unable to be measured precisely accurately. Estimation uncertainty is that this absence of precise was uncertain. That measurement was uncertain. The suspectability of accounting estimate and related disclosures to an inherent lack of precision in its measurement. That is, they're unable to precisely measure that. That's what estimation of uncertainty would be. That uncertainty would be low in few cases and high in few cases. We'll see those. Low when the business activities are not complex. Accounting estimates are frequently updated, derived data that are readily available, and fair value accounting estimates where the method or model of measurement was made by FRF is simple. You see, the activities, the period, the frequency from the period were frequently updated, and the data and the model was simple or not. And with regards to high estimation uncertainty, the accounting estimates relating to outcome of litigation and fair value accounting estimates of financial instruments which are not publicly traded, and fair value accounting estimates which are highly specialized entity developed model. Okay, out of these were highly uncertain, high estimation uncertainty. Okay, and you have to remember these. With regards to the two more definitions, that the auditor's point of estimate is auditor, how do he obtain sufficient appropriate audit evidence? He do recalculations, etc. Right? In that recalculation, he had recalculated some accounting estimate that was auditor's point estimate. That amount that derived was in evaluating management's point estimate is what the auditor's estimate. That is that estimate amount that auditor is thinking would be fine, and the management point estimate is as per from the management perspective that monetary amount that estimate is more reliable, so it's management point estimate. This is both were the accounting estimates only, but this was calculated by auditor and this was by the management. And with that said, we'll just dive into the standard 540. What the auditor should do, he has to do his objectives to obtain understanding of the requirements of AFRF. Why he has to obtain as per objective what we have read? He have to obtain sufficient and appropriate audit evidence in context of AFRF, right? If you remember the objective, you could easily write the whole standard. Not only for this, for everything. For all standards were designed in such a way, and how management identify those transactions even that give rise to the accounting estimates to be recognized. That is, that situations where the management cannot measure that estimate, cannot measure that monetary amount, and how management makes the accounting estimate, that the method that we're using and the relevant controls with regards to that, whether management had used any expert and the assumptions that the management is taking, and whether there are any change with regards to prior period methods, and how the management had assessed the estimation uncertainty, that is low or high estimation uncertainty. How to remember this? You see, it's mostly talking about the method. What's the method, and whether the method was having any assumptions and there were any changes with regards to the method. If you remember method, then half of the answer you have done it right. And with regards to the controls, and have used any management experts and the level of degree of estimation, if you remember the objective, and another half you could write. And what the auditor has to document, what the auditor has done, he has to document that. He has to document the basis of auditor's conclusion about the reasonableness of the accounting estimate then, and the disclosures that give rise to significant risk and the indicators of possible management bias. What's the auditor objective? In order to know that accounting estimate were reasonable and the disclosures were adequate or not, he has to document how the conclusions were reached, and since the accounting estimates were done by the management, he has to also document whether there were any indicators of the management bias. and that's it. And the degree of estimation is influenced by the factors. You see, we have categorized that into low estimation uncertainty and high estimation uncertainty. On what those were based, how the factors influence that? On the period, forecast period, and availability of the data. That's what high, not publicly traded were high estimation uncertainty trade, not publicly traded. Yeah, and how frequently, and with regards to the data and the models that were used, and the extent of the estimation and the sensitivity of the accounting estimates with changes to the assumptions. With regards to estimates, you also have to write assumptions sidewise, and the extent to the which accounting estimate depends upon the judgment, as it was done based upon the judgments of the management. You have to write also about that. These 2 points were something you have to remember, and these were things, if you remember that low and high uncertainty, you could easily write the forecast period and the data and the extent of which accounting estimate, and the sensitivity, the assumptions that were done, and the extent of the judgment, and the auditor's points estimate developed by how the auditor, as we said, auditor also recalculates the accounting assumption that was prepared by the management. How auditor does that? Use that? He use a model that is commercially available for use by or auditor developed model. He can use his own developed model or was available in the market, something that relates to the model, with use of model, and further developing management consideration of alternative assumptions. Again, assumptions had come. Whenever there were estimates, there have to be assumption point. Here the assumption is he has to see the alternative assumptions and the outcomes with regards to that, and employing and engaging a person with specialized expert. When the management is doing, we have to see what the assumptions of them, and they have used any kind of expert. Even when the auditor was doing the estimates, he also have to check the assumptions models and the expertise, any kind of things, and making reference to the other comparable conditions, transactions, and events, like checking the alternatives. And these were the 4 points. You could also just compare it with how the management had done all the assumptions and the expertise, and with regards to the method or model that was being used, and both were similar. And auditors range, the range to encompass all reasonable outcomes rather than all possible outcomes. You see, the auditor has to not include all the outcomes, that is, including the rare situations and all. It has to not be that all the possible, it's not all the possible things, all the reasonable outcomes, in order to have whether they were estimates were reasonable or not. He has to eliminate all the rare circumstances and include all the things, right? Has to make sure it is narrower enough in order to provide sufficient appropriate audit evidence, and that range should be narrower. When there were any kind of deviations, then it would be treated as a misstatement, so that it would be treated as misstatement. You see, the range to encompass all the reasonable outcomes, and the auditor has to use that range so that it is narrow enough to enable the auditor to conclude whether the accounting estimate is misstated or not, and whether the auditor has concluded the auditor's range provides sufficient evidence. And a management point estimate, that is what the accounting estimate prepared by the management, lies outside the auditor's range, then it is a misstatement. And with regards to the disclosures of them, the disclosure of key assumptions, again coming assumptions. Assumption is the hero element here. Assumptions may be described as a term as key sources of estimation uncertainty, and the critical accounting estimates. Under these headings, they have to describe the disclosures with regards to the assumptions of in preparing the accounting estimates, and the qualitative disclosures such as exposures to risk, and quantitative disclosures such as extent to which the entity is exposed to risk. It is the both the qualitative as well as the quantitative impact implications also have to be mentioned in the disclosures. And that's it, we have completed our SA 540 here. Now I'll see SA 550, that is related parties. With regards to related parties, And now we'll see the objectives of the auditor, irrespective of whether AFRF, that is applicable financial reporting framework, establishes related party requirements. That is, AFRF talks about related party requirements or not. Auditor has to obtain understanding with regards to related party relationships and transaction sufficient to able to recognize fraud risk factors, like what we have learned: fraud risk factors, incentives, opportunities, pressures, or individual rationale to commit fraud, if any, arising from related party relationships or transactions that are relevant to the identification and assessment of risk of material misstatement due to fraud. Okay, we have to obtain understanding of relationships and transaction with related parties for the fraud, to recognize fraud risk factors, and to conclude whether the financial statements are affected by those relationships. Why we have to check whether the financial statements were affected or not as an auditor, why we went to the entity to form an opinion on the financial statements and internal controls thereof. So whether that financial statements were true and fair and were not misleading. And there were definitions with regards to arm's length transaction and the related party transaction. You may refer that, and we'll discuss this later. And with regards to the inherent limitations, management may be unaware of the existence of all related party relationships and transactions, and related party relationships may present at a greater opportunity for collusion and concealment or manipulation by management. These were the inherent limitations under this standard, that management is first of all not aware with the related parties and their transactions, and second thing is that those relationships provide a greater opportunity, again what, fraud risk factor, thus providing an opportunity for collusion, concealment, and manipulation by management. And auditor shall inquire what he has to do. First of all, he has to identify the entities related parties, including any changes from the prior period. Okay, first thing, related parties and the nature of relationships, whether they have control or whether through the ownership or through the like a patents or etc. With regards to the assets and all, you have to find the nature, whether the entity entered into the transaction. These were with regards to the parties relationships. This is now comes to the transactions, whether they have entered or not. If entered, whether those entered identify, account for, and disclose relationships and transaction in accordance with AFRF, and those transactions were authorized and approved significant transactions that are outside normal course of business. 2 points with regards to relationship and two with regards to the transactions. That is first thing, identifying the related parties with regard any changes to the prior period. And second thing, the nature of relationship. And third, that first with regards to the transaction is whether they have entered or not. Second thing, they have authorized or approved the transaction that are not outside the normal course of business, and the AFRF, as per AFRF, they have disclosed or not. And the thing is, auditor identify significant transactions outside the entity's normal course, what he has to do. The nature of these transactions and where related parties could be involved, he has to identify that. And auditor shall inspect. What he has to inspect? He has to inspect document. What documents with regards to the transactions? All the bank, legal, and third party confirmations and minutes of meetings of whom? Shareholders. That is what they're talking about with regards to parties who have control, significant control, like shareholders, who are promoters, etc., to meetings of TCWG and such other records and documents, all the third party confirmations and minutes, and such other documents. And the auditor should remain alert and maintain professional skepticism throughout the audit with regards to the existence of any related party relationships and transactions that were identified by the management but were not previously identified or disclosed to the auditor. And if the auditor identifies significant transactions outside the entity's normal course of business, thus not only with regards to the related parties, but to any other person that is outside the entity's normal course of business, he have to inspect what? He has to inspect the contracts. and arrangements. This is with regards to the related parties. He has to identify the nature of transaction and what related parties are involved in. This is normal parties which were we have not finalized or identified them as a related parties, but entities normal course of business, that's outside normal course of business. What you have to do, you have to inspect the contracts and whether the transaction suggests that they may have entered into for fraudulent financial reporting, like for window dressing the financial statements and conceal the misappropriation of assets. And he has to check whether they have been doing that and the terms of those transactions, and the transaction whether they have been appropriately accounted and properly adequately disclosed or not, and obtain audit evidence that transactions have appropriately authorized and approved. Whenever there comes a transaction, there comes the approvals and authorizations. What they have to do, what first thing, documents, contract documents and the terms they have, and whether they have an intention to what fraudulent financial reporting and conceal the misappropriation of assets. We have to check that. And we have also to check the objectives of the order. What's the objective of the order, whether the transactions have been appropriately accounted or not, and whenever their transaction there comes appropriately authorized and approved. Okay. And identification of previously unidentified or undisclosed related parties or significant related party transactions which have identified by the auditor, which was not previously identified by the management, or which have not been disclosed by the management. They have promptly communicate the relevant information to the other members of the engagement team, the partners. Since it's a significant matter, they have to discuss to the engagement team and request management to identify all transactions with this newly identified related party. First, we have to communicate with our engagement team members, and then we have to make a request the management to identify all transactions with this new related party and inquire why entities control failed to identify that relationship and that related party transactions. We have to question the internal controls also and perform appropriate substantive audit procedures and reconsider the risk. After we have found new information, what we have to do? We have to change the overall audit strategy and change the audit plan, etc., right? Detailed audit plan, and perform such additional audit procedures other than the planned audit procedures. And if any non-disclosure by the management appears intentional, if the intention if it is done intentionally, that are unidentification and not identification and not disclosing was made by the management intentionally, then you have to evaluate such implications on the audit. What you have to write with regards to this is management putting scope that it would cast a doubt on the reliability of the management, all the audit evidence that was obtained and the written representation that were given by management. You have to reevaluate the objectivity and the integrity of the management, their ethics and all. That's what you have to do. Okay, what we have to do when we find a new related party, first thing, we have to communicate with our member and request management that these transaction identify all transaction with this party and why this internal control failed to do so, and provide and do modifications with regards to the overall audit strategy, audit plan, and do additional audit procedures and perform substantive audit procedures. And if it is intentional, you have to also evaluate the implications of the audit, whether you have to withdraw or just modify or give disclaimer of opinion, etc. And with regards to the fraud risk factors that are associated with related parties with dominant influence, like one entity or one particular person is having a dominant influence, what all the things that he could do, the related party has voted, refused to accept. Voted is something that is to oppose or refuse to accept the significant business decisions taken by management or TCWG. That related party is having a dominant influence, like he has been having shares for 15 to 20% and all. He could do, he could refuse to accept the business decision taken by the management or the TCWG who were actively involved in the business, and the significant transactions are referred to the related party for final approval. who has to give the final approval? The audit committee has to give. But due to his dominant influence, what he could do, he could give the final approval. That's again a risk. There's a little or no debate among management or TCWG regarding the business proposals initiated by the related party. You see, first thing, the related party who is having dominant influence rejected the business decision taken by management and TCWG. And with regards to the decisions taken by the related party, there is no or little debate among the management and TCWG. That is, they have been accustomed to act. They have been accustomed to act, the management and TCWG. Heard it somewhere, right? In law. Transactions involving the related parties are rarely independent and reviewed and approved. These transactions were rarely independent and they were rarely reviewed and approved. And that's it. And now we'll discuss few points with regards to the verification, how to verify the existence of related parties. How do you have to verify those related parties? First, through entities' IT returns, information supplied by the entity to regulatory authorities like registrar or RBI, SEBI, etc., and shareholder register to identify principal shareholders, and statement of conflict from the interest of management and TCWG, and contracts or arrangements, significant contracts, life insurance policy, significant contracts that were renegotiated, and internal auditors report and record of entities investment and pension plans. You need not remember all these things. What all the things, how to remember is all the regulatory requirements, IT returns, that information supplied to the regulatory authorities, and then with regards to the shareholding and some significant contracts, etc. Write these 4 to 5 points. It was more than enough for that. And the transactions outside entities' normal course of business may include what all those transactions that we have to do. You see, where we have seen this, we have seen it here, right? Yes, here. There were few transactions that were outside from the entity's normal course of business through another party. What we have to do with that? How? What are those transactions were? The like corporate restructurings or offshore transactions with offshore entities having weak corporate laws, and leasing of premises or rendering management services for no consideration, and sale transactions with huge discounts, and transactions with circular arrangements. Circular arrangements were something that they were a series of transactions that who paid only receives the inflow of the cash. That is, who had paid. That is like taking money out from one pocket and putting it into the another pocket. That's it. And all the transactions in between were just drama. And the transactions under the contracts were that have terms have changed before the expiry, and that's it. These were all the transactions. And we have completed essay 550 also. And now we'll discuss essay 560 subsequent events. As always, we'll first see the objectives of the auditor. He has to obtain sufficient appropriate audit evidence with respect to the events occurring between the date of financial statement and date of auditor's report. Date of financial statement is the date of the end of latest period covered in the financial statement, that is audited period last date. From that date to the auditor's report, that is when the auditor had signed the auditor's report, that require adjustment, that this event is an adjusting event or a disclosure. If it is not an adjusting event, what he has to do? He has to obtain audit evidence which is sufficient and appropriate, and respond appropriately to the facts that came to know to the auditor after the date of auditor's report that may be caused the auditor to amend the auditor's report. Okay, this is until the auditor's report, date of the auditor's report, and he has to respond appropriately. He need not adjust the auditor's report, or he need not ask the management with regards to the financial statements, or else just he had to respond to the facts that have come to know with regards to the any kind of events after the date of auditor's report, which would amend the auditor's report. And the date of approval of financial statement is that on that date where the financial statements are prepared was taken responsibility for those financial statement. Those who have prepared the financial statement, who has responsibility to prepare financial statements? Management. So when management takes the responsibility of those financial statements, that date is known as date of approval of financial statements. When date of financial statements are issued, when financial statements were made available to third parties like regulatory authorities, shareholders, etc. And coming to the definition of subsequent events are events occurring between the date of financial statement, that is the end of the audited financial year, from that date to the end of auditor's report, and the facts that known to the auditor after the date of the auditor's report. This includes both all the objectives here. Here from the period, they are talking about the period, and here they were talking about the facts. So both were subsequent events only. And the financial statements may be affected by certain events that occur after the date of financial statement. There are two types. There were two types of subsequent events. One is adjusting event, and the second one is non-adjusting event. When the condition that existed at the date of financial statement, those were the adjusting events which require changes in the financial statements. And those who do not provide any kind of evidence at the date of financial statement, and those events arose after the date of financial statements, were non-adjusting events which require disclosures. And with that said, we'll move on to the 560 case scenario, what the auditor shall do. What was asked in the what he has to be do in the objectives, he has to do that in the standards. Obtain understanding of the procedures management has established to ensure subsequent events. What he has to do, he has to understand how management is establishing or what the procedures were done by the management in order to identify the subsequent events. Second thing, inquire the management that subsequent events had occurred which affect the financial statement, whether subsequent events were identified or not. Second thing, whether they affect the financial statements or not. Third thing, reading of minutes of meetings that were held after the date of financial statements, and reading the entity's latest subsequent interim financial statement, that is the subsequent year's first quarter financial reports has to check after the date of the auditor's report, but before the date of financial statements were issued to a third party, a fact became to know. This is second point in the objectives. Yeah, he has to respond appropriately. What he has to do, and a fact comes to know that he should amend the auditor's report. What the auditor shall do, in second point, how he has to respond, that he has to discuss with the management, determine he has to determine whether the financial statements require an amendment or not. In his belief, his audit report has to be amended. He's discussing with that management and asking the management whether this require an amendment in financial statement as well, and inquire how management addressed that matter in financial statement if at all the amendment was made. And when management does not amend, but the auditors believes they need to be amended. Here you see, auditors believe that the auditor's report has to be amended. And now here, auditor is believing that his audit report has to be amended as well as the financial statement also have to be amended. Then what the auditor should do? If auditor's report has not yet been provided, okay, what that he has to do, when the auditor report was not handed over to the management and we had not signed, what he has to do, he has to modify the report under SC 705. If he had not provided that to the entity, what had already provided, he had provided to the management the auditor report, what the auditor shall do, the auditor shall notify the management not to issue to the third parties, not to issue the financial statements and all. If the entity, without those necessary amendments, had issued the financial statements, then what the auditor has to do? He has to prevent reliance, he has to take appropriate action to prevent reliance on the auditor's report, like a tweet with regards to that, or consult the legal advice. Okay, this is with regards to the what auditor's responsibilities. First thing, he has to know how the management is doing the subsequent events and how they would affect the financial statement, and he has to read the minutes and read the latest interim financial reporting statements. And this is come the second point in the objective that facts have known and the auditor need to amend audit report. What he has to do, he has to discuss with the management and ask the financial statement have to be amended or not, and if so amended, how would it impact financial statement. And if auditor also believes that the financial statements have to be amended, if the audit report was not prepared and if it's not provided to the entity, he has to modify the report because the audit report is still in his hand. He could modify that. And if he had already given to the entity, what he could do, he could ask the management not to issue to the financial statements or audit report to the third parties. If the management had issued without those amendments, then what the auditor has to, he has to respond appropriately to prevent reliance on the audit report or take a legal advice. And now, or with regards to the audit report amendment, amend the auditor's report to include an additional date restricted to that amendment. So he could attach that auditor's amendment paragraph or a kind of extract of any kind of report or a small report, additional date. After the date of auditor report, an additional date could be made only with regards to that amendment and provided new or amended audit reports. He could just add that amendment or he could wholly modify the entire report and create a new auditor's report, includes the statement of emphasis of matter paragraph or others matter paragraph with regards to the such amendment. And that's it. We have completed SA 560. And now we'll discuss SA 570 going concern. And now we'll see some callouts here. Under the going concern basis of accounting, the financial statements are prepared on the assumption that the entity is going concern and will continue its operation for a foreseeable future. That when accounting of the financial statement was prepared as per going concern basis, then what they'll have be classified as a current liability, non-current liability, etc. If it was not prepared under a going concern concept, all the maturities, all the loans would come to the maturity and all. That's how the financial statements were prepared. This is the all clear cut of how the financial statements would have been. So, for a foreseeable future, means foreseeable future is the next audit term. That if it's 3 months, 3 months, 12 months, 12 months, that's a foreseeable future. General purpose financial statements are prepared using going concern basis unless the management either intends to liquidate the entity or cease operations or have no realistic alternative but to do so. This is the key phrase. This phrase, these three lines you have to write whenever you find any going concern concept. You see, these summary, these callouts are something that you have to remember, okay, and write it in your examination. That's why it was given in a special place. Okay, so this is with regards to that. And if the financial reporting framework contains an explicit requirement, the financial reporting framework contains an explicit requirement or not for the management to make specific assessment for the entity's ability to continue, it's management responsibility to assess the entity's ability to to continue as a going concern or not. You see, like this, we have seen somewhere with regards to the related parties, right? If the AFRF explicitly recommends or not, the auditor has to identify the related party transactions and related relationships. Likewise, even if the FRF explicitly provides a recommendation for the going concern or not, the management should assess the going concern concept. And coming to the objectives of the auditor are to obtain sufficient appropriate audit evidence regarding the appropriateness of the management use of going concern basis accounting. He has to check whether the going concern assumption is appropriate or not, and to conclude, okay, he has to conclude something. What he has to do based on the audit evidence obtained, whether a material uncertainty exists or not, which cast a significant doubt on entity's ability to continue as a going concern and report it as per SC. What he has to do, he has to show whether he has to obtain sufficient appropriate audit evidence that going concern is appropriate or not. Second thing, he has to conclude whether exists a material uncertainty related to the events or not. That is, an event had occurred which would cast a significant doubt on the going concern. So uncertainty is like the event had occurred that this going concern will not be applicable. Okay, it's a negative kind of word. And there were few indications with regards to the going concern assumption. What are these indicators? You could read it that, or you can take a printout of it, and it was available in the telegram. You could read it. It just what does it do is something that was anything that was of negative to the financial statements will go with like a net liability or net current liabilities position. That is a negative mark there, negative position in the financial statements or inability to pay the creditors. It was all the negative sides of it. For the operating indications like labor difficulties or loss of key management, and they have without replacement and all, and an emergence of highly successful competitors there. So those were like indicators which would cast a doubt on the going concern basis of the entity. Other indicators like non-compliances and pending legal proceedings, etc. You could just read it. And with that said, we'll just dive into the standard SF 70. Yes. What are the factors that relevant to the management assessment of the entity's ability to continue as a going concern? You see what the auditor has to do. Auditor has to obtain sufficient appropriate audit evidence that going concern concept is appropriate or not. What factors he has to check? He has to check the degree of uncertainty, whether it is material or immaterial, whether that event is material, that it would affect the going concern assumption or not. He has to check that. He has to check the size and complexity of the entity, whether as we have said for the operating indicators like a successful competitor, and with regards to the other indicators like what legal proceedings, etc., penalties and all. With regards to the complexity of those transactions and the size of the entity, with regards to the competitor and all, we have to check that. And any judgment about the future is based on the information available at the time at which judgment is made. That is with regards to the judgment of the any kind of information in which time it has taken, whether it has taken at the time when the laws have not fully been amended or when the new competitor hadn't come, likewise. And those are the factors with regards to that. And management preliminary assessment of entity's ability to continue as a going concern. In our call out, what we have seen, whether FRF explicitly required to check the going concern assumption or not, management has to do that, right? How the management has to do. If such assessment had been performed, what that has to do. The auditor shall discuss with the management on the identified events that cast a doubt on entity's ability to continue as a going concern. The management had done that assessment. Auditor, what he'll do, he will take the events or the conditions that cast a doubt on going concern. If the assessment had not yet been performed, he has to ask, okay, if you are not have done that, on what basis you are preparing the financial statements on a going concern basis, which would or whether the events that may cast, and inquire for the events that cast a doubt on the financial statement of cast it out on the going concern concept. First thing, when they have done, he will take the identify the events or conditions that were identified by the management. If have not done, on what basis they have done, and inquire the events, etc. And the auditor shall remain alert throughout the audit for the audit evidence for the events that cast a significant doubt. This is like professional skepticism. Even for the related party transactions, he has to maintain a professional skepticism throughout the audit with regards to the related party transactions, and for the events and conditions that cast a doubt on the going concern also, he has to remain alert throughout the audit. And the audit procedures, when events and conditions are identified, what he has to do, what's objective of the auditor? Objective of the auditor is to identify the events and conditions that cast a significant doubt on the going concern. Then what the auditor has to do when he found those events? When management not performed assessment, request management to make assessment. Okay, management has to do as per FRF. If I had not done, what he has to do? He has to request management to make assessment and evaluate management plans for the future actions for going concern assessment. And when entity has prepared cash flow forecast, evaluate the reliability of the data and consider whether any additional facts, information available, and request written representation from management and TCWG regarding future plans and feasibility. You see, all the audit procedures regards to the only the future plans, everything with regards to the future. This assessment, except this assessment, this one you could anyways write. And for this, the future action plans, and second thing, all the cash flow forecast and the reliability of the data, and any other reliability additional information that was available, and ask the future plans with written representation. And what's the second objective of the auditor? Second objective of the auditor is to conclude. There were four types of conclusions that the auditor may reach. First one is adequacy of disclosures when events or conditions have been identified and the material uncertainty exists. What is his objectives? Two things: to identify the events and the conditions, events or conditions that were identified that cast a doubt on going concern, and whether there were uncertain, the degree of the uncertainty, right? When that degree is material, then what he has to do? The management's plans to deal with these events and conditions and disclose clearly that there is a material uncertainty. For the 2 points he has to do, when events were identified, he has to write what? He has to report the management plans, how to deal with events or conditions. When he got this, he got like this when he found the where are they? And management plans for the future actions for the going concern concept and their future actions. He has to report here and clearly disclose there are material uncertainty exists. That's first one. And when adequacy of disclosures if events have been identified, but no material uncertainty. That is, this uncertainty is not material. Then what he has to do? He has to just evaluate the requirements of AFRF with regards to the adequacy of the disclosures of the events and conditions. Only the first point has to be written. Only for the first point has to be written. Since it is material, he has to report the future plans of the management and disclose the material uncertainty. When there were no material uncertainty, no need of future plans, what he has to do? He has to do report only as per AFRF. You have to evaluate the requirements as per AFRF. Okay, we have done with two. And the third one is the use of going concern accounting is appropriate, but there exists a material uncertainty. You see, going concern is appropriate, but there were few conditions or events that would cast the uncertainty would be material. So it's plus one condition and minus one condition. Then what the auditor has to do for the first thing, for the events and all, he has to give some adequate disclosures because the going concern is adequate. He has to express an unmodified opinion, that is a clean report, and auditor shall report there exists an uncertainty, material uncertainty for the things. When there exists a material uncertainty, he has to disclose clearly that there exists a material uncertainty. Okay, and when there were events identified that cast a doubt on going concern, he has to report the management plans. When the going concern is good, fine, he has to issue an unmodified opinion. If adequate disclosures for the material uncertainty but it's not made in the financial statements, then what he has to do? He has to qualify the opinion or an adverse opinion or give an adverse opinion. In the basis of qualified opinion, he may state that there exists some material uncertainty. Whenever there's a material uncertainty, he has to disclose that. And the fourth one is the use of going concern is inappropriate. What the auditor has to do, he has to issue an adverse opinion. And that's it. We have completed our going concern essay 570 also. Now we'll move on with essay 580, written representation. And the objectives of the auditor are to obtain written representation from management and TCWG that they believe they have fulfilled their responsibility. Who had fulfilled their responsibility? Management and TCWG. While what is their management responsibility in preparing the financial statements and design, implement, and monitor the internal controls operating effectively, which are operating effectively. So we are only concerned about the financial statements here. So they have fulfilled their responsibility for the preparation of financial statement for the completeness of information provided to the auditor. Second thing, to support other audit evidence relevant to the financial statement. You see, written representations support the audit evidence. They are not substitute to the audit evidence. Okay. To respond appropriately when written representation requested by auditor provided or not provided. That is, auditor has to respond with that. The date of written representations shall be as near as practical to, but not after the date of auditor's report. That is, after the auditor's report, it has to not be written have to not be taken. Written representations have to be taken prior to signing of the audit report. And audit evidence obtained is not sufficient without obtaining the confirmation from the management that is believes that it has fulfilled their responsibility. That is, yes, written representations are not substitute to the audit evidence, but they support the audit evidence. They are supporting these written representation are supporting the audit evidence, which itself would not be self-sufficient. So the management, we are having a written representations which confirming beliefs that management had fulfilled their responsibilities. And here are few types of some additional written representations about the financial statements, and with regards to specific assertion, few written representations are there. Will you could just read it once. You see, additional representation with regards to financial statements is the policies through which it has been preparing the financial statements were appropriate, and the carrying value with regards to the classifications of assets and liabilities which were both contingent and actual had been there, and the title with regards to the assets that were pledged and collateral. By the way, the difference between set off, pledge, mortgage, we have discussed that in Keyword Kit series, right? Do check that out also. And aspects of the laws and regulations and all with regards to the how within the environment in which the financial statement have to be prepared. This is not so important, but it would be very nice if you write, if it gets a direct question, or you could write that if it's just like what all the things that instead of specific, what are the policies and procedures, laws and regulations, and with regards to the carrying value. And these were the written representation you have to take for the financial statements. And for the specific assertions like past history and choosing a particular course of actions, like to accept this investment policy or not, like that, and entities' ability to pursue specific course of action, both were mostly the same, and the entities' lack of any other information that might have been obtained during the course of the audit, which was inconsistent with management's judgment. And you see, this is not so important. And with that said, we'll just dive into SF 580. First thing, written representation about auditor has to obtain written representation in supporting of audit evidence. Okay, what the written representation have to be? For the preparation of financial statement, that management is taking responsibility in the preparation of the financial statements, one thing, and relevant information provided and completeness of the transactions. Have you heard something like this? It is the premise of the management. Yes, premise of the management, that the management like it has responsibility in preparation of financial statement and all the information that was given to the auditor, and it would cooperate and it give all the books of accounts and all the additional information and all. Have you remember, if you remember the premise of that, that is what they are talking about. And with regards to the doubt as to reliability of the written representation, when the auditor will have a doubt on the written representation's reliability, when if the auditor had concern about the competence, integrity, and ethical values or diligence of the management. We have discussed this. You see, when auditors had found some fraud, what will have? It would cast a doubt on the integrity and ethical values of the management, which would also bring a doubt on the reliability of the written representations. This is our discussed point earlier. If written representations are inconsistent with the audit evidence, you see, written representation has to be in support to the audit evidence, but here they were contradictory. So then also they would cast a doubt on the reliability of written representation. If the auditor concludes that the written representations are not reliable, they haven't given any reason for that, but auditor finally concludes that they were not reliable, and the auditor shall take appropriate actions. This is again the objective of the auditor, to respond, including determining the possibility effect, whether he has to modify as for SC 705. Two things which would cast a doubt on the reliability. First thing, when has concerns with regard to competence, integrity, ethical values of management, and they are inconsistent with the audit evidence. And finally, they have not given any reason, but auditor concludes that they were not reliable. And auditor, what he has to do, he has to take respond to that, and if he requires, he could modify the report. And if management does not provide one or more than requested written representation, if management has not provided written representations only, what the auditor has to do, when management was not doing the work or not providing the information or putting a restriction on the auditor's work, we discussed in our keyword kit series, right? Same thing has to be written here. It repeats the same thing. Discuss with the management and re-evaluate the integrity of the management. If they're found reasonable, you have to alternative audit procedures and all. If not, you have to modify the report. This is the same thing. Discuss with management, re-evaluate the integrity of the management and the reliability of the representation that were taken. Take appropriate action like possible effect on the opinion in audit report in accordance with SC 705. And recon reconfirm the understanding of management responsibility in written representations. That is, you take a written representation confirming that the management has understood its responsibilities. Those who sign the terms of the audit engagement on behalf of the entity no longer has relevant responsibility. You see, when you have to reconfirm the responsibilities of the management through written representation, when those who signed the audit engagement, in audit engagement letter, we have what? Responsibilities of the auditor as well as responsibilities of the management and the scope, etc. Right? You see, those who signed the audit engagement were not no longer have the relevant responsibilities. That's one thing, that's change in management. Second thing, the terms were prepared in the previous year. And second thing, the terms were misunderstood and there were change in circumstances which make it appropriate to do so. That is when, like, change in management and change in the terms or misunderstood or change in circumstances. And where the current management was not present during the audit period that was referred in the financial statements or the period of audit. There was a new management that had been there. So this such person may assert that they do not were in a position to provide all the written representations because they were not in place during that auditing period. So this would not diminish such person's responsibility for the financial statement as a whole. So even they were there in the auditing period or not, those responsibilities, those management responsibilities would not diminish the financial statement as a whole. The written representations relate to a matter which are material to the financial information, then the auditor should seek corroborative audit evidence from other sources inside and outside the entity. That's like a written represent. It's just a call out here to just remember that if it's something that was material, he has to obtain information or have to obtain audit evidence from various sources. And auditor should evaluate whether written representations were reasonable and consistent. Reasonable and consistent with what? All the other audit evidences. And she'll consider whether individuals making such representations can be expected to be well informed on that matter. And written representation cannot be a substitute for the audit evidences. And we are expecting that those who are giving the written representations are have proper information and they are well informed with that. And written representations shall be in form of a representation letter. Why we have given this? For the MCQ purpose. Written representation letter addressed to the auditor. It's like they are communicating to the auditor. And that's it. We have completed our 500 series with this. And now we'll move on with S600. First, we'll see few call outs here. Yeah. Principal auditor means the auditor with responsibility for reporting on financial information of an entity which is having one or more components. Components would be like any division, branch, subsidiary, associate, anything. Audited by another auditor. Those were audited by another auditor and he is auditing for the whole entity. The other auditor means who is auditing that component, specific division or branch. And When the principal auditor uses the work of another auditor, he has to determine how the work will affect the audit. That's another call out. He has to just determine that. And with regards to the division of responsibility, when the principal auditor has to base his opinion, that is, principal auditor's opinion, it was based on the financial information of the entity as a whole, relying upon the statements of the reports that were audited by the other auditors. That was, his opinion is based upon the reports of the other auditors, which would clearly differentiate the division of the responsibility for the financial information by indicating that extent which the other auditors were responsible. And this would not decrease the responsibility of forming a reasonable assurance or forming a correct opinion or reasonable opinion with regards to the whole financial information of the entity. This would not diminish the responsibility of the auditor. And with that said, we'll just move on to SA 600, where before acceptance as a principal auditor, what the auditor has to do. Like any other auditor, what he has to do, he has to estimate his competence first thing and the management reliability there. And now the materiality of the portion of the financial information, how material there were financial information he was being audited for that entity as that particular component, and the principal auditor's degree of knowledge with regards to business of the components, SQC1, and risk of material misstatements in components audited by the other auditor. What are the risks that he is expecting with regards to the components audited by the other auditor, and the performance of such additional procedures with regards to the components audited by the other auditor. These two were with regards to the other components which were audited by the other auditor. The risk of material misstatement, first thing, and the performance of additional procedures with regards to those other components. And first thing is materiality of the financial information. Okay, fine. And that's the thing that was out of box from which we usually learn. And second thing is the principal auditor has to know whether he was competent enough and he has capability to do the audit or not. This is as per SQC1, and it's as simple as that. And what the principal auditor should do before using the work of the other auditor who is auditing the components, right? Other components. First thing, he has to advise what he has to advise the other auditor with regard to use of his work and report. Advices like communication. Make sufficient arrangements for the coordination at a planning stage of the audit, like exchange of emails or just knowing how the communication has to be, whether it's written or electronic form, and how, to whom they have to address and what timings, etc. Advise the other auditor of the significant accounting and auditing requirements and reporting requirements, and obtain representation as to compliance with them. That is, we are taking a representation. That representation, any written representation means what? Accepting the responsibility for that matter. Then we are taking with that representation that the other auditor is responsible for that. He complaining, he complying with the accounting, auditing, and reporting requirements, and he's like that. And the inform the timetable for date of completion of the audit, and inform areas which require special consideration. First, what he did that he just communicated. Advice here means it's a communication. Okay, it's not a like an advice, free advice that we give to anybody. Just a communication. This was mostly used in banking terminology and all. With regards to advice means also means communication. Okay, advise the first we have were communicating the use of his report and make sufficient arrangement for the communication and all. And second thing is that we are taking written representation like an oath that he will be complaining. Who is complaining? Other auditors complying with the accounting, auditing, and reporting requirements, significant which are significant, and inform the timetable and the areas. That's it, timetable and areas. And here taking a written representation that he is responsible for complying with that and communicating we use that work and making sufficient arrangements. That's what he has to do before using the work of the other auditor. While using the work of the other auditor during the audit, he may visit and examine the records of the branch, that what the other components he is using, and nature, timing, and extent of procedures depend on that he also have to what the auditor has to do before accepting, have to perform such additional procedures regarding the components, right? What he has to do, he is doing some like changing the nature and timing and extent with regards to the circumstances and materiality and principal orders auditors knowledge of professional competence of the other auditor. Depending upon the circumstance and materiality, the nature, timing of extent of the process of change, and principal auditor's knowledge of the professional competence of the other auditor. Other auditor's professional competence would also affect the nature, timing, extent of the procedures. And this knowledge may have been enhanced from the review of the previous audit work of the other auditor. It's like obtaining like information with regards to the other auditor from his previous work. And these were the things that the principal auditor has to do. He may visit and examine the records. He may change the nature, timing, extent depending upon the circumstances and materiality and professional competence of other auditor, and the knowledge that he had with the other auditor from his previous audit work. And other auditor found significant findings in that branch, division, or joint venture, etc., subsidiary, and the principal auditor may consider it appropriate to discuss with other auditor and management of the component the audit findings or other matters affecting the financial information of the components. Auditor may consider it to discuss with the other auditor and the management and how they are affecting the information, financial information of the components. And he may also decide at to, you see, auditor had already found the significant findings in that particular audit. Now, what principal auditor has to discuss with the management of component and other auditors, its significant effect or its effect on the other components, other subsidiaries or other branches, divisions, etc. And he may also decide as to the application of supplement test of records of or financial statements of that component. Such tests may be performed by the principal auditor or the other auditor. These were the supplement tests he could also go for. And where the auditor's report is other than unmodified. That is, he had other auditor report had given a modified opinion, then what? The principal auditor should document how he had dealt with such qualifications or remarks in the other audit reports in framing in his own report. He also have to refer to that. What we have to do, what when other auditor finds significant, he has to discuss with the other auditor and management of that component with on the financial information of other components and do supplement tests either by principal auditor or other auditor. And when there were a modified report, then he also have to document how the other auditor had dealt with those qualifications, how the coordination between should be the principal auditor and other auditor should be. There should be this is actually a direct question, but we'll just go how we have to do that. Sufficient liaison between the principal auditor and the other auditor. There should be a proper arrangements and all. There should be some trust and all, and the other auditor should coordinate with the principal auditor. Okay, that's what the question is also about. They have to coordinate. Yes. Principal auditor should advise the other auditor any matters having the important bearings. Like the same thing, what he has to do here is communicating some important areas for the special consideration. He's doing that right now. And the principal auditor may require other auditor to answer a detailed questionnaire. This is again a special point to remember here. And what the other auditor has to do, he has to respond to the questionnaire. That's it. A sufficient license, a coordination should be there and advise all the important areas. And they have to, principal auditors may require to answer a detailed questionnaire and the other auditor has to respond to that. And now, while reporting, what the principal auditor has done, if audit everything has been completed while reporting, principal auditor has to express a qualified opinion or a disclaimer of opinion when principal auditor concludes that the work of the other auditor cannot be used. If it cannot be used, what he cannot obtain sufficient appropriate information from that component, right? There's a restriction on the scope. That's what they are talking about. For that, when there was a restriction on scope, what you have to do, you have to qualify the report or give a disclaimer of opinion. That's what they're talking about. He may give qualified opinion or disclaimer opinion when he cannot use the work of other auditor and had not performed any sufficient additional procedures. It could not be obtained even after alternative audit procedures. Then this would be a limitation of scope. You have to qualify or give a disclaimer of opinion. And if the other auditor issues a modified report, what he has to refer it to the same in his report. First thing, and for here it is, if the other auditor issues a modified auditor's report, the principal auditor should consider whether his report also requires a modification or not. If it's an immaterial component, in immaterial, like say 2% of sales comes from that division or that branch, then that's not material, right? He need not modify that report. But if it's a significant component, like it comprises of 30% of the sales, then they would cast a like a situation where the principal auditor also has to modify the report. And that's it. We have completed SA 600. And now we'll see SA 610 here using the work of internal auditors. The objective of the external auditor, that's B, where the entity has an internal audit function. For few entities, for few classes of entities, internal audit is mandatory, right? For that, those have internal audit function, and the external auditor expect to use the work of that internal auditor or to modify the nature, timing, extent of the audit procedures that they were also allocating for that to be performed directly by the external auditor, or use the internal auditors by a direct assistant. First thing, they're using the work of internal audit function. Second thing, they were using direct assistance from the internal auditor himself. What are his objectives when he used that? To determine whether the work of internal audit function or direct assistance from internal auditors can be used. First, he has to check whether he could use that or not, whether that would be okay or not, whether that would be adequate enough to use that in appropriate or not. First, he has to determine whether the work or direct assistance is appropriate or not to use them. And but if using, okay, he found that okay, it's fine to use that because the internal auditor function they have objectivity and then etc. Their integrity and have ethical values and they have particular competence and all. He thought, okay, they can use the internal auditor's work or take direct assistance from him. If using the work to determine whether that work is adequate for the purpose of audit or not. First, we have to check whether that internal auditor or audit work has to be used or not. Second thing, whether that work is adequate enough or not. While taking the direct assistance, what the auditor has to do, he has to direct, supervise, and review the work of the internal auditor while taking direct assistance. That is the objectives of the auditor. And now, what are the responsibilities of that? What are his objectives? Are his responsibilities? External auditor's responsibilities not reduced while using the work of internal audit function or taking direct assistance. Likewise, and you see what they are saying the external auditor responsibility is, it was mostly tested in MCQs or some case scenarios. How is that a management fraud had happened and it was found by the internal audit function. Okay, now this external auditor has to report that or not. There's a question there. You see, you have to write this. Uh, what you have to write, the external auditor's responsibility will not be, you see, instead of placing that external auditor, you could write that name that was given in the case scenario itself. Those auditors would not be diminished or reduced by the internal audit function that was there. Since they were reporting, it's not that he was free from reporting that. His responsibility also will be there for that fraud. So he's independent to the internal audit function or his responsibilities. So the fraud, even though it was reported by the internal audit function, he also have to report that fraud. That's what the responsibility they are talking about. And any kind of responsibility with regards to the omission of any amount or disclosures. You see, these are all why he went to the audit the financial statement, what they contain. They contain all the amounts or the disclosures, etc. First, responsibility was not reduced, and with regards to any kind of omission of amount or disclosures and incorrect accounting estimates and judgments that were taken by the management, whether they were unreasonable, etc. And then policies, accounting policies that the financial statements were prepared were inappropriate. These were the external auditor's responsibility that refer to that. And with regards to that, and what is this essay mostly talks about the usage of work of internal auditor or take direct assistant. There were two categories. Every point goes into two tracks, right? First thing, before using the work or before taking the direct assistance from internal audit function or internal auditor, what the external auditor has to do while determining whether the work could be used or not. First, he has to check objectivity, competence, and his approach of the quality controls. Okay, what he has to do. While not only the internal auditor, while using the work of the management expert or the other auditor or any kind of auditor's expert also, while using somebody's work, what we check? We check the competence of them and their objectivity and their ethical values or the quality standards they were following, and any kind of works or the knowledge degree, etc. We'll check that. And here we are seeing the objectivity of the internal auditor, and they're not objectivity means not showing any kind of bias. That's one thing. And second thing is the level of competence of the internal auditor and how well they could perform the internal audit function and approach of internal audit function, including the quality control, how they were doing approaching to any kind of misstatement or irregularities or any kind of deviation, how they were performing the audit procedures while using the work, and while determining whether they wanted to use the direct assistance, what he has to check. He has to check again the objectivity and the competence. That's it. He has to check whether there exist any threats for objectivity, and whether he has to determine the level of competence also. And after all this determination, before that is this is or this is done before, right? Now, the external auditor determined that he will use the work of the internal audit or take direct assistance. Then what he has to do? While using the work of internal audit function, what he has to do? The nature and scope of work of internal audit function and its relevance to the external auditor's overall audit strategy and plan. That's again we have seen in the objectives, right? What? First, he has to determine whether they could use that or not. That's what we have discussed prior. Now, what we are going to discuss whether they were adequate or not. That work is adequate or not. With that, they were relevant or not, and making all the significant judgments in preventing undue usage of the internal audit function. These 2 points you have to write. And while taking direct assistance, the amount of judgment. You see, judgment was mostly involved here, right, with regards to the usage of the internal audit function or taking direct assistance from the internal auditor. Mostly the judgment was mostly involved here, and assess the risk of material misstatement. And an external auditor being sufficiently involved in the audit, they have to communicate TCWG and document the above things. That how they were using what or type of what the areas he was using the work from, or from what all the things, or what are all the things that were given to the auditor for the direct assistance and all. And while using the work and taking direct assistance from the internal audit function, what he has to do? He has to discuss the planned usage of the audit function. That's the scope of the internal audit function they were using, and read the internal financial statements, etc., and perform sufficient audit procedures to evaluate the internal audit function. Okay, he has to discuss what all he is using that, and read the report of internal audit functions and internal audit report, and perform sufficient audit procedures to evaluate internal audit function. Its internal audit function is mostly like internal controls, right? It's a part of internal control system. And while using the direct assistant, what he has to do is obtain written agreement from the entity, written agreement from the internal auditors. Entity here refers to the management, and direct supervise and review the work performed by the internal auditors. That's what we have seen in this third objective. You see, while using the internal auditor, you have to not use what all the matters that were done by the internal auditor himself. Like if the internal auditor had done some X category of work, you have to not take direct assistance from the same work. That's like a self-review threat. Okay, and you have to not use the significant judgments that the auditor has to take. These were the 2 points you have to remember in extra from this PDF I have missed here. And this is like mostly like behavioral science. You see, it's a self-review thread. One who does the work cannot review the work or cannot audit that work that exists there. And so, moreover, you have to not believe or rely in the audit procedures or the things that require SCs to do by yourself, to obtain the information directly by yourself through internal auditor. Okay, you have to not do these two things. First thing, you have to not assign the work to the internal auditor that he only had performed to review. Okay, that's first thing. What's first thing is talking about the one who does the work should not review the work. Okay, and second thing is all the significant judgments or that was wanted to, like, what fixing the materiality or performance materiality and assessing the risk of material misstatement, all the things that have to be done by the auditor himself as per standards of auditing, right? You have to not assign that to the internal auditors. And with that said, we have completed our SA 610, and now we'll discuss SA 620 using the work of an auditor's expert. That is the expert that was employed by the auditor. He's not employed by the management. If it's employed by the management, it is management expert. Okay. And with that said, first we'll see the objectives of the auditor with regards to SA 620. First thing, what he has to do to determine whether to use the work of an auditor's expert or not. We have seen something similar to like this, right? While using the work of internal auditors or while using the work of management expert also, first he have to determine whether he could use that or not. It depends upon that, and whether that work was adequate for the audit purpose or not. Similarly, all the 600 series talks about that. First, the auditor has to determine whether he could use that work, whether because it's a question like whether the internal auditor or the other auditor or the auditor's expert here as having that integrity or competence, or they are having any kind of ethical requirements and all. We have to check for that. And after that, the work, whether it would be adequate for our audit purpose or not. And this is generic. And the auditor shall not refer to the work of the auditor expert in unmodified audit report unless required by law. You see, whenever auditor is giving a clean report, then he need not refer the auditor's expert name. If at all he is giving a qualified opinion or something, he could refer the auditor's expert name, but that does not diminish, that does not reduce the auditor's responsibility for that opinion. Okay, when giving a clean report, he need not refer auditor's expert name unless required by law. And if he is giving a modified opinion, that's qualified opinion or disclaimer of opinion or an adverse opinion, he may refer to the auditor's expert name, and that reference would not reduce the auditor's responsibility for that opinion. And now we'll see what are auditor's responsibility, what are his responsibility, his objectives, what is responsibility, why the auditor had got, he had went to form an opinion on the financial statement. You see, auditor has the sole responsibility for the audit opinion expressed, and the responsibility is not reduced by the auditor's use of that auditor's expert. That's what we have discussed in the summary, right? That thing. If the auditor, if you see, if these all the things that were in colored could be asked in as a direct question. Even if you don't remember this precise, you see, in that hurry, we don't find audit is, I think, as per all the subjects, audit is a lengthy subject which for which the time wouldn't be sufficient. And moreover, for the standards on auditing, what do? We usually put it at last, right? For that, if at all you have, might have not read all the PDFs with regards to this, which you have taken printouts or not. If you don't have, at least read the summary portion. If you read the objectives itself, it would be you're half done with the standards of auditing. Okay, you're half done with the, if you know the objectives of the auditor, and that's it. Okay, this is what we are talking about in the summary section. That summary section is that important. And if the auditor concludes that the work of auditor expert is adequate for his purpose, he may accept the expert findings and conclusions. That is the second objective. when he found that audited experts work is adequate, then he might use the experts findings and conclusions. Then that's his responsibility. And with regards to the agreement, like any agreement, see the agreement with regards to the engagement, like an engagement or audit report, sorry, engagement letter of engagement, it's kind of agreement between the management and the auditor, right? How we define the terms of that. First thing, what it has to contain responsibilities of both the parties and the work they were doing. What with regards to the work, like the scope and within what time it has to be completed, or whether any kind of format that has to be given as per the laws, or any kind of reporting framework or etc. And these were the things. And we'll see with regards to the agreement between the auditor and auditor's expert, the nature and scope and objectives of the work, okay, work, and the respective roles of the auditor and the expert. Two things done. And third one is the nature, timing, extent of the communication, how to communicate, okay. And the need for the auditor's expert to observe confidentiality requirements. You see, the communication was also used in SA 600 with regards to use of the other auditors' work, right? There also we have come across this point. So whenever they were agreeing to the work, or whenever two people were coordinating, we also have to determine the way of communication, and that's it. And you see, that's normal way how do we behave in our usual day-to-day life, that's the thing, but using some specific words here. In usual terms, we don't use nature, timing, and extent and all. We'll just the way of communication. For this examination purpose, in order to get marks, these were the keywords to just put these phrases to gain you marks. That's it. And the need for auditors expert to observe confidentiality requirements, and confidentiality requirements also. Two things we have already known, and the special things that we have to remember is the communication that we have seen as per SA 600, and the confidentiality requirements. And okay, and evaluating the adequacy of the auditor's expert. What is the objective of the auditor? To evaluate whether the work of auditor's expert is adequate or not. How would he do that? He would evaluate that adequacy by the relevance and reasonableness of findings and conclusions, relevance and reasonableness of the assumptions that were used by the auditors, relevance and completeness and accuracy of the source data. This is a direct question you have to remember. This is similar to that we have discussed earlier. Relevance and reasonableness of the findings and conclusions, relevance and reasonableness of the assumptions and the method, relevance and completeness and accuracy of the data. Whenever we find data, what we have discussed earlier, the adjectives that have to come with regards to the data is either sufficient or appropriate if you're as an auditor, with regards to the depending upon the situation, and completeness and accuracy. And with regards to the types of the reports or opinions auditor can obtain from the expert or for the audit evidence, that is they're talking about the scope in which he could use the auditor's expert, that is with regards to an evaluation of all the assets and liabilities, and including impairment assets and business combinations, and any kind of actuarial calculations with regards to insurance contracts, any kind of estimation of oil and gas reserves. Okay, oil and gas reserves estimation, because it's something that was very different from the auditing perspective, right? Auditing field. And valuation of some environmental liabilities and cleanups. You see, all these were something that related to the natural resources, environmental, and interpretation of contracts and laws and regulations. What the thing first? What does financial statement contain? These two things, right? Valuation of complex assets and liabilities, and actuarial calculation of insurance contracts, estimation of oil and gas reserves and environmental liabilities, etc. Setup clean costs, these regards to the environmental things, and interpretation of contract laws and regulations. If you categorize these things, it is very easier for you to write it in examination than remembering all the 5 individual points. And analysis of complex or unusual tax compliance issues, etc. And with that said, we have completed our SA 620 also. And now we'll go on with SS 700, that is forming an opinion on reporting on financial statements. As usual, we'll see the objectives of the auditor first. They are to form an opinion on the financial statement based on the evaluation of the conclusions drawn from the audit evidence obtained. That is what he had come to, why he had come to the entity to form an opinion on the financial statement. It was addressed here as a 700 to form opinion on financial statements based on the conclusions drawn from the audit evidence obtained. To express clearly that opinion through a written report. First thing, he has to form an opinion, and how he has to communicate. He has to communicate through a written report. And now this is what all the things that we have in our auditor's report. Title, addressee, auditor's opinion, base of opinion. We'll see with an example now, just to remember it in a go. Yeah, this is independent auditor's report of Tata Motors for the year end 31st March 2021. Okay, now with regards to the title, this is the title, independent auditor's report, and they're addressing that. To whom they were addressing? To the members of the company. And auditor's opinion. See, the opinion paragraph is here. And basis for that opinion, they have given a basis for opinion for that. And with regards to the going concern, they have described it in auditor's responsibility. They have not given a, yeah, they have discussed it here somewhere around, yeah, going concern basis, etc. They are concluding that it was okay with regards to a sub part of the auditor's responsibility. And with regards to the key audit matters, they have given key audit matters also, key audit matters and their description of the key audit matters as such. And responsibilities for the financial statement, that is, this is the responsibility of the management. Preparation of financial statement is responsibility of the management, right? This is what the responsibility of the management in preparing the financial statements, as it's in accordance with accounting policies, Ind AS and all. And auditor's responsibility, they're talking about auditor's responsibility in audit of the financial statements, that they're to obtain a reasonable assurance and all. And then the location of description of the auditor's responsibility and other reporting responsibilities with regards to any kind of other matters, and reporting on other legal and regulatory requirements and all. And at last, the signature. The signature is a digital signature UDIN of the partner, and the place of signature, that is Pune here, and the date was 18th May 2021. This is, and these are the elements of the auditor's report. And with that said, it's a 700 here. Auditor's opinion. The opinion section of the auditor report shall, what it shall do, it shall identify the entity and state that financial statement have been audited, identify the title and refer to the notes, whether there were summary of the significant accounting policy, and specify the date or the period covered. We'll see whether that this has that or not. You see what they're addressing. To identify the entity, they have identified the entity as Tata Motors Limited. I will just move on fast because it's a revision series, right? We'll just discuss it later in any application based batch or something like that. For an audit marathon, we have to move on quickly. And to state the financial statements have been audited, they're saying that they have been audited, the financial statements of that entity. And second thing, identify the title for each statement. They have identified like a balance sheet, P&L account, and changes of equity, standalone financial statements, and of cash flows for the year ended, etc. And refer to the notes of accounts with significant accounting policies, like you see, including the summary of the significant accounting policies and explanatory information, and specify the date or the period covered. You see, they have covered the period for the year ended 31st March for 2021, and this is with regards to that, with an example and for the basis of opinion what they have to do. You see, how to remember all these points was that to see a normal audit report. Okay? At that time, when you know how an auditor report was formed, you cannot do that at while before the examination, but with a common sense, like what, while communicating a particular matter, how you could frame like think. And most probably nowadays ICI is also asking to form a to give an extract of the basis of opinion paragraph or give an opinion paragraph and all. It's better to just go through this PDF. It has only 2 to 3 pages, I guess. Yeah, or 3.5 pages. You could just scan it once, and so that you'd be able to write it and understand how an auditor report would be. And with that said, we'll just go with basis of opinion. First, what it has to do, it has to state that the audit was conducted as per standards on auditing. You see, auditor has to do audit as per standards on auditing. Refer to the section with regards to the auditor's responsibilities under the SEs and include the statement that auditor is independent of the entity. That is again that he followed the SQC one, and state whether the auditor believes that the audit evidence is the auditor has obtained sufficient appropriate audit evidence. You see this basis of opinion paragraph, that audit was conducted as per standards on auditing, and they have given the section for their responsibilities, and they have said that they are independent with the code of ethics and all, and they were also complying the ethical responsibilities and all, and they have obtained sufficient and appropriate to form our opinion on the financial statements, etc. These were the things that were should be given in the basis of opinion paragraph. And with regards to the auditor's responsibility, obtain reasonable assurance about whether the financial statement are free from material misstatements and issue auditor's report, which includes that they have maintain professional skepticism and they had done professional judgment and all, and identify and assess the risk of material misstatement, and that they have communicated to TCWG and all the 3 points have to be given. And the supplementary information presented in the financial statement, how they were presented, it was presented as like this. As with regards to additional information, the below are supplementary details of Tata Motors Limited with regards to two joint operations and all. This is how they were presented, the balance sheet and the P&L account and all. And that's how the supplementary information was presented, which was not required by the AFRF. And auditor has to evaluate whether they were integral part of financial statements or not. If they were integral, then auditor's opinion also shall move. That scope also increases to that integral part. If not, what the auditor has to suggest the management that it should clearly present in such a way that it clearly differentiates it from the audited financial statements. That's how the if the management refuses, then auditor shall identify the unaudited supplementary information and explain in the auditor's report that it has not been audited. And this is with regards to the supplementary information. And we have completed essay 700. And now we'll discuss essay 701, communicating key audit matters in the independent auditor's report. We'll go with the objectives first. Objective of the auditor is to enhance the communicative value of the audit report by providing greater transparency about the audit that was performed. Second thing is to assist the user in understanding those matters that, as per auditor's professional judgment, were most significant in the audit or financial statement of the current period. First thing, to enhance the communicative value and to assist the user that these were most significant items, significant matters in the audit. We'll see the definition of key audit matters were most significant as per auditor's professional judgment in the audit of financial statement of the current period. This is the second objective of the auditor. The key audit matters are selected from the matters that were communicated to TCWG. If the matters that were not communicated to TCWG, then those matters have to not be form part of key audit matters. Since they were so most significant for the user understanding, they have to be communicated to TCWG. And this applicability of 701 key audit matters would be applicable to complete sets of general purpose financial statement, whether it be CFS or SFS, for a listed entities, and circumstances when the auditor decides to communicate key audit matters and required by law or regulation. Listed entities when auditor fails to communicate, and as per laws and regulation. And a call out is, remember, this is something that was widely asked as per SS 705, prohibits the auditor from communicating key audit matters when the auditor disclaims an opinion on the financial statement unless such reporting is required by law or regulation. Why this was said? You see, disclaimer of opinion was asked when you don't find any kind of sufficient and appropriate audit evidence. When this key audit matter was given, when audit was done super fluently, and you have communicated to TCWG and all, everything happened good, and you have a few matters that which a user have to put some emphasis on. That's it. Both were two different scenarios. Something you have properly communicated and proper, you have got sufficient and appropriate evidence to communicate to the users of the financial statement is key audit matters. Something you cannot you cannot form an opinion on, you did not find any audit evidence, is when you form disclaimer of opinion. That's why these both are exclusive things. Okay, and now we'll just go on to the SA 701. Communicating key audit matters is not what is it should not be. It should not be a substitute for the disclosures. It should not be a substitute for reporting under SA 570 going concern, a separate opinion on the individual matters, and the substitute for the auditors expressing under modified opinion for SA 705. We'll see how the key audit matters were communicated here. Yes. Key audit matters, or those matters in our professional judgment, that's auditor's professional judgment, were most significant in the current period, and the matters were addressed in our audit as a whole and forming opinion thereon, and we are not providing a separate opinion on these matters. This is one point. That in the communicating of financial statement, there's a third point. Going concern disclosures and modified opinion also has to be included there. And while determining the key audit matters, what all the areas you have to consider? The areas which have high assessed risk, the significant risk involved, and significant auditor's judgment, and they have significant events and transactions. We'll see in this report what they have discussed. They have discussed about some impairment reversal and all. That's something a significant estimate, right? A significant material estimate. So they have communicated that as a key audit matter. And communicating key audit matters are those matters that in professional judgment they are more significant in the audit, and these matters were discussed in the financial statement as a whole, informing auditor's opinion, and the auditor does not provide a separate opinion on these matters. Have you read these somewhere? In the auditor's report only, in our auditor's report, all this matter was given there. It's like an extract of that. And that's it. We even have completed SA 701 with regards to this. And now we'll go on with SA 705, that is modifications to the opinion in the independent auditor's report. We'll go with the objectives of the auditor first. The objective of the auditor is to express an modified opinion. That is not a clean audit report. When auditor concludes that based on the audit evidence that was obtained, the financial statements as a whole are not free from material misstatements, or they're not able to find sufficient appropriate audit evidence. This is when a disclaimer of opinion has to be given, and this is when a qualified opinion has to be given. And everybody knows this table, right? We'll just move on with further that. We'll just discuss that later. And first one is inability to obtain sufficient and appropriate audit evidence by limitation of management. Even we have discussed in our keyword kit series and all time, right? What we have to do, what the auditor has to do. First, he has to ask the reasons for that limitations, and then he has to obtain they were reasonable or not, and if not, they have to communicate to any other higher authority in case it's management, right? So they have to go, if they have TCWG in that company, and determine to obtain the audit evidence through, if he finds reasonable, to obtain that by audit evidence through alternative audit procedures, and if they were not reasonable, the auditor has to withdraw. When while withdrawing, what he has to do, he has to communicate to the TCWG or any other reporting regulatory authorities, etc. And that is with regards to limitation of management, limitation of by the management. And if the auditor is unable to obtain sufficient and appropriate audit evidence, what he has to do, if the auditor concludes that the possible effects on the financial statements of undetected misstatements could be material but not pervasive. Pervasive means all the financials, all the matters in the financial statements. We'll just go with an a report here. You see, this is a report of Air India Limited. They have given a qualified opinion. In that, what they are saying, in our opinion, with the information and explanation given to us, except for the possible effects of the matters described in some emphasis matter paragraph. That is, they were not pervasive. That is not all matters. They have given some exceptions to few matters. Okay, and they have used the word the possible effects and all. Even here, even in the standards of accounting, we also have the possible effects on the financial statement that were undetected and they were not pervasive. Not pervasive is communicated as an indirect thing, like except for some matters, para G, like now here para G of emphasis matter paragraph, like that. And if auditor concludes that the possible effects on the financial statements of undetected misstatements could be material and pervasive. Material and pervasive, then what he has to do? He has to form a adverse opinion. That's what in our table, right? Material and pervasive with regards to the matters in financial statement, which were misstatements, adverse opinion. And yes, misstatements in the financial statements, withdraw from the audit, or if withdrawal from the audit before issuing the audit report, it's not practicable, then give a disclaimer of the opinion on the financial statements. Okay, we'll see the adverse report and well as a disclaimer of opinion. Now, you see in this adverse opinion, what they have said. They have said that the matters that were discussed and therefore statements that did not give the information that was required by the act and all, and the financial statements do not give a true and fair view with regards to the accounting principles or Ind AS and all. That's how they have communicated. And with regards to disclaimer opinion, what they have communicated is that we do not express an opinion itself. That's what they have communicated because they have not able to obtain sufficient and appropriate audit evidence. Okay, this is how the matters were being communicated. These are all the phrases that we use. And with regards to the adverse opinion or disclaimer of opinion, when the auditor considers it's necessary to express an adverse opinion or disclaimer of opinion, when we use adverse opinion or disclaimer of opinion, when the matters were adverse as well as pervasive, there were not some possible effects except few matters like what we have in qualified opinion, like that a paragene emphasis matter paragraph, right? Like that. Shall not also include an unmodified opinion with respect of the same FRF. That is, when he was giving an adverse opinion and disclaimer of opinion, he should not give an unmodified opinion like a clean report and all. He has to give only one opinion on a single financial statement. Single financial statement, single opinion. To include such unmodified opinion in the same report in these circumstances that would contradict the auditor's adverse opinion or disclaimer of the opinion. When the auditor disclaims opinion, the audit report shall not include key audit matters. And when we have discussed in our key audit matters paragraph while discussing that, right? Because both were exclusive things. Both were exclusive things. And when the auditor expects to modify the auditor's opinion, the auditor shall communicate to the TCWG, which also we have discussed it earlier. Even while giving as a key audit matters also, those matters also have to be communicated from the matters that were being communicated to TCWG. And while coming to this diagram, this was from an extract from CA, a quick reference chart. With regards to any material misstatements, if they were material and not pervasive, they have to give a qualified opinion, like they have given here, right? Except for the paragraph, this matter paragraph and all, there were few exceptions. That is not all. There were few exceptions. So you have to give qualified opinion. If all, then an adverse opinion with regards to the misstatements. And inability to obtain sufficient and appropriate audit evidence, material and pervasive. Disclaimer of opinion. If at all, like not getting any kind of information, you have to give disclaimer of opinion. If they have got some information with regards to that, but only for few things they haven't got, you have to give a qualified opinion. And that's it with regards to SA 705. The most key part of the thing is only this diagram. Okay, now we'll discuss SA 706, that is emphasis matter paragraph and other matter paragraph. We'll go with the objectives of the auditor first. The objective of the auditor, having formed an opinion on the financial statement, is to draw users' attention when, in the auditor's judgment, it is necessary to do so by way of clear additional communication, that is, which had already communicated, he was doing it, repeating that, because that requires users' attention. In the auditor's report, where those were first communicated, they were first communicated in the financial statements. The matters that were disclosed or presented appropriately in the financial statements, the auditor is repeating for the user's attention. User's attention means like the stakeholders, etc. And with regard, that's the first thing. This is the emphasis matter paragraph. These are the objectives of the auditor with regards to emphasis matter paragraph. For the other matter paragraph, what any other matter that is relevant to users' understanding of the audit, that the auditor's responsibility or the auditor's report. Okay, this is something that were relevant for the user's understanding of the audit, how the audit was done and all, on the responsibilities of the audit or with regards to the auditor's report, etc. And now we'll see the definition of the emphasis matter paragraph, a paragraph which included in the auditor report, okay, that refers to matter appropriately presented disclosed in the financial statement. That is, financial statement have already disclosed the matter, then the auditor is repeating the same thing in the auditor report because he wanted to draw attention of the users for the draw the attention of the users. And other matter paragraphs which were included in the auditor's report, that refers to the matter other than those presented or disclosed in the financial statement, like what the auditors is thinking of, like his responsibilities, or with something that was which were not included in the financial statements. And we'll see those in a bit. Emphasis matter paragraph. First, we'll discuss the emphasis matter paragraph. This is a paragraph that was included with a heading emphasis matter paragraph, and it also includes a paragraph of clear reference to the matter that can be found in the financial statement. As per the definition, what the emphasis matter contains, it contains additional information with regards to the matters that were already disclosed in the financial statements in auditor's report, and also indicate that the auditor's opinion was not modified with the matters that were emphasized. This is also the same thing that was repeated in the key audit matter paragraph also. And now we'll see some audit reports with regards to that. You see, this is Air India's Limited, and they have given a qualified opinion. For this, they have given emphasis matter paragraph, or they have, see how the paragraph started, to draw attention to. This is to draw attention to some few matters that were already discussed, like for note 50 and all, note 26, which were already disclosed in the financial statements, right? In form of notes. And in last, what they have given, the opinion is not modified in respect of the above matters. That is what we have seen in the C point, right? And this point is with regards to the note numbers, they have given 50, 26 and all, and the heading that it consists of emphasis of matter paragraph. Okay, now what is the difference between key audit matters and emphasis matter paragraph? Emphasis matter paragraph is mostly communicating to the users of the financial statements, like for the bankers or the regulatory authorities or shareholders, etc. But key audit matters were the matters that were communicating to the audit committee of the entity. Yes, you heard that, right? Key audit matters were things that auditor is communicating through his audit report to audit committee. Okay, that's why they have given the audit procedures that are being performed. You see, you cannot simply identify that these are the matters that you'll be uh, communicating to the auditor committee and all. This is how an internal intention was. This is how, this is what the intention of the key audit matters were. What's the responsibility of the audit committee? To evaluate how the auditors were doing. First thing, they have to recommend the names of the auditor, remuneration, and how they were performing the audit and all. That's why for that performance only, they have given the audit procedures, what all the key audit matters that were communicated to TCWG and how they were addressed. Not only this, even here also, the key audit matter here and how the matters were addressed with regards to test of details and controls and all they have given. This is the difference between emphasis matter paragraph and key audit matter paragraph, key audit matters. And what's with regards to the other matter paragraphs are, they're not prohibited by law. That's simply saying that other matter paragraph was not prohibited by law, okay? And when 701 applies, the matter has not been determined to be a key audit matter to be communicated in the auditor's report. You see what they are saying, when 701 applies, when key audit matter applies, and the auditor determined that it is not a key audit matter. You see, what's the definition of key audit matter in the auditor's judgment? It is most significant, right? So he thought that that was not most significant, and he was putting that in a other matter paragraph. And the auditor shall include the other matter paragraph with other matter and all. That's what we have to see. We'll see an example with regards to that in the Tata Motors. There was a heading other matter paragraph, and what they have given that they have not audited a joint operation which was audited by the other auditor, which have been audited by the other auditor, which was furnished by us by the management. They thought that this is not a key audit matter in their paragraph, in their professional judgment, so they have given that in other matter paragraph. And that's it with regards to the other matter paragraph. And the circumstances where the auditor may consider it necessary to include in emphasis of matter paragraph are, these were the circumstances which make the auditor to include those matters in emphasis matter paragraph. First thing, emphasis matter paragraph was communicated to stakeholders or users at large. Key audit matters were communicated to the audit committee. Other matter paragraphs were not that significant matters that were not presented or disclosed in the financial statements and all. And what are those circumstances which include in the emphasis matter paragraph were any uncertainty like litigations or any regulatory actions and any significant subsequent events that have occurred, like fire accident of in the factory, or in the with regards to the early application of the new accounting standard which has a material effect on the financial statements, any major catastrophic that had and continues to have a significant effect on the entity's financial position. That you see, all these matters were very significant. That is, they had an AFRF which was not acceptable, and to alert users with regards to the financial statements are prepared with a special purpose framework. Those were not general purpose financial framework financial reporting statements. They have a special purpose framework. And when the facts came to know that the auditor, after the date of audit reports, and the auditor provides a new amended auditor's report. We also have discussed with regards to amendments of auditor's report also, right? And that's it. We have completed our SC 706. And now we'll move on with SC 710, that is comparative information and corresponding figures and comparative financial information. And this time we are not going to see directly the objectives of the auditor. We'll watch a video. This is our keyword kit series. This is a video of keyword kit series. You see, corresponding figures were numbers from same time period for the last year. That is comparing 2 years. It's corresponding figures. Okay, like they have sales a comparison with in a toy store from 2020 to 2021. Okay, and with regards to the comparative figures, what they have said is that it is similar time period but not the same time period. Similar time period means what? Like with regards to the seasons, like they're comparing the sales with regards to the summer season and the winter season. That is what they're comparing. They're comparing two different seasons corresponding were same element, like 2 years. They're comparing 2 years or with the last year, etc. And here they were comparing 2 quarters, or say they were comparing the summer and the winter. Comparing is comparing similar things. What do? We compare similar things. Okay, and that's what the difference between the corresponding and comparative. Comparative were two different time periods which were similar in nature, but not this from the last year, etc. For the last year, it is corresponding. And with that said, we'll just See now the objectives of the auditor. The objectives of the auditor is to obtain sufficient and appropriate audit evidence whether the comparative information included in the financial statements. Comparative means summer, winter, okay, in all material respects in accordance with the requirements of comparative information in the AFRF, and to report in accordance with the auditor's reporting responsibilities. Okay, this is with regards to the objectives of the auditor. These were the definitions. All the three things were there, right? First, comparative information is the amounts or the disclosures included in the financial statement in respect of one or more prior periods as per AFRF. It's a simple definition which we do not usually get remembered with that. Corresponding figures were those comparing with last year. Okay. Comparative information where amounts or disclosures for a prior period that are included as an integral part of the current period of financial statements and are intended to be read only in relation to the amounts and other disclosures in relating to the current period. You see, it's a comparison between the current period and the prior period. The level of detail presented in the corresponding amounts are dictated primarily with the relevance of the current period figures and all. This is just definition for you to understand, but mostly we have to write not the definitions usually. And comparative financial statements were comparative information where amounts or disclosures for the prior periods are included for comparison with financial statements of the current period, and the level of information that was, it was all the same with regards to this. Okay, usually in any kind of financial statements, what do we have? This is an audit report. What they are doing is they are comparing balance as of March 31st and March 2020. That is, they're comparing the previous prior period items, right? This is what they have set as a corresponding figures. These were corresponding figures. But when you see the annual report of Tata Motors again with regards to, wait, yeah, this is the annual report with they have compared the remuneration of one managing director, that is for the April 2021 to the June 30th, and they have compared with the managerial remuneration from July 2021 to March 2022. That is of the similar kind of time periods. This is what the comparative data they call it as. Yes, this is how they use the corresponding and the comparative figures. And with that said, we'll just move on with SS17 here. What the audit procedure? First, you have to assess the consistency of the accounting policies and check comparative figures. Comparative figures is that remuneration with that the amount and disclosures in the prior period, and determine that the financial statement contain appropriately classified the comparative information and evaluate the impact on the financial statements and obtain written representations. You see what the auditor has to do. He has to check the accounting policies, and he has to check whether the amount and the disclosures check the comparative figures in the prior period, and you have to check whether they have been properly classified or not, and you have to check the impact on the financial statements and and the written representation thereof. And if the audit report of the earlier year is qualified, what you have to do, because corresponding figures something we have to compare it with the prior period, and most usually even not every time, but sometimes the comparative figures also has to be compared, right, with the prior period items. When auditors report in the prior period is qualified or adverse, or a disclaimer of opinion has given, you have to check whether that item was resolved or accounted or disclosed as per FRF, and need not refer the previous modification if they have resolved or accounted or disclosed that. If they have rectified the prior period mistake, the auditor need not or refer to the previous modification. If unresolved, then what he has to do, he has to refer current period figures and corresponding figures. Corresponding is prior period figures, and those affect how do they affect the financial statements of the current period, and in any other case explain the opinion modified because of the effects of the unresolved matters. Okay. And with regards to the audit report, with respect to the corresponding figures, the auditor opinion should refer in his opinion only when, if previous year auditor's report is other than unqualified, that is, it has qualified, and prior period statements were not addressed, if prior period financial statements were unaudited. Then what? if all the three happens, if any of the three happens, what he has to do, he also have to give opinion even on the corresponding figures. Usually, if prior period items were audited, he need not give with regards to the corresponding figures. Corresponding figures are prior period figures. And if at all they were qualified, audited and qualified, if they were resolved and accounted, he need not specify that modification. If they were unresolved, what he has to do, he has to refer how it would impact the current year financial statements and effect of the modification and all. And in his audit report, what he has to do with respect to the corresponding figures, he also have to form an opinion, because the prior period items were not audited or prior period misstatements were not addressed and prior period audit report was qualified. Yes, it is not a clean report, then he has to form an opinion on that. And with respect to the comparative figures, the auditor opinion should refer in his opinion only when the auditor's opinion shall refer to each period for which financial statements are presented, on which audit opinion is expressed, and the difference in the opinion on the previously issued financial statements, and if previous year financial statement audited by some other auditor, and if prior period financial statements were unaudited. Same thing that was repeated here. You see, when financial statements were unaudited, yes, unaudited, and if the previous financial statements were audited by some other some other auditor, both this come hand in hand, and the difference in opinion, and also the auditor's opinion shall refer to each period for which financial statement, that is, he has different opinions with regards to that. So these two go hand in hand, A and B, on which audit opinion has been expressed. And that's it, we have completed essay 710 also. And now we'll see essay 720, that is auditor's responsibility relating to other information. And we'll see the objectives of the auditor first, to consider whether there's a material inconsistency in between other information and financial statements. Other information, it is provided by the management or the board who prepares the financial statements. Don't get confused with the other matter paragraph. Other matter paragraph is what auditor gives. Other information is what management gives. And consider whether that matter is material inconsistent with other information and auditor's knowledge obtained in the audit. And these were the two things for the material inconsistency, and to respond appropriately when auditor identifies how he has to respond. He has to know whether it has to be a materially misstated or not. We'll see that the auditor's responsibility with regards to the other information. You see what the auditor was saying. This is responsibility of the other information is responsible for management and board of directors. Management and board of directors are responsible for the other information. And what they're saying, this other information or do not include in the financial statements or auditor's report. Okay, that's fine. Our opinion does not cover other information. Okay, that's first thing. They have disclosed the responsibility criteria. And with that, what they have said. And they have said that whether the so what they are asking the users, consider whether the information is materially inconsistent with the financial statement, first objective, and our knowledge obtained in the audit, second objective. And how he has to respond, he is saying that we conclude that there's a misstatement in this other information. That is how they have responded with regards to the misstatement. That is the third objective. All the three they have complied with. This is with regards to the objectives of the auditor. This is just a definition, financial or non-financial information and all, and how the audit procedure have to be. First, he has to obtaining the other information and read the other information, and then respond with regards to the material inconsistency, which was there or not, whether they were materially misstated or not. That's what they have discussed here, right? That what they have discussed here, they have materially misstated or not, and they have found that there is a material misstatement. And responding into that, if there was a material misstatement, they have to respond to that, and they have to report, and documentation has to be done. That's what all with regards to the other information. And that's it, we have completed our standards, and now we'll discuss the important questions. We are not discussing the direct questions that could be asked, like a list of self-review, list of threats for independence, or the fundamental principles of the ethical requirements and all. We are not discussing those. What we are something you could easily write after seeing this PDF or reading from any notes and all. But what we are discussing is all the important points, important questions in the latest MTPs, RTPs, and we are covering both the MTPs and we are covering the latest RTP and case-based questions, like something those were not direct questions, and and we'll discuss how to write answers with regards to that particular standards. And for a situation we have 2 to 3 standards that comes into our mind, how to incorporate those two things, and when we find one, how to find the linked standards